technology, economics, management, and policy. So ultimately, our mission statement is the business and policy of digital financial services. And again, thanks to Chris. Where are you, Chris? Chris, there you are, Chris Calabria from Gates Foundation. We're going to hear from him right after me for your support, your multi-year support and faith in us for the past few years. It's great to have you as a partner. Thank you. So about a bit of our activities. This is what we do. You can go online. There's a QR code inside the booklet where you can go straight to our website and see all this. We do a lot of model laws and regulations we've written, which are there for regulators around the world to utilize. Webinars, capacity building webinars, which are extremely popular. Summits, this one. Conferences, roundtables. There's a legal and regulatory database of about 70 countries and other information is entirely free, built bootstrapped and built from the ground up. We work on blockchain, identity. This is inter alia, anti-money laundering stuff, mobile-related studies. And what you'll hear from about a bit later is what we're building for in the next few months, which should be released, an actionable cybersecurity risk management framework. Again, a lot of papers and studies, commentaries, analysis of new laws and regulations, collaboration with industry, regulators, academic standard-setting bodies. So you can see we're kind of an omnibus observatory working with a lot of folks around the world on all manner of issues. Our webinars, there's a screenshot of some of them, and you go onto our mailing list. You'll be told when they are. We've got one coming up in a few weeks on gender and cybersecurity. This is our website, dfsobservatory.com, and this is the legal and regulatory database. Again, this is free, and you're welcome to trawl through this at your leisure. As I mentioned, we're building a cybersecurity actionable risk management framework. This has been going on for quite a while with support of the foundation. We're looking forward to publishing it and it being utilized by many countries and entities around the world. So a bit about the summit evolution. I've been organizing this one since 2010 when I started this. We started off as mobile commerce, and you'll see the evolution. 2014, it was mobile payments. Then 2016, digital financial services, and now it's more of a omnibus digital finance summit, which you can see from the agenda. You can see it's a pretty jam-packed agenda, so although we're running a bit late, we'll try and make up time during the day. It's in your bio booklet, and you can go online and follow it, and the speaker bios and the like. So ultimately, if you look at the agenda, you'll see all these topics, and there is a golden thread running through all of them, believe it or not. So anything from blockchain to innovation, investors, payments, banking, identity, artificial intelligence, privacy, and ultimately this rolls up into what I call digital economy. And we're going to talk a lot about innovation. So ultimately, that's the goal of a lot of the folks who are here, is to innovate new business models, new players, new technologies, and really disrupt. And that's what we've seen. Disrupt in the sense that we have, for example, blockchain is an ultimate disruptive technology for now, and we're going to hear the implications of it, from the cybersecurity to the regulatory implications from a lot of our speakers during the course of the day. So that's enough from me. Learn, network, have fun, and ask questions. And please tweet. That's our hashtag at the bottom. It's also on your bio booklet, so feel free to tweet out anything that you hear about today. So I'd like now to hand over to Chris Calabria of the Bill and Melinda Gates Foundation. He's a senior program officer there.
Yeah.
All right. You can see why I didn't last long in the major basketball leagues. Okay, here we go. So my name is Chris Calabria, and I'm a senior advisor for supervising regulatory policy at the Bill and Melinda Gates Foundation, where I'm part of a team called Financial Services for the Poor. If you're familiar with the Gates Foundation, or perhaps if you saw the recent Netflix documentary about inside Bill Gates' brain, you might be familiar with our work on public health, vaccinations, medicine, education, and so on. You might be surprised to know, though, that we have a program in financial services. If you were surprised, you're in good company, because even though I'm a bank regulator by background, I didn't realize how deep the Foundation's work was in financial services until just before I started at the Foundation. So why is the Gates Foundation involved in financial services for the poor? At the Gates Foundation, we believe that every person deserves the chance to lead a healthy and productive life. And our mission is to address inequities in all forms to help realize that vision. We seek to improve the lives of the poor by finding ways to increase access to healthcare and medicine, to clean water, to good nutrition, education, and economic opportunity, which includes access to financial services. A growing body of research shows that having access to appropriate financial tools strengthens the financial resilience of individuals and families and enables the poor to lift themselves out of poverty. Over the last 15 years, technology, and especially payments technology, have been important drivers of inclusion in emerging and developing market economies around the world. Consequently, at the Foundation, we work to expand access to digital financial services among the poor, women, and the unbanked, especially in lower and middle income countries around the world. Now, the Foundation has partnered, as Leon mentioned, with Columbia University Business School in 2015 to help launch the Digital Financial Services Observatory here at the Columbia Institute for Tele-Information. And we've been pleased to support the leadership of Professor Ellie Noem, Dr. Leon Perlman, who's just here, Jason Buckwitz, as well as the broader staff and leadership of the Institute and of the DFSO. Now, when we launched this initiative in 2015, our goal was to provide high-quality academic research that anticipates, analyzes, and advises on the main regulations likely to affect the development of financial services in emerging and developing market economies. We wanted to ensure that those services emerge in a fashion that is safe and sound, competitive, innovative, and protective of consumers. We especially wanted to ensure that financial systems serve the needs of the poor, women, and the unbanked. Now, since 2015, a lot has changed in financial inclusion, yet much remains to be done. This can be seen both in the number of people with access to a formal financial savings account of some kind, but also in who is providing that account to them. First, with regard to the number of people served in financial services worldwide, lower and middle income countries have recorded substantial increases in the number of adults with access to a financial services account of some kind. The World Bank reported that 515 million new adults have gained access to an account of some kind since 2014. That means that today, about 69% of individuals over the age of 15 worldwide are banked in some fashion, up from 62% in 2014 and 51% in 2011, when the World Bank first began gathering surveys on financial inclusion. That said, improvements in access to financial services have been uneven around the world, and particularly the gender gap remains virtually unchanged since 2011. Today, just 65% of women have an account compared to 72% of men worldwide, a 7 percentage point gap that's persisted since the World Bank's first survey in 2011. Women's access to financial services is a special concern for us at the Foundation, as countless studies across countries and cultures has shown that when women have access to their own accounts, own digital accounts, it's a win-win for everyone. Women tend to spend more of their funds on their family's nutritional needs and on their children's education, resulting in better health and educational outcomes for all. While many issues may be holding the gender gap open, a significant challenge that women face in lower income countries is proving who they are sufficiently to meet Know Your Customer rules so that they can open a financial account. So promoting modern identity standards and national identity systems is one of the Foundation's primary areas of investments in digital infrastructure that is meant to help increase inclusion, especially among women. As a result, this is no time for any of us to rest on our laurels. 1.7 billion adults continue to lack access to financial services worldwide. These unbanked people don't enjoy the means that we take for granted to save for the future, to conduct their daily economic transactions safely, securely, and efficiently. and to invest in their families' futures. Yet of these 1.7 billion people, the World Bank estimates that just over 1 billion of them own a mobile phone. Technology, consequently, is continuing to play an important role in how we will include formerly unbanked individuals into the financial system. And who provides those accounts is the second area in which we've seen important changes and trends since 2014. While banks remain at the core of financial services in many markets, non-bank providers continue to grow in importance in serving the needs of those living in impoverished or rural areas. Less than 15 years ago, mobile phone providers began experimenting with basic financial services, principally payments. The best example might be the innovative M-Pesa service launched in 2007 in Kenya by Safaricom, a telco and mobile phone company. Sub-Saharan African countries continue to lead the world in the use of these non-bank mobile money services. Today, 21% of Sub-Saharan Africans have a mobile money account, a near doubling since 2014. Worldwide, the World Bank reports that 52% of adults have sent or received a digital payment of some kind, whether mobile or online, up from 42% in 2014. These changes in the payment space have driven regulatory reforms as well, with new kinds of payments bank licenses launched in India, and a similar payment services bank license recently launched in Nigeria. These narrow banks, if you will, are allowed to accept and hold funds for consumers, make payments on their behalf, usually on a mobile phone, but generally not to extend credit to them. The advent of Fintech firms, that is, technology providers that play a more direct role in financial services, as well as the emergence of massive social media platforms providing payment services in some countries, is accelerating other changes in how consumers access and use financial services in developing and emerging market economies. Now, given especially that social media platforms seem to know more about us as individuals than just about anyone else, including the government, privacy and efforts to preserve privacy have been just as important to the poor in emerging and developing countries as they are to those of us in developed countries. Taken together, these trends in the numbers of new customers served using mobile devices and the greater range of firms involved in this work makes the work of the DFSO even more important today. We recently renewed our partnership with the DFSO in late 2018, asking Ellie, Leon, and their team to focus especially on the regulatory and risk management aspects of technology in the digital financial services area. From the Foundation's discussions with financial service providers, regulators, central bankers, consumer advocates, and technology providers around the world, we know that one of the foremost concerns for everyone is cybersecurity. So DFSO and we agreed to emphasize the work to identify and understand the cybersecurity risks of today and those on the horizon that may affect the delivery of digital financial services in developing countries. In particular, we're seeking to build risk management and policy frameworks to help providers and regulators to manage, prevent, and respond to cybersecurity risks in a systematic manner. On that note, we're pleased to welcome Keith Bowie to the DFSO as a research scholar, who together with Leon and others is spearheading much of this work, and you'll get a chance to meet Keith later in the afternoon. In addition to cybersecurity, the Gates Foundation and the DFSO continue to collaborate on several other subjects at the heart of technology, regulation, and financial inclusion. You know about these areas of focus from DFSO's many webinars, roundtables, publications, and postings, as Leon just showed you on screen. And we're so fortunate that today we'll get a chance to hear from experts across the public and private sectors, including from the Superintendent of the State of New York, as well as from locations near and far, on topics related, once again, to digital payments and emerging payments technologies that have been so important to promoting inclusion, to related emerging technologies and distributed ledgers, such as blockchain platforms, identity, and especially digital identity systems, a critical area of focus for improving women's financial inclusion, as well as the related issues in privacy, and innovation and efforts to promote new thinking on technology and business practices, especially through incubators and national strategies. I'd like to thank all of you for taking time out of your busy schedules to join us in thinking about how we can improve inclusion for the poor, women, and unbanked around the world. So let's get started. Thank you.
Thanks, Chris. It's now my honor to introduce aforementioned Superintendent of the New York State Department of Financial Services, not of New York State. Linda Lacewell, we're super glad to have you here, and everybody's really looking forward to your remarks. A little about Superintendent Lacewell. She currently serves as Superintendent of New York State Department of Financial Services, also known as DFS, so we share an acronym at the very least. As superintendent, she oversees and regulates the activities of approximately 1,500 bank and non-bank financial institutions and more than 1,400 insurance companies, totaling 7.3 trillion in assets. This includes many fintech companies, such as those licensed as money transmitters, licensed lenders, or virtual currency companies. Since becoming superintendent, she has championed economic justice, fighting for consumers, helping expand access to financial services, and supporting community institutions that serve their residents. I'm honored to ask Linda Lacewell, Superintendent of New York Department of Financial Services, to address us for the keynote. Thank you.
Thank you, Dr. Leon Perlman, for that introduction. I was a little confused, truthfully, when I got invited to a DFS symposium. Given that I am the superintendent of DFS, I thought maybe you guys would throw me a party to congratulate me on my one-year anniversary at DFS, which was earlier this week. Thank you very much. And then as I was sitting here waiting and I heard Leon say we've had some problems with the subways, I was hoping he wouldn't read into my bio that I'm actually on the board of the MTA. I will not be taking questions on the MTA. And thank you to Chris. Boy, you know, services for the poor, it's hard to think of anything more important. The subject matter of this conference is really reflective, actually, of our priorities at DFS. So innovation, financial inclusion, empowerment, and how these all connect. So DFS, you probably know, was the merger of banking and insurance after the financial crisis in 2011. It's one of the first things Governor Cuomo did. So I like to think of DFS as being born of innovation because there was a sense that we had too many silos in government. Banking over here, insurance over there. There are risks in the market irrespective of the nature of the product. So let's break down those silos. Let's put all financial services together. By the way, whether it's banking, insurance, or other kinds of lending, credit, financial services, and products across the board. So we not only have your traditional industries, but if you think of Google payments, Apple payments, PayPal, all those of the like, across the board, check cashers, almost every financial service and product you can think of. And the statute creating DFS was written broadly for a reason, because of the need that it was born of. So we actually have something called gap authority, which means if a financial service or product is not already being regulated primarily elsewhere, for example, the federal government, then even without it being expressed in the statute, DFS can come in and regulate that service or product. So it is a pretty awesome responsibility, and our first task, of course, is safety and soundness of our industries. But as I've been saying, that's job one, but that's like a C+, right? And we're at a university, that's a C+, because there's so much else to do. And we put the consumer at the center of regulation. Why? Because everything that our industries do and everything that we do, all the decisions that we make affect people, otherwise known as consumers, right? Consumer is just somebody who buys a product or service directly. It's not some subspecies out there of like, you know, there's people and then there's consumers. Everybody in this room is a consumer, okay? Everybody who's in financial products and services is also a consumer. So the people who are affected by everything we do have to be at the center of our calculus because it affects their daily life. My background, I'm a former federal prosecutor. I worked for Governor Cuomo when he was Attorney General doing corruption and healthcare-related investigations, and then went with him with a group of people when he became governor, ultimately as his chief of staff. In the governor's office, one of the things I did was help create the Open New York Open Data website, which was a window into innovation for me and very impactful. As far as financial inclusion is concerned, we all have narratives, we all have stories. My mother was born in Calcutta and ultimately emigrated with her family to England when she was a teenager. Married an American and had 3 girls, one of which was me. But, you know, we all have narratives and stories that are complex and diverse in some aspect or another. That was mine. Encounters along the way really open your eyes to the great diversity that we have, the problems that people of color incur, and what the potential paths forward may be. And the diversity is so vast and broad that we are essentially all the same, and we need to keep that in mind. So DFS is 8.5 years old. We had the honor of ringing the bell at the New York Stock Exchange in the fall to celebrate that. As I mentioned, I'm 1 year in and taking stock of where we are and what we've done. DFS across the board has led just as New York leads, right? DFS was the first regulator to put together cybersecurity regulations. That was a few years ago, now in full force and effect for all of our regulated entities and their third-party vendors. And that's critically important because cybersecurity is the biggest risk we face, governments, industries, elections, across the board. And it's got to be wrapped in. And as we move forward in a digital society, cybersecurity has to be wrapped within the products and services and institutions and sectors and everything that we do, because again, there's no sort of fintech or tech company here or product or service and then, oh, let's think about cybersecurity. It's got to be there in the design, otherwise it's not going to work. And whatever you build will then be at risk. I also co-chair the governor's advisory task force on cybersecurity, which, as you can imagine, has been pretty busy lately between cybersecurity threats from Iran, followed closely by taking a hard look at election security in the state of New York, which the governor is very focused on. And I think that given what everybody saw in Iowa, centering around a particular app and whatever happened there, shows the importance of having good systems in place, because when things go wrong, people panic and they think the worst. And what happened? Was it some external threat? They say no, but then is it incompetence? They say no. So what actually happened? And you need to have confidence around technology if you want to innovate in a meaningful way and move forward. DFS also has global impact, partly because of the nature of the institutions, some of them that we supervise. Foreign banks typically have a presence in New York and typically are regulated by DFS, and so that gives us a global reach with a whole host of issues to consider there. In addition, since the states are the regulator of insurance, no dual system there, our large insurance companies are global actors, so that presents a host of issues as well. So as a result, our partnerships are not just with the federal government and with other state regulators, but we have partnerships with global regulators. I met with some of them in Europe pretty recently on both the insurance and the banking side, and it's very important, especially when we both supervise the same institutions, to ensure that we're talking to each other, we have an open dialogue, we're appropriately sharing information. And it was interesting to find that they're confronting many of the same issues, of course, that we are. Cybersecurity, climate change, fintech, how to nurture industries that are, have been traditionally less innovative and now need to innovate, to wit, smaller community banks and the like, and how do we protect consumers in all of these endeavors? Because while I said consumers are at the center of regulation, what they said to me in Europe was the consumer has to be at the center of innovation. And of course, they're exactly right for a lot of the same reasons. And so with that global reach in mind, DFS was the first banking regulator, state or federal, to join a global coalition on climate change, known as the Network for the Greening of the Financial System. We also joined a similar coalition on the insurance side, which is the Sustainable Insurance Fund, SIF. And very recently on the innovation front, we joined GFIN, which many of you are probably familiar with, a global network on innovation. And of course, the minute we joined, they voted that their next conference would be right here in New York. So we look forward to that. And I'm also pleased to announce that at the end of that week, which is Fintech Week for New York, on April 2nd, DFS will be hosting an all-day conference on innovation and financial inclusion, which again speaks directly to what we're discussing here, and that's going to be very exciting. So we are mindful of the pace of change, which you know better than I do, in the technology space and in the knowledge space is extremely rapid, right? The speed of change is not every 10 years, it's every year, it's every 2 years, it's doubling, tripling, quadrupling. They now say, studies say, if you're going to school to get an engineering degree, by the time you graduate, everything you learned in your first year is going to be obsolete. So that speaks to you about what kind of training and lifelong learning we're going to need and what kind of skill sets that we're going to have to teach people rather than just having them learn pieces of information. So as a result of all of this, this is why one of the first things that I did when I came in last year was to create a division of research and innovation. We had a little office that handled something called Bitcoin, cryptocurrency, you probably heard of it. And we took that little office and we made it a full-fledged division, same size, parallel to banking and insurance, and recruited somebody who actually understands these issues, the great Matt Homer, who's here today, to head that. And he's leading us by leaps and bounds into innovation and into opening up to dialogue and partnership, with all of you, to make sure that we grapple with innovation in a way that considers the views of all stakeholders, right? Consumers, yes. Industry, yes. Because these are complex decisions that have to be thought through together, hence events like this today. And just this week, we announced Project Whitehall, which is an InsurTech initiative designed to facilitate dialogue between regulator and InsurTech innovator, and there's an opportunity to seek dialogue with DFS if you are nurturing an InsurTech idea and you want to talk through what the guardrails are, what the regulators expect, and that's very exciting, and that's a first for DFS, so that's very important as well. We're also going to be going back to the UK to meet with government officials and regulators there, the UK Treasury, Bank of England, the UK government has invited a small coalition of states to go to London and sit down and meet with the UK government, the relevant officials, and others to see how we can partner and what trade opportunities there may be. And that's very exciting as well because New York is a global center, right? And so we want to create a marketplace where you can not only innovate and grow your companies, but where you understand that this can be a point of partnership not only with other states, but also with other countries, and we'll see what kind of collaborations and agreements that we can reach with the British. I grew up part of my life in the UK, so this is very meaningful to me. But obviously, there's a lot of innovation going on in Europe, and companies want to innovate across nation states. So we're very excited about that, and that's an announcement for today. So, and let me just say that I think that innovation and regulation are not necessarily in conflict. Because if you're innovating, you're creating something new. And if you're creating something new, number one, you're going on a level playing field, that if you're good-hearted and good-minded and you want to create a company that's acting with ethics and morality, you don't want the company next door to you to be doing something else. So having a regulator articulate what the guardrails are is important for a competitive purpose and a level playing field. Second, it's important because fintechs, insurtechs, all new innovators, you're offering a financial service. You're just like every other financial service company, which means that there are bad actors out there who may seek to use your services and products, money launderers, terrorists, people in sanctioned countries, thieves who want to steal your product, cryptocurrency exchanges hacked in 2019, investors lost over $500 million. And if you have the right risk controls in place, which we identify for you, then you help protect yourself, you protect consumers, you don't become a tool of the bad actors, and who wants that, right? And so it's really, really critically important. And I have to tell you, in the cryptocurrency space, which we are the only regulator of, as you know, it's a marketing point. I can't tell you how many cryptocurrency-related companies come in. They show us their marketing materials. They're very proud. And it says, we are the regulated cryptocurrency company, right? Why do they say that? Are they so excited to have what some see as a burden of regulation? Well, I tell you who's excited. Their prospective investors, their prospective counterparties, anyone that they're going to be dealing with, because it's a stamp of approval that somebody has taken a look and vetted it. And in an innovation world, that is a competitive advantage. So we feel good about that. At the same time, I fully understand that DFS itself, as a child of innovation and as one who is intersecting with innovation, which is sweeping through all our industries, has to change as well. We have to reinvent ourselves to be equal to the task of regulating you and of helping you grow, because innovation is important in New York, it's important to the governor, it's important to DFS, it's important for economic development, which happens to be part of our charter, and we want all of those things to occur. But we have to be equal to the task. We have to be more agile, we have to meet the market, we've got to get speed to market. I am opposed to backlogs, just on principle, and government has to work and perform to get the job done. And we are very focused on that, and we're looking at our examination systems. We've got to be more risk-based, more data analytics-based. This is a huge undertaking, but one that I am fully committed to. In that regard, as you may know, I've recently mentioned that our Bitcoin license needs a second look. Why? It's about 5 years old. As Professor Chris Brummer pointed out to me, that's like, in the field of innovation, 5 years is a lifetime at least, right? Every year is probably a dog year or some equivalent. 5 years without taking another look, when that industry in particular has really grown to some extent, matured, become more sophisticated, different players, you've got institutional players, people have been living with the regulation for a while. What's working, what isn't, what adjustments can we make? And so that's why we've put out for comment, as you know, a couple of ideas, such as a self-certification program for new coins by entities already regulated by us, and other ways of streamlining the processes here. I want to take a minute to talk about the risks of innovation beyond the sort of traditional financial risks. Obviously, this is shown most directly by algorithms, right? People say technology doesn't discriminate. Well, algorithms can discriminate, even if they don't have a state of mind, right? And so the issue is, what is the effect of the algorithm? Who designed the algorithm, and what were they trying to achieve? And what are the data points that they put in? And what are the metrics they put in? And what is the mix? And algorithms, for most people, except whoever designed them, tend to be a black box. Big data, what is the use of big data, and what is the impact there when you take the human being directly out of the equation? Well, DFS has already grappled with this on the insurance side a couple of times. One, we told auto insurers, You cannot consider education or occupation when you're making underwriting decisions because it has nothing to do with the way people drive. And by the way, it has a disparate impact on some communities of color who may not have achieved the level of education or occupation that you think is a material factor here. And it's irrelevant, so just don't do it. Second, we told life insurers that if they're going to use big data in their underwriting decisions, that they need to make sure their decisions are not having a disparate impact on protected communities of any kind. And that it's their responsibility to do that work. It can't just be, I use somebody else's algorithm. You, the entity using the algorithm, take responsibility for it, whether you outsourced it or not, and figure out what the impact is. That's your job. And if you're going to make an adverse decision based on big data, then you're going to have to tell the consumer what you did. Because the transparency there and letting people know what happened is vitally important. So with those lessons learned, looking sort of more broadly at algorithms, of course you're probably familiar with the Apple Goldman credit card. You know, it's not a bank except it's Goldman, right? The advertising is, we're not a bank. You know, Apple's not a bank, but you know, Goldman is a bank. I have to know because we regulate them. Goldman Bank, it's called Goldman Bank. We regulate them. And they, in partnership, put this product out, and obviously there are a number of complaints, underscore complaints, right? Because nobody has the facts yet. Complaints that this product was not equally available to women. Is that true? Nobody knows because there's no transparency into financial products and services, credit decisions, lending decisions. How was the decision made about who to offer credit to? If you have two people in the same household, one a man, one a woman, what would the basis be for lending to one and not the other? What algorithms are involved? Is it one? Is it multiple? Was there a fair lending screen? It's the same analysis. Just because it's an algorithm doesn't mean it's not the same analysis. And it points also to a consumer confidence issue, which if you're innovating, you don't want to end up creating a product that gets criticized that has no transparency, because that's not going to be good for your business. And you don't want to be tainted by that. And you don't want to be viewed as doing that because you would never want to do that in the first place. So I have two lessons from all of this. In the interest of time, I'll cut through a little bit. One is the consumer, and the other is this diversity impact issue. On the consumer, if you think about data privacy, as mentioned earlier, there are companies out there that are sweeping through, vacuuming up data. There are acquisitions that occur just to get a hold of the data. There are companies that operate because they're thinking about getting your data for their second, third phase, right? We know this. There's private equity money, venture capital money going into a lot of these applications because they see they'll operate at a loss for a long time because there's some opportunity for them at some point. And now we've got the issue of the consumer's privacy on this data. What is happening to this data? Europeans grappled with it. California has now grappled with it. Nobody has it exactly perfect. I think it's fair to say change is difficult. But how did we end up here? How did we end up where we have all these companies with boatloads of data and now we're trying to figure out, well, what about the consumer? Well, the reason is because the consumer wasn't at the table at the beginning. The consumer was not at the table at the beginning. And that is a very important lesson, because if the consumer had been at the table from the beginning, we would have worked out what the rules of the road were then. Now the cat's out of the bag. Everybody's like, well, the data's already all out there. What do you want me to do? Yeah, because the consumer or the consumer perspective was not at the table. And as you innovate, you have to think about that, because looking at it later is going to be very, very difficult, which is where we are now. Second, diversity. There's story after story about, traditional companies, public companies, private companies, banks, insurers, and the lack of diversity in their top leadership and on their boards. And there's no doubt that this has been a problem. There are some changes happening, but it's not enough. The Wall Street Journal pointed out having one woman or one diverse person on a board is not impactful, because you just put somebody who can be viewed as a token, and you've got to have representation across the board, pun intended. So efforts are being made, right? California has a law now that is being phased in. We want one woman on a board. The next year we want 2. The next year we want 3. It's going to be 50%. New York, the governor signed a law at the end of last year requiring reporting from companies on what the board service is. And I have to tell you, in my new role over the past year, at least at the beginning, I mean, it's hard to shock me, but I was pretty shocked at the lack of diversity in traditional financial services, insurance in particular. So we had the National Insurance Association, all the 50 states and some of the territories in New York for their national conference. And as the host, I stood up to address the crowd, did a little homework. Out of the 50 states and all the territories, the number of women leading insurance as regulators is 12, including me. So that was pretty eye-opening. And the numbers regarding representation within the insurance industry is pretty dismal. Like much of other industries, it's pretty decent at the first level. It starts to taper off at the mid-level, and then in the executive suite, it's like, you're a unicorn if you're a woman in the executive suite. So that was impactful for me, and I said, we've got to have better diversity in the insurance industry so that we've got more diversity in women leading states as regulators, and so that we have more diversity leading this national association, which this year, or at least that past year, had no women on the board leading the NAIC. I think they now have one. So here's what I would say to you. Don't be smug about this because you're not a traditional company. What is your diversity? And what is your diversity going to be? Because you have both an opportunity and a responsibility. The responsibility I hardly need to articulate. The opportunity, all the studies show that diversity helps you. Diversity grows your market share. Diversity, guess what? Engenders creativity in executive suites and on boards. Why? Because everybody sitting around you when you're making important decisions looks just like you or each other. They're all going to say the same thing. You need diversity of all kinds. Women, people of color, immigrants, rural, farmers, LGBTQ, because diversity of all kinds, including diverse experiences, living overseas, whatever it may be, brings fresh ideas and energy, and that helps on the brainstorming, and that is going to help your company. And the statistics now are irrefutable. So it's ironic that traditional industry has apparently had trouble, right, getting to where they need to be, but you guys have no excuse because it all applies double for you. If you want to innovate, be diverse, and you're going to have that competitive advantage. And if you're innovating with a diverse team, you're less likely to end up with a product that has a disparate impact because somebody will have flagged it up front. It is a self-protective measure. And so I would say to you that that's really critically important. And so there's much more I could say, but I won't. I could talk about this all day. I'm sure you don't want me to do that. But as you go forward and change the world, as you will, just think to yourself, how much of the world are you bringing along with you? Did you put the consumer at the table as well? And what is the diversity of your team that you are building so that you maximize your creativity, your impact on the world, financial inclusion and empowerment? And are you innovating in ways that you generate products and services that further financial inclusion that is so critical to everything that we do? Thank you very much.
Thank you, Superintendent Leswell. As you can hear, Superintendent's been a powerful advocate for consumer rights, diversity, and innovation. We share not just an acronym, but it seems a lot of similar interests, especially in our cybersecurity and financial inclusion focus at the Observatory. And we look forward to much cooperation in the future. And we're going to hear also from Matt Homer, who's at the department in the innovation panel. So thank you again. Okay, we're going to do the next panel, which is the blockchain panel, and I want to introduce Sandra Rowe, who needs no introduction to most of you. Sandra is the head of the CEO of the Global Blockchain Business Council, and she will introduce the panelists in the panel. Over to you, Sandra.
Good morning, everybody. How are you doing? We're going to have a fun session this morning, so hope you have your preferred beverage. Sit back, relax, and if you have some questions, we'll do them at the end of the panel, but for now, we're going to start with the panelists because we have quite the diversity of panelists in terms of background and industry. So when people talk about financial services today, I think you are remiss to just think about traditional financial services. Providers of cryptocurrencies and digital assets are emerging, and some are very well established. Beyond that, we have people who are innovating inside of every single subsector of financial services, whether it's asset management or insurance or whatever have you, and a lot of it, some of it, related to blockchain and DLT. So we're going to try to cover as much of that as possible in the next 50 minutes. So without further ado, I'd like to start with Jeff, who is to my left here. Jeff Horowitz is the Chief Compliance Officer of Coinbase. I think most of you are very familiar with Coinbase. And I have a kickoff question for you, and we're going to talk about crypto to start and move into other elements of innovation happening in financial services. So, as a significant cryptocurrency market infrastructure institution, what do you see are some of the biggest challenges and frictions when you think about the customer and crypto? Linda just talked about putting the customer first, so let's start with that.
Sure. Well, thanks for having me. I would start off, one of the biggest challenges is how do you get into the crypto ecosystem? So we rely on bank partners around the globe to be able to convert their fiat into crypto. Banks are still a little skeptical about where this space is. KYC is expensive. As we have customers from around the globe, we're required to verify their identity. Not every country has an easy system to verify identities, whether that's a passport or a driver's license, but as you get to some of the more undeveloped countries, you know, a letter from a tribal eldsman is what's actually allowed in that country. But the systems that we've designed to try and do this in a quick and an efficient way are looking at scanning passports and driver's licenses. So we can't get a global reach around the globe and make this easy. We heard Linda talk a little bit about, actually the panelists before, about a digital identification. As we want to bring crypto to the unbanked, we need a digital identity. It's very repetitive and expensive to walk into a branch and have to give your driver's license, but when you open up a broker-dealer, give your driver's license, and if you have more than one bank account, it's repetitive and expensive. One of the other challenges we have is we don't have real clear guidance yet on, as we do funding, what is considered a security. We're still relying on the Howey test, which may have worked great for orange groves, but it never really contemplated a utility crypto token that starts off as a utility or starts off as a security, but becomes decentralized over time. There are a lot of really interesting projects that need funding, but we're a little stuck in, I won't say the dark ages, but somewhat of a narrow view of how we make those determinations. And that is making it hard to do that here in the US, and some of those projects are moving overseas. I think the other thing is customers are still worried about safety. We heard from Linda about cybersecurity. We're spending a lot of time building our custody solution. We just went through a SOC 1 Type 2 and SOC 2 Type 2. We're trusted with our customers' assets, and we are a DFS trust company, and we are looking at ourselves to meet those standards, just as whether we were a bank branch of a foreign bank here in New York. So I think those are some of the challenges, but I think as a community working towards how do we knock down some of those friction points.
Great. I should have asked the audience here, we're going to have some participation. How many of you guys actually hold any crypto at all? Actually, a fairly significant number.
How many are at Coinbase?
Don't answer that one. Don't answer that one. No obligation. Just kidding. No, but I will tell you, 5-6 years ago, I think there may have been 2 hands in the room if we were lucky. So there's been significant innovation and progress made to help probably reduce friction and also the education piece. Donna and Michael, do you have thoughts on what are some of the challenges for the consumer, the customer, and any progress that's been made around innovations that have helped?
Yeah, I can go first, yeah. So I think it's funny because we were discussing before financial inclusion of the poor, and I think if you look at crypto and the waves and what has happened in terms of adoption there, so last year you saw it as being the best performing asset class of anything, so it like basically doubled in value, which is huge. So when I guess the question that crypto is kind of slow, I don't think that's true. When I look at the adoption curve and what's actually happening and how we are looking at things, if you go a few years back, we definitely saw that the big hurdle were, as Jeff mentioned, getting banks to exchanges that enabled financial inclusion of the poor or those who wanted to transfer funds, for example, to the loved ones back home and so on. And I think the challenge for the industry today is more around financial inclusion for the rich. And the reason why I put it this way is because what we try to do today is to make this asset class available also for derivative products, for things that are like typically for the richer part of society. We want hedge funds to invest in crypto, and they want to get into this. And to do that, they need more regulatory clarity. Because if you're the poor part of the population, you don't need that regulatory clarity. You just jump on any opportunity. But if you have a lot of value to protect, you definitely need a lot of regulation, you need regulatory clarity. And the big hurdle I see in the industry today is that as this is a global market, price manipulation happening in a country in Asia can actually influence and being cashed out at exchanges here in the US. So we need to be better at understanding what price manipulation works and how we can help with that. So that's some of the things that I see as challenges.
So I would say that we need more regulation, not only regulatory clarity. So I think that going hand to hand with what Michael said, if you have price manipulation on exchanges, be it wherever they are, that ends up that the SEC, for example, will say, we can't do an ETF because the underlying is not clear as to whether or not it is being manipulated in general. So I would say, first, I don't think there is anything called a utility token. I think there are consumer tokens, and that the word utility was made up when they didn't want to be a security. And so I do think that we need to think more clearly, and obviously Hester Pierce yesterday issued a proposal which would be Rule 195 about a safe harbor, which will have a lot of discussion before it even gets anywhere in the next 90 at least days, and perhaps it will be her signatory piece before her term is over in this coming year. But I do think that we have to remember that digital assets is a small piece of the overall financial infrastructure, and securities laws have been working very well for securities, and we need to make sure that what we do is in a regulatory framework and not try and go in the gray areas all the time and end up in trouble.
Puneet, I'm not sure if you have any views on if you're hearing anything from customers, but if you have anything.
Yeah, so, I mean, from our perspective, we have been very closely monitoring the evolution of the market. Obviously, over the last year, there's been increased interest from global regulators on prudential regulation around this. So BCBS, which is the Basel Committee for Banking Supervision, and Bank for International Settlements, BIS, in December, published a consultation paper explaining and asking for feedback around how this asset class should be prudentially managed vis-a-vis the risk. Just on back of it, European Union issued its own consultation paper on the same lines. So we continue to monitor, obviously, those changes, which has bearing on how banks look at this overall. In addition, from a technology perspective, obviously the concerns around privacy, scalability, operational resilience, all those critical matters are also kind of evolving and have evolved a lot over the last several years, and something we continue to monitor from that perspective.
So this might be controversial to some of you. I'm going to just put it out there. If you believe this is a multi-trillion-dollar industry in the making overall, it may take us 5 years, may take a decade, 2 decades, who knows? But if you have that premise, then and it's borderless in nature, meaning it does not respect the fact that you are sitting in a sovereign country with rules and laws. It's quite the conundrum for global regulators to try to protect the consumer, to allow for innovation, and yet coordinate across oftentimes things that involve culture and sovereign and political factors as well. So when we think about that, what are some of the ways that a firm like Coinbase or Chainalysis will compete as you get some of the incumbents and the big techs coming in who are going to play in this field? So again, the assumption is this is going to be a big, big pie to go after, and big guys are going to come in eventually. Fidelity already has, and a bunch of others. So when that happens, and you have the epic battle of incumbents versus newcomers, how will they and how will you deal with a global regulatory environment and compete?
Sure. Well, it is borderless, but as crypto regulation is maturing, different countries are starting to issue their own guidance, and whether that's at the FATF AML standards level, or recently Germany came up with their own regulation. We're registered here in the U.S., in the U.K., in Ireland with the CBI. We are looking at applications in Japan and Singapore, and need to understand what each country's regulatory framework is. We've taken a long view. We've embraced regulation. We've tried to build our brand around sensible regulation and protecting our customers. There are other companies that are less brand aware and are going to the countries where there's less regulation, less consumer protection. I would love the US to lead in that, because if it goes overseas, most likely the customer protection laws there are going to be less than we have here. So I think what we need is a level playing field. We should be able to have crypto regulation minimum standards like FATF is trying to do, so that you can't play regulatory arbitrage. It's going to take a couple of years to catch up.
So I think one of the things that we are doing actively, so we have customers in more than 120 countries from different government agencies there, work closely with regulators in different countries, and one of the things we did early on in the EU was the 5AMLD around lobbying for more like friendly regulation or regulatory clarity for crypto exchanges in Europe. That came into effect today, and that took like 5 years to make that happen. So it's again working with regulators worldwide, ensure that they're all like having a good understanding of what are actually the opportunity here, and that you need to regulate this as a global thing and not just do it in single countries. And I agree with Jeff, like you definitely see some regulatory arbitrage where you see exchanges and other players in the industry try to move to jurisdictions where there's less regulation. And we also see, and that's some of the stuff that we highlighted in the crypto crime report that came out recently, is that we definitely see that those exchanges are being abused for money laundering in big scale, both for scams, but also for terrorist financing and other stuff.
Yeah, the other thing I would say, and going back to the title of the panel, which is blockchain, is that we still are conflating all of the time blockchain and crypto. And they are two related but separate things. And there are many institutions that are using blockchain in ways that have little or nothing to do with crypto. And then there are places that are trying to use a token or a digital asset in some way that they may not even need a token, and they may not need a blockchain. So I think when we think about when Sandra talked about the capacity of the industry and how it's going to grow and mature in different ways, but we need to be thinking about what we're talking about when we say the industry. Is it banks using blockchain? Is it cryptocurrencies? Is it supply chain blockchains? Which will all be viable different ways in which the industry will grow. So I think conflating them all the time and always making it as crypto is the industry is problematic because we want it to be much more than that.
Yeah, I agree. There's permission blockchains, permissionless blockchains. Crypto just happened to be one of the first experiments to figure out how to leverage the blockchain. But yes, people, when I joined Coinbase, my kids describe me as my dad does Bitcoin. Yes. But there are companies like JP Morgan that is developing, Quorum and their own platform to do stuff within a closed network. So there's lots of opportunities. If it's more secure, it can move stuff cheaper, quicker. We should figure out how to leverage that. It's sometimes we're a little the cart before the horse. The technology's there, but the regulations haven't caught up of how do we manage that risk.
Yeah, and just to add on to that, because you're an exchange, I do think that the more secure exchanges become, and you guys work on that too, we enhance the opportunities. We saw what happened in Canada. Because the exchanges weren't secure there, the Canadian government came in and basically said, if you don't know how to custody, you're a securities exchange, full stop. So I think that working together as the industry grows is super important along the way.
So I'm going to take a lead here from, I think the panelists got together without me because they've teed up Puneet's questions quite lovely, in a lovely way. Because we do want to cover the DLT and blockchain portion, which often gets let's put it this way, clouded because people talk about crypto as the only thing. But it's not true. Puneet, Citibank has been very busy, quietly busy. Would you like to share some use cases that excite you, some of the innovations that are going on, really from a focused on how do we make processes efficient and or better for the customer?
Yeah, sure. Just to give kind of a little background, we've been looking at this space now almost over 5 years. But very early on, we realized there are 4 things which are very critical. First is network adaptation. Financial markets are social in nature. People need counterparties, they need customers, people need to lay off risk. There needs to be a connectivity within the market. So just putting a solution out there just for Citi does not make sense. We need to collaborate with our clients. We need to collaborate with our counterparties. Second part was around the technology's own capabilities. We are really putting high-profile financial transactions worth billions of dollars onto this. The technology needs to meet the requirements which are suitable for that kind of high-risk threshold. And that's been actually the work over the last several years to actually bring it to that level. The legal and regulatory frameworks are important. I think we talked a lot about that. In some areas actually kind of from a supervision perspective. And lastly, actually focusing on initiatives which have direct cost benefit. In the early years, with the hype, there were so many POCs which were one and done. So you do a POC, and after that, there's no scalability, there's no replication, you cannot do it, and that's about it. You get a press release, and that's great. Again, from our perspective, our focus was to actually put efforts into something which will be meaningful from the industry perspective, from an institution perspective. So some of the examples which could be pretty pertinent are something we announced yesterday via a company called Exoni, which we're working with about 12 other buy-side and sell-side firms around post-trade processing. And post-trade processing in financial markets has not been one of the kind of areas where a lot of focus has been historically been, but I'm glad because of this technology or other reasons, there's been a lot more focus. So effectively, there is the equity swaps, which are swaps on underlying single name equities or on indices, which are very actively used by a lot of large investment managers and others to take exposure, where the back-end processes were fairly manual in nature. And leveraging this technology where we are hosting a node, counterparties would be hosting a node, effectively having something we love to call as perpetual reconciliation. So it means that us and our counterparties will constantly be reconciled. This is not really leveraging email, Excel, PDFs, which might have been happening so far, but ensuring that we are taking the risk out of the system, we are driving operational efficiency there. Other very related area and very interesting and which is very pertinent for this technology is trade finance. Global trade has been fairly paper-oriented, a lot of counterparties. Commodity trade finance, I get the numbers, about 37 individual different documents which get copied 240 times, around 29 different parties which need to receive some part of it, etc. So we went live last year in a commodity trade finance consortium working with commodity producers, the independent trading firms, certification authorities, financing banks together, called COMGO. The focus of that was to automate in the commodities trade finance lifecycle to begin with, a lot of work around letters of credit and financing of commodities trade. Another interesting example, very pertinent to this technology. I mean, frankly, putting this technology where it doesn't really make sense comes out very easily because you suddenly start questioning why do you need blockchain here? Why do you need DLT here? And you really need blockchain DLT on specific use cases. And one need to be cautious from the beginning that you are actually questioning yourself while endeavoring on that for long-term success. So I think those have been a couple of very interesting examples. There is work going on in Australia where the Australian securities settlement venue, ASX, is leveraging blockchain DLT technology to actually revamp their back-end processing platform. So their platform was product antiquated. They decided to leapfrog. It has taken a long while, obviously. The technology is still nascent and needs to make sure that it meets the requirements to go live to process securities for the entire market there. But the expectation is in 2021, they will go live. So again, very interesting initiative, pretty large-scale implementation. So some of the examples.
Great. And there's a key word that Puneet mentioned, which is consortium or consortia. To think of banks even 10, 20 years ago working together in a group of 12, I don't know how many of you are former bankers, but in one instance, in my early days at CME, we spent 6 months arguing about IP when we were trying to get together to do a project. The fact that this is advancing the way it is monumental and frankly a testament to the fact that blockchain is a team sport. So along those lines, Donna, can you give us a few thoughts on whether you see and what direction you see these? The technology is decentralized, but really it's a network of consortia that are forming.
Yeah, I mean, there are definitely a network of consortia not only between public blockchains and private blockchains, and at some point in the future, they'll be going in and out of one another. The analogy I use is if anyone knows England and you go for a walk in the countryside, there are public spaces that you go on the walk, then you open a little gate, you go in a little private part, and you go back out the gate, and you're still walking around. When you go in the private part, you're not invited up to lunch at the people's homes, but they've allowed a passageway through their house. And I think it will be very similar between public-private blockchains. The one thing I wanted to point out is because in this area, more on the digital security side, we have securities, and we have companies that want to go and create, public companies that want to go on the blockchain. And they want to for a whole host of reasons, including governance. We've seen a lot of very poor governance. We've seen the consolidation of voting for companies, for boards, for proxies, for social impact consolidated in a couple of different places. And so I think that blockchain and a number of the startups have the opportunity to break up some of these natural and also sanctioned monopolies, whether it's DTCC or Broadridge, over time, in where there'll be more opportunity for competition, and competition is good. It lowers prices, it creates just more innovation. And so I think that that's one of the very positive things that might be an outspin, and whether that's financial institutions using it, consumers will benefit, and you'll be able to actually hold a whole range of digital assets yourself if you want to, or custody them at Coinbase, Citibank, Fidelity, wherever.
Any views on your, Michael or Jeff, on your collaborations with big institutions? And do you find that you're increasingly having to work with incumbents?
So I definitely see that like big institutions start to move in there into the industry now, also in the crypto space. So I definitely see that there's huge interest. And I think it goes very well hand in hand with what I said before, like inclusion of the rich, which is kind of what is happening right now. We definitely see there's an interest in big banks to be able to custody crypto, to help their customers. They have had customers approaching them and say, can you store 70 million worth of Ethereum for me? And you prefer to store 70 million worth of Ethereum at JP compared to a garage startup that say they can do custody and have it existing for 2 weeks. So it's like, there's definitely something around logos here and that ability. It usually comes in waves, but a lot of things happening right now. One of the things I think is interesting to see at the growth last year is that we see some of the new banks like that are for a lot of like trying to get a wallet share of the millennials, that they're offering crypto today, and we're actually seeing those grow month over month in terms of processing of payments and so on. So it's a steady growth that is happening right now, and yeah, and I definitely see that the existing incumbents are embracing this.
For us, we want to see the crypto economy grow, and so competition is good. Whether that's the Fidelities or the Robinhoods or the large banks becoming actual crypto custodians, that's good for the longer term game. We've been at it, and we store $8 billion in custody through our trust company. Should the big banks get into it? I think that would be great. I think there's trillions of dollars that we can all share in that pie.
So let's talk about big tech, because big tech's been inching their way into financial services for years now, but we're really seeing some leapfrogging going on in the last couple years. What happens when big tech becomes bank-like, and they're also the world's biggest data aggregators and repositories of data? What happens there? What's the view? Do they get regulated like banks? How do we deal with this?
I think Linda Lacewell needs to come and regulate them.
Where's Linda?
No, I mean, I think you can't have it both ways. You can't decide that you want to be a tech company and give consumers consumer products that are financial instruments and not have any regulation. If you want to go to the Fed window and get the same rates as banks, you have to have be under the same constraints of banks. Also because they haven't acted towards consumers, as we all know, in a way that has protected them, whether it be their privacy or their data or other things. So if tech companies can go into a normally regulated environment without the same type of regulation, and using the same words, Linda, then the cat will be out of the bag before we can put it back. So I think that that we need to approach it slowly and conservatively, and make sure that the tech companies are providing technology, and then when they step into the arena of financial services, they have the same advantages and disadvantages as the people that are in financial services.
Yeah, we have that debate, are we a tech company, are we a fintech company, are we a financial services company? At the end of the day, we're a little bit of all of them.
Okay, so you're at the point where you guys are a hybrid. You're saying you're all of them. That's
Yes.
great.
You know, because we're trusted with people's money, and with that comes laws with regulations and responsibilities. So we need to embrace what our responsibility is there. But the space also moves quickly. We're a technology company, and we want to ship products, and we're trying to figure out how to do that at the pace that a technology company operates, but we've got rules and regulations to follow. So, you know, Linda talked about how they have a new framework of how do you list assets, and is it a one-by-one review, or can you work on a framework? We need regulations like that to keep up with the pace of what a technology company offers.
Yeah.
So I have a slightly different view on that. So I definitely agree that there needs to be some regulation around what happens, but also if you look at tech by its heart, it's like it's creating technology that can solve problems that we had to solve with paper and regulation in the old days. So sometimes we're actually creating technology that solves a regulatory problem, and that means that if you then try to shoehorn the regulation and force it to be regulated in the old ways, you probably need to learn something. So I think a good example of that were Uber and how they grow and have been growing with various success all over the world. And you could say, like, we had regulation around taxes for a long time. So the reason why you want a driver that's like with a certificate and a medallion and so on, you want to ensure that he's not going to mock you when you get into the car, and you know that it's there's a certain price and other things. So there's some transparency around it. And that goes both ways. There might be some monitoring in the car. They're not cheating. We can check their meters and so on. Tech can solve that in another way because, well, you can easily do ratings and figure out where the people are there. You actually know where they are on the entire ride because both the driver and the person have GPS there. So you can actually solve some of the regulatory hurdles to ensure that you have the same level of customer safety as you have in the old model, or at least adequate setup there. So I'm just saying that there are actually examples where you could say, well, technology solved a regulatory problem, not the way that it was in the old days, but in a new way. So we need to ensure that we just don't want to enforce regulation that might need to be changed over time.
I'm not sure that Uber is the best example. Because for the drivers, they would not say that technology necessarily enabled them to do a job, but then they wanted certain kinds of pay and scale and standards, which they're entitled to. And on the consumer side, there was a lot of safety problems in the cars that have been reported. And so, and clearly, Uber is not trying to be a financial institution. So I think there's the yin and the yang in each one of these different models as we go through, but clearly somebody's regulating Uber now, especially in California. So I don't think that's a bad thing. The GPS technology is good.
So this leads us to a topic that's going to play out, you know, for probably decades to come, which is the data aggregation piece. I think it's great, and Michael, I do see your point about technology can solve for certain compliance and regulatory challenges. But on the flip side, I think the key distinction that people need to make about why this matters to so many people around the world, this is now data not as just information, this is data as value. It's redefining the nature of what we consider as money and moving that frictionlessly across a digital network, whatever it may be. And so when you get to a world where you can move money around, however you define it, as quickly as you can move emails and basically at zero cost, what does that do to our current financial institutions, our networks, and also our regulatory regime? So when we just talk about data, what is the responsibility of institutions, all of your institutions, on how you manage that? Because let's face it, the backlash has only just begun, and I think the generations to come are not going to tolerate the status quo. So, anyone want to address how they're dealing with data and privacy issues?
Well, I can give an overall wish. So, you know, if blockchain and some kind of token, crypto, whatever, could give back to people that have had their data monetized by companies, the ability to monetize their own data whether that be that they could aggregate different things that they use on social media, and that a company would come to them and say, okay, I'm going to give you $20 a month, and that will be for your Facebook, or comparison of your Lyft versus Uber versus something else. That gives back to the consumer the ability to some way control and monetize their data. And I think that's a fantastic model for some companies. We've seen in New York Angels, a couple of different companies trying to do this. They were too early in the cycle. But I do think that if data is able to be monetized for the individual, then in some way blockchain crypto gives back and empowers the people that need financial inclusion most.
Yeah, I think blockchain has, and crypto has, the pros and the cons, right? It gives some level of pseudonymy where you can move value around the world and not have to worry about where's your personal data going. But that's a dual-edged sword, because we still have the law enforcement challenges, is they need transparency. So I think one of the steps is we need to figure out, as we're looking at big tech and fintech, what are the regulations they should be under? I mean, the first regulation that was imposed on cryptos was from FinCEN as a money service business, because we are dealing with fiat money, but I'm probably the farthest thing from Western Union on a daily basis. I'm much closer to a broker-dealer or an exchange. So I think it's finding the right regulatory framework. I mean, the CFTC thinks it's property or it's a commodity. I think if we can figure that out, we can figure out where the right regulation, whether it's privacy and data, should apply.
Any thoughts?
So I think around the data piece, I would say that, so first of all, we don't store PII in the edge analysis, so we don't have that data sensitivity to the same level. But I think that already today, we like to talk about data as being a big problem and privacy. We already use it as money. So I pay with data every time I search on Google, and I pay with data every time I look at YouTube. So I'm actually actively using it that way today, and people love to do that. But they also love to say that they don't like it, but when they vote with their feet, they don't care. So it's I think that it's kind of this dual-edged sword where we like to say that it's a problem, but at the same time, it might not be a problem to the extent that we are talking it up to.
Just to kind of close it, just when you think of this technology, it does allow control for individual or a company to get control on the data. The examples which I gave, in all of those examples, in a traditional sense, you would have actually had to send the data to somebody. And every institution will send the data to somebody who will aggregate and then sell it back. Here in this case, you control your data, you are data self-sovereign. And you manage and control the data, you decide who gets right to see it, etc. So it does allow, through cryptography, ability for data control to be kind of coming back to the generator of data, so to speak, and decide the ownership rights there.
So we're going to open it up to questions now. There are mics somewhere. So raise your hand and you will get the mic in your hand, hopefully. It's quite a few questions. Over there and over here. And if you're obfuscated by the pillar, because we want to see your nice shiny face, please come around and introduce yourself and also your organization, please. And it needs to be a question, not a statement, please.
Well done.
Yes.
Hi.
Gentleman to my right.
Hi, I'm Alan King from IBM Research. And since we already work with a digital currency, and Uber and Lyft and those companies rely on credit cards to actually make things work, I'm just wondering, what is the value proposition for blockchain and crypto as a payment mediator as opposed to an asset?
Well, I think you answered your question just by your statement, which was you need to have a credit card and you need to have a bank on both sides of the transaction. And there are a lot of people that have neither, or for a lot of people, the fees associated with those things are incredibly high. Also, the settlement for the person who pays and the person that receives can be a longer duration. So the hope is that blockchain and crypto, that the rails that are being built underneath will speed these transactions, and that the cost is de minimis. I mean, you can move a huge amount of Bitcoin for nothing, and I mean, Coinbase will be able to tell you even more, but as the fees are coming down, even for trading, the fees definitely associated with having a credit card. The hope is that using blockchain, people that have neither of those or remittances, for example, would be very, very cost efficient. Instead of Western Union charging people up to 15%, you could do it for 2%. And for people that are sending home what their minimum wage of $15 an hour is, that's enormous.
Yeah, I agree. Here in the U.S., we have Venmo, and we've got credit cards and debit cards, and it works really well. But there's a lot of the world out there where it doesn't work. And the example of $15 to send something to Western Union, where for pennies you could write it on the blockchain, that works. Bitcoin is more of an asset speculation. It's not yet fast enough as a payment, but some of these other coins and projects can actually work. But we're still kind of in the first inning. But I think we need to explore where those projects can go, and can we take out some of the intermediaries and some of the costs and allow assets to get around the globe cheaper, faster, and bring more people into the economy.
Michael, there's a question in the back? Okay.
Yeah, hi, Rahul Kapoor from Zero G Partners. A lot of the use cases you've talked about have largely been operational, compliance, risk-oriented. And you see a lot of companies, trying to disrupt with launching stablecoins, et cetera, to transform industries from a growth standpoint or transform their businesses to grow new markets, particularly in the B2B side. Wondering what use cases you see in some of those growth, market penetration areas, and how stablecoin you think plays in that whole ecosystem.
So I think like one of the things we see on the stablecoin side, they were probably launched first by Tether, and Tether is actually in trading volume and everything today is most days the biggest currency in crypto. So it's clear that it serves a purpose. And if you look at the volatility in crypto and the speed by which you can transfer it, and then match that up with the fiat system. So for example, if you're trading on an exchange in Asia and want to move your funds to say Coinbase, and you at the same time might want to do a fiat transaction first to your bank and then further from the bank account to the exchange, to the other exchange, then you're talking days. So it definitely means that you can do arbitrage, you can do a lot of things and really utilize the volatility of crypto way better by having a stable currency at the same time.
I'm on the record. Tether for me is 70 people going around 15 chairs, and when the music ends, there are 15 chairs. So I don't understand why people continue to use it. I do know what they do. I do know how much it's used in China and in Russia, but the logic of it just evades me. So I do think that there will be other different, better stable coins that will be trustworthy and pegged to something that's more 100% or close to 100% of reality. But in answer to your question, isn't always everything in the beginning about operations, compliance, and risk? Risk is always one of the biggest things you want to mitigate. So I can understand that that's where most of the projects are at this time.
Yeah, we have our own stablecoin, USDC, and it's pegged to $1 at a large bank. It's that base currency that allows trading pairs to move around the globe rather than always converting some kind of fiat. Once you're in a stablecoin, it can move and make transactions easier. But it's not just the Tethers and the USDCs. The Fed and national countries are thinking, can they digitize their own dollar? So it's an experiment, and we'll see where it goes.
Yeah, we could have an entire day on that one alone.
Yes.
So anyone who's interested, let's just sidebar that additional conversation. I think there's a couple more questions. Can we take maybe one or two more? Do we have time? Okay. The gentleman in the back's actually been very patient and waiting, so we're going to go there. Yeah.
I probably don't need a microphone because I got a loud voice. One question that I've thought about in the years since cryptos came up is if it's going to be used for transfer value, there has to be an exchange to get into fiat unless people envision that merchants all around the world will start accepting a variety of cryptos. And I haven't yet figured out if anyone has a notion of how that will actually happen, or if it will happen. Because to my mind, people use fiat. People don't mistrust governments in general. So you could transfer cross-border, but then you have to bring it into a currency that you can spend.
Well, if you talk to Backed, who just did another acquisition yesterday, they have some pretty strong ideas about how you're going to be able to use crypto to pay for lots of things in T plus 2, 5, whatever years.
5 years.
I don't know, I said T plus 2, 5 years, and there's a question mark at the end of that. I don't run, they don't tell me their secrets. But it was pretty clear what their roadmap was when they announced having Starbucks and others in their syndicate.
Yeah, but one of the initial challenges that for the payment to get set up was merchant acquisition, getting merchants to accept a electronic currency over cash. So when you have multiple competing digital currencies, the merchants, what's a merchant going to do?
I think Sandra just reminded me. I think it's also important to understand that FX markets currently, if you look at FX markets, about $5 trillion of FX gets traded every day. And the spreads are tiny. They're like in pips. So you're talking about not second decimal point, third and fourth decimal point. So we already are, when you think of cross-currency from an exchange perspective, we're pretty efficient markets. And actually the back-end settlement of it, which is another reason here in the crypto world that how do settlements happen between exchanges, between movement of all of this, is highly efficient. This 5 trillion gets actually netted down into about, I would say about $50 billion, $60 billion, because there's multi-party netting which is going on through a regulated infrastructure, which is reducing the liquidity risk associated with it. So it's a pretty complex matter as you add a new currency and as you think of currencies and exchanges of those, etc. Liquidity and settlement mechanisms, all of that ecosystem is very critical. So actually I agree with your point that it's a complex area.
Yeah, but going back to Sandra, what Sandra said in the beginning, when she asked how many people have had any crypto, I mean, the hands up today are very different than they were 2 years ago. Back to your time.
It's a self-selected.
I understand that.
True, could be.
And the students in my classes at Fordham, they know a lot more coming in to the class than they did 2 years ago. And that's not because they're any smarter, it's just it's more around them. There's more to read, and so it happens incrementally over time as the infrastructure and the plumbing gets built.
I mean, this is the epic battle that we have for the next decade, which is which crypto will prevail, and frankly, which will be used as payments, which will be used as store of value, and frankly,
Multiple decades. Just look at the time it took to grow credit.
perhaps, but we've already spent a decade, so let's see.
Give one more.
One more question, yeah?
Looks like we have been dancing around the elephant in the room, which is CBDC, because stablecoins point to that, and the payment stuff points to that. So what are your views on that? How close are we? Are there?
Vipin, can you tell everyone what is CBDC? for
Central
return?
bank digital currency. That
Thank
means, obviously it means fiat, but expressed like cash, not like a bank account, but something else.
So we didn't dance around it. We decided not to talk much about it.
Because then the other elephant in the room would have been brought into the whole conversation.
yes.
They're not
So-
in the room.
Yes, so a number of, many banks have been working on this for several years. The question is, do we really want a central bank currency, digital currency? Is that good for people? Maybe it's good in the United States, but of course, then we have China, and people are worried about China, not because the currency is going to be within China, because obviously that country and the way in which its people relate to it is their own entity. But what a number of people are worried about is the ability for China, if they have a central bank digital currency, to ask for countries in Latin America, South America, and Africa that they do a huge amount of resource business with to accept those currencies as payment, and then they can track where it goes through. through the world. So yes, everybody's talking about them. The former chairman of the CFTC is launching a project on digital global currencies. The jury's out. We'll see what happens. 2020 will be a lot of conversation about it, so no one will dance around it.
I think we have one more question that can be taken, and then after that, appreciate all of you have lots of inquiries. Maybe we can have a conversation after, but who's got a question in the room? Go ahead.
Hello, my name is Jabron from Queens College. I'm a student there. My question has to do with, earlier was mentioned that larger financial service companies are entering the crypto space, and that'll be good for the long haul and smaller crypto companies. So my question is, do you think there will be a shift in strategy for the smaller crypto companies? And if so, what does that strategy look like?
I don't know if it'll be a shift in strategy. I think, one, we could all play in the same marketplace. You may see some consolidation. I think you're already seeing that around the globe as some of the regulations, happen in the UK.
Yeah.
Some of the firms can invest in a large risk management compliance infrastructure to meet those regulations. I think if the big banks go in, they're going to have to learn the custody piece of it. But they've got a lot of distributed network. They've got retail customers they can market to. So it'll be interesting. I think they've sat on the sidelines, whether that's the institutional money or to jump in. I think they're learning. They're starting with their own permission and closed networks. But I could see them getting in as this becomes more mainstream as another revenue stream and asset class for them to support.
Great. Well, look, thank you very much to the panelists for their time and the discussion. We covered a lot of different topics. Thank you very much to the audience for your great questions and your attention.
You as well.
Hope you don't mind my crack about the Coinbase.
Oh, not at all.
No, thank you.
Good to see you. How are you? I'm good. And you? Good. Actually, just did one with Jonathan. Hey, good to see you. Good.
Okay. David, how are you here? Okay, that was a great panel. Thank you again, Sandra. Okay, David True, are you up? Yep. Okay.
Hey guys. So we're ready to rock and roll?
Yeah, sure.
Where's
Well,
Yossi?
we're missing Sunil is yet here.
Sunil's here?
Good to be.
Good to see you.
And Yossi is yet here. So
Is Yossi here?
hey Sunil, so you
Oh, there you are. Hey man, good to see you. Real quick. Is Yossi Hassan in the room? Yossi? Ah, great. You're good, sorry. Okay. Great, ladies and gentlemen, if you could settle down, we're going to start the next session. We're running a few minutes late. And for those who've joined on the live stream, welcome. Hope you finding it as interesting as we are. Okay, I'm going to call up David True. Oh, there's David behind me, hiding. Okay, David. David is an old friend of the DFS Observatory and a moderator of many of our panels, and he's well known to many of you. He's got many roles, but I'm going to introduce him as head of NIPE in New York. So, David, you're going to introduce the Innovators and Incubators panel. Over to you.
I shall. Well, hi guys. I'm the guy who doesn't need a microphone, but I've got one anyway. Are we going? Okay, good. I got a sign here. We've been asked. We've got a lot to cover. We've got a big panel. Where one person is yet to come, but he'll be here in a moment. So we will be fairly brief in doing the introductions of ourselves, and then we'll jump right into it. I'll wait for Bruce to get back here. He's come. Yeah, no, he'll be back in a second. So one thing I would say is that, look at the name of the panel right here. It's Innovators and Incubators, the State of Fintech Innovation. So rather than, it's more talking about where the landscape is and where is it going and why do people get into that. So that's sort of where we're going to kick this off. And one thing, and I'm waiting for Bruce to get back. I'll give Bruce a moment to, here's Bruce coming back right now. So, first of all, when I run a discussion, I like to have questions whenever they come up. So if you have a question, we can go to it, because that makes for a more interactive conversation. And second, if you use an acronym that you don't explain, unless it's a really obvious acronym, then I will ping you and ask you to explain that acronym, because there's nothing worse than getting lost in a conversation where you get the articles and the verbs but not the nouns. So that's a problem. So, with that said, we have a wonderful panel. We got 5 folks to talk, so not a lot of time. We've got Yossi Hassan, is it Hassan or Hassan? Hassan, the managing director of Techstars Blockchain Accelerator. We've got Sunil. Well, actually, if we're going in that direction, we got Bruce Lincoln, the co-founder of Silicon Harlem. We've got Sunil Madhu, the CEO and founder of Instant, as other companies as well. We got Sam. We got Samantha Reddy of Moneyline, and I was glad to have her on the panel because I knew about Moneyline, but not much. So this drove me to find out more about Moneyline. And we've got Kimberly Quinones. Did I get it right? Sure. Okay. The executive director of the New York Blockchain Center. So we're thinking about that environment and that ecosystem. And who have you heard about the Visa acquisition of Plaid the other day? Yeah, so I think there's someone from Plaid here who's probably pretty happy right now. So that's an example of where somebody started innovation and had a particularly good exit. So there are reasons for starting, and then there are places that you want to get to. And given that we have folks in all different parts of that ecosystem, where the ideas come from, the incubation going up the stream, why don't we just walk down and each of us talk a bit about what has driven us, what has led us to go and do what we're doing today, and kind of where we see that headed to, where the ultimate direction is. So Yossi, you want to, it's pretty open-ended, so you can sort of talk about what you're doing and we'll go from there.
Sure. So hello everyone. I'm the managing director of the Techstars Blockchain Accelerator, but prior to that, for my sins, I did the Fintech Accelerator, and prior to that was building startups in Africa. And to answer your question in terms of where I see the progression or why we do what we do at Techstars and work with early stage startups to help them build their innovations, is I'm a firm believer in how technology can democratize access and really change the way we are able to transact and interact with the world. And one area where the most impact needs to be made is in financial services. And I think the combination of what I'm passionate about, which we can talk more about, of blockchain and fintech, is able to do that in a true way on a mass scale in a way that wasn't possible before. So what we do at Techstars is work with early stage companies that have great ideas but may not know how to actually go about doing that. One of the co-founders of Plaid was actually an associate in one of our programs. And what we get inspired by is seeing companies go from inspiration to IPO, and helping them along that journey. So happy to talk about how we do that and the kind of companies we see in this space.
So Bruce, you're at a different point in the whole flow, so why don't you talk about what you're doing?
Okay. So good morning, it's great to be here. My name is Bruce Lincoln. I'm the co-founder of Silicon Harlem, and I'm as well a senior fellow at CITI, where I focus on the next generation internet. And if you just look out behind you in the window looking east, that's Harlem. So that's the catchment area where we've been working since 2014 to basically grow it as the next hub for tech and innovation. And that's important to us because it's similar to, as Chris said, it's like a developing country. But more so, like what Linda said, we understand that the community, like a consumer, needs to be at the center of innovation. So that's what we've been very focused on doing. And at this particular point in time, we've developed Harlem, where it's the community as a platform for where we're basically working on the next generation internet. And then that can drive fintech innovations. It can drive AI and machine learning innovations. It can drive extended reality innovations. So that's where we are right now in our development as an innovation and tech company.
So what you're working to do there is to put an infrastructure in place that will allow more innovation on top of it?
Not simply the material infrastructure, but also a humanistic infrastructure where people are engaged and able to take advantage of what technology promises.
Okay. Sunil, I know you've gone through a few companies and you got a new one now, so please.
Sure. My name is Sunil Madhu. I'm a serial entrepreneur. My most recent company was Socure. grew that all the way through Series C. It's a couple of years away from IPOing, and I decided to start a new company called Instant. With Instant, I'm looking to disrupt financial services customer onboarding, which continues to be a problem. Businesses, as it turns out, are rejecting up to 40% of good people, young people, millennials and others, trying to simply open up an account. And at Instant, we aim to solve that problem by outsourcing customer onboarding from businesses so we can manage it as a infrastructure service offering for the enterprises in financial services, e-commerce, healthcare, and other verticals.
So it would be, this is far beyond just doing credential checking. This is onboarding in general in a broader
That's
way.
right. We're going to, what I've realized is that different businesses are spending a lot of money, wasting a lot of money actually, trying to cobble together their own technology stacks and waterfalls to onboard customers, and it's inconsistent. It leads to fraud. It leads to lots of false positives. Having built the most accurate AI for verifying people online, I realized that...
That's secure.
That's secure. I realized that there's an opportunity to arbitrage this market. So with Instant, we are offering to buy out up to $100 million of fraud losses from the businesses by simply transferring the customer onboarding process wholesale to us. We'll guarantee that businesses' top line will grow by double. So we'll give a contractual guarantee to any business that signs with us that will reduce your top line decline rate by more than 50%, and we'll absorb 100% of your fraud losses up to $100 million.
Would this include something like, in a business that I know very well would be credit card onboarding? Would it include something like that?
Yes, credit card onboarding, lending, bank account opening, e-commerce account opening, really any scenario where you need to onboard a customer. And let's face it, all businesses need to grow top line to perpetuity by signing up new customers.
Absolutely,
So
absolutely.
We're going to solve that problem.
So, Samantha.
Yes. So hi, I'm Samantha Rohde. I'm the COO of MoneyLion. MoneyLion is a consumer digital finance platform that is focused on offering banking, lending, and investing services to about a target market of about 100 million Americans who are underserved by traditional banks. And by that I mean we're really looking to address some staggering realities, such as 78% of American workers who are living paycheck to paycheck, 7 out of 10 Americans do not have $1,000 in savings, and 70% of Americans who have a banking relationship are unable to borrow money from their bank. So with our products and services, we are providing low-cost access to banking services, we are providing that access to credit, and we are offering them savings and investment products that allow them to get started building that financial cushion and thinking about their financial future.
Yeah, I was very pleased. I talked to one of your colleagues yesterday, and it filled in a little bit. So you're not exactly like one of the neobanks. You're sort of a broader set of services than a lot of these neobanks offer?
That's right. So, there's a lot of so-called challenger banks out there. You've heard many of the names, and they are really focused primarily on the banking services, so the deposit checking accounts. So we have that, but we bundle that up with the access to credit and the savings and investment accounts. So
now,
really focus on more the holistic financial wellness.
Now, have you been with MoneyLion for a while?
I have been with them for several years. I was on the board for 3 years and just joined as COO a few months ago.
So what was the founding idea? Was it looking and saying, okay, there's underserved and we think we can provide better financial services to them? Do you know the origin story?
Yeah, that is the origin. I mean, it was, we were 6 years old, stood up initially as a lending product, and then have built a whole ecosystem around it to include the banking and the savings and investment products as well.
And you're pretty far down the road. You just did Series C?
We did, mid last year.
What are you thinking, or do you not want to talk about what you're thinking and where you're seeing going with this? Because, I mean, we see some IPOs, but clearly IPOs has less, if anyone is as old as me, you remember the dot-com bubble. You don't have to be even as old as me to remember that. And you saw a lot of IPOs go south. There have been fewer of them recently, and there's been a few that have done less well than hoped. Or gotten close to IPO and pulled back. So how do you guys think about where you take it after Series C?
I mean, I feel like, this is the stage of the company's evolution where, you're now focused on, profitable revenue growth. You're focused on scalable unit economics. And that is really the phase of growth that we're in.
The kind of things Uber's looking for, excuse me.
Yeah.
Which is why they're launched financial services, because they're trying to figure out something they can make money with.
Yeah.
So.
I mean, at Series C, investors are really looking for all of those things. They're looking for the path to profitability. They're, making sure that there's a management team has experienced operators there that can actually scale the business successfully. So it's a different dynamic. And I think that's even all the more, there's more focus on that now with some of the examples that you've given of companies that have been able to scale revenue, but they haven't been able to scale revenue growth profitably.
Yeah, that's all in the press these days. So, and then Kimberly.
Yes. Hi, I'm Kim Quinones. I'm with the Global Blockchain Business Council, and we're the operators for the New York City Blockchain Center, which is not an incubator, not an accelerator, but a place where startups and enterprises that are well established in the blockchain area and everyday New Yorkers all converged to learn about blockchain. And what really got me involved in all this is jobs, 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 the creation of jobs in blockchain in the United States, in New York City, helping New York City keep its role as a leader in financial services, and making sure GBBC really focuses on this, having valid, scalable applications of blockchain and doing it within a clear regulatory environment.
So how would what you do compare to what Yossi's working on at Techstars?
Well, do you invest in companies also?
Yeah, so we invest in startups. We go from an application pool of about 1,000 companies, and we choose 10, and we work with those 10 companies for 13 weeks in a mentorship-driven accelerator program. We invest up to $120,000 into each one of those companies. We do take equity or tokens, depending on what the company is building, and then work with them from then to hopefully what you're talking about, either an IPO or some kind of exit, or if the company is able to fund itself into perpetuity, we're also quite happy with that.
And we're about helping people make the connections and understand what the regulations are that they're going to be operating under. There are actually true incubators and accelerators that do that also. The New York City Partnership, both in finance and in the new transportation group. Really there, it's about helping people connect with the end user and work through that onboarding process in a safe, cooperative environment. Absent the investment side of it, it's really to help refine the product and get over the hurdles to the application of the product. So money investment is important, but helping startups develop the product, not just from a neat idea, but to an idea that really works. And we're talking about the financial services sector. And when you're talking about that, these are systemically important things that you're dealing with. And it takes time to get it right. And startups don't always have the money to give them the time to get it right.
So how are you guys funded? Are you funded by the city, or get government funding or private funding?
It was a mix.
It was a mix. It's a mix. Okay.
Yeah.
Now, so how clear are people on the distinction between incubator and accelerator? Are we pretty good, or could we do with a moment on that? Do in a moment. So, because I've had trouble figuring that all out. So why don't one of you or two of you sort of talk about that? Because through that process from the initial idea, I want blockchain as a way to help the underserved or people who are not adequately served by financial services or whatever, then the steps you go through. So somebody take a whack at explaining what each of those is and what's the distinction.
I'm going to give it to you guys.
Sure. So I think traditionally what you'd expect from an incubator is a place where you are given some resources, maybe some office space, maybe some legal advice, some shared services that can be done to the startup where it's still very much at the idea stage, where you're incubating this idea to try and see how can we give this enough resources to take it from an idea to something more tangible, and bring in enough of what we can and to nurture this idea so that it has some chance of success. Where an accelerator would come in is to say, well, this idea is a little bit further along than that. There is a real potential for product market fit here. What we need to bring to this founding team or this startup is significantly more resources, so either in the form of capital or expertise or relationships with people in the industry as potential clients, and do that in a fashion where we're doing it in a compressed space of time. So typically we're looking at 13 weeks or 3 months. And on top of that, bring in a curriculum that we know works in terms of how to build a startup. So it's a much more curated process than what I know of an incubator, but take it from incubation stage is probably the first stage, and then from there you would graduate into an accelerator program, and from there into the real world and be building your startup without all of these kind of support services around it.
From Silicon Harlem's perspective, we're a hybrid, so we're part accelerator, we're part incubator, but also because we focus on an underserved community, we also have to make sure we provide very real committed resources to get people from where they happen to be at this current point in time to where they can then move forward and take advantage of the innovation economy. So we have everything from contracts with the Department of Education and the Department of Information Technology and Telecommunications to where what we do is provide services to the local community. We also have large-scale initiatives with university consortia where that's where we connect more with those companies that have an idea that would be able to take advantage of the next generation internet. And then sort of in between there, we have small startups that use our innovation space called Uptown Space, where they come and they basically just need a space to be around other bright individuals, and some of that turns into inadvertent innovation that can then tie into some of the initiatives and trends that we see happening in the city. And then we have a broad-based set of educational programs which happen on sort of a bi-monthly basis where they're open to the community. And then a key area of focus is blockchain, cybersecurity, and what we're working on in the next generation internet. So we function like that as a hybrid.
So did MoneyLion or any of your companies ever go through these processes, an incubator or an accelerator process?
Did not.
So there's other ways to get at it.
Sure. I mean, there's the traditional, angel investors to venture capital, straight that route.
So we've seen a lot of that over the last few years, incubators and accelerators, and some of them privately done, some of them put together by universities or whatever. Comments about that? Are they generally? I shouldn't say they've generally been helpful because you're doing that. Presumably it is helpful. But what are your thoughts about that as a way of encouraging these things to happen versus kind of putting it together oneself?
I think the growth has been spurred on by the fact that large businesses don't know how to work with startups. Large businesses, do business with other large businesses. $1 billion bank knows how to do business with another $1 billion bank, but it doesn't know how to do business with a seed stage startup or a Series A startup. And so I think the reason why we've seen the growth of accelerators and so on is to sort of help the businesses meet in the middle with the startups, because the people who operate the accelerators kind of understand how to navigate the large enterprise and how to help the startup that doesn't know how to do that bridge the gap. So they act as a glue, if you will.
It's almost like Google Translate. How do I speak their language?
Kind of, yeah. And
except it probably doesn't keep your data.
Yeah, exactly. If obviously, I'm a serial entrepreneur. I've sold to financial institutions many times over the last 20 years. So, I haven't had the need to go use an accelerator or an incubator. But, if you're a first-time entrepreneur and you're selling into a very tough market, financial services is not the fastest market, easiest market to sell to. You've got to hate yourself just slightly less than wanting to go into healthcare to go attack the financial services market. So, I think that accelerators do a good job to bridge the gap.
So that brings me over to MoneyLion then, because you, 6 years old, 7 years old?
6, yeah.
6 years old. And obviously delved right into that financial services space, likely seen as taking share away. Did you see yourselves as taking share away from other providers or offering something to folks who did not have an option?
In our case, it's mostly taking share from other providers. I mean, of the $14 trillion in assets sitting at banks, almost 50% are sitting at the top 5 banks.
So what have been the interactions you've had navigating that, which Suna was talking about, if you're in early stage, how do you navigate with that? You're right in the midst of that. Marketing messages, things you have, I'm sure you have alliances. You must have a bank behind you somewhere to provide the banking licenses.
Sure, we work with a bank, an OCC chartered bank, and we basically just build the product and service layers on top of that. We work with a lot of other, fintech companies such as Plaid to create those integration points from, all the banks that our customers would have, existing relationships with. So there is a big ecosystem there.
Was it a challenge at first when you were going in?
Well, I wasn't there at the very beginning,
Yeah.
but as with anything that you're starting from the ground up, of course, and it's you're navigating, a lot of emerging technology and changing technology. You're navigating a lot of regulation.
Yeah.
You're navigating, federal regulation, state regulation, all of those things. So it's a pretty complex business.
Yeah.
So, please.
I think that one of the biggest barriers that a lot of entrepreneurs, first-time entrepreneurs anyways, that sell into financial services don't appreciate that is that if you're not compliant, there is no sale.
Right.
And a lot of entrepreneurs don't understand what that actually means. What is the bar that a financial institution has from a compliance perspective that you have to be able to meet in order to be able to sell to them? And many of them sort of scramble at the last minute without planning ahead of time.
So that raised an interesting question. Does anyone, any questions so far? I just thought I saw a hand. So that raised an interesting question then. This comes down to regulation, which was touched on earlier. It will be talked about later, I'm sure. It talks about government. And we've seen different initiatives over the years. Was the OCC tried to put together their bank charter, which I guess is still out there, but I don't know how far. Did they shut it down already?
Yeah.
They shut it down. I didn't have much luck with it. So to what kind of role or what kind of help or hindrance do you see coming? Road barriers that could be taken away, dealing in this financial services space. What have you dealt with? What would you like to see more of that would help?
Regulations. So America is a different market from Europe, right? We are not forward-leaning in terms of regulation because we feel that over-regulation tends to be an impediment to innovation. In Europe, you see a collaborative effort between regulatory bodies and private sector, and they're forward-leaning in terms of compliance regulation, where they work with private companies to shape regulation and then roll that out, and it's pretty quickly adopted. Here we have the problem also of overlapping jurisdictions. So between the OCC, the Fed, the FINRA, FinCEN, there are like different pieces of the law that, and CFPB, there are different pieces of the law that sort of sit under different purview, and sometimes just figuring out which of the regulatory bodies and which regulations you're going to have to comply with itself is a challenge.
Yeah.
Yeah.
One of the things that we saw a lot of is with the startups where you have people who were coming from a regulated industry, somebody who came from financial services, said, yeah, this is what we have to go through with all these different regulatory bodies are necessary evils, they would look at it as. And they're familiar with it. I came from Wall Street. I was there for 30 years. I was at a commercial bank, a retail securities firm, all these different entities, and we had 4 or 5 different rooms full of regulators. But then you get technologists who are startups too, and they've got a great idea. And they don't understand this array of regulation that exists for potentially them, for their own operations, and certainly for the people that they want to sell their technologies to. And that is time consuming. It's getting better. And we heard Linda Lacewell this morning say, I hear you, but there's got to be a lot more of that.
It would help if the regulators would create sandboxes. CFPB is trying to do something to that effect right now. I've been in one of them already.
Are we all familiar with the sandbox concept? If you might speak.
In essence, it's like, vehicle registration, right? So you get a car, you've got to register it, you've got to have registration for it in order to take it on the road to say that it's safe. By giving a vehicle registration, the registration authority is not saying Toyota is better than Mercedes-Benz. They're just saying both are road safe. So it's the same concept where you get the regulators to sit together with, say, an innovative new startup that's going to disrupt the shit out of the industry. And the regulator works with a startup to help them navigate the mirth of the regulatory environment. And then they provide a certification, a letter, or something that says, you know, this startup has gone through these processes and we can certify that they fit within the bounds of regulation. And you know, getting that piece of paper is great, because when we sell into financial institutions, the compliance team, the chief compliance officer, etc., they're not people that like to stick their neck out. They don't want to rock the boat. You know, anything that has to do with the internet is still mind-blowing to them. So, you know, they kind of move very slowly.
It's just a bunch of tubes, remember Senator Ted Stevens?
Yeah, that's right. So, you know, so in the US, the way standards work is the de facto standard process, right? So you duke it out in the market, convince a bunch of companies to acquire, and, you know, 4 or 5 years down the line, after you've got 30 to 40% of the market to adopt whatever the hell you're using, that becomes a de facto standard. And you can look at, you know, KYC tools as an example. There is no certification path for a vendor to say that they're a KYC vendor. You just have to go and get companies to adopt. And it's a very inefficient, painful process, to be honest.
And Dave, I want to build on what Sunil's saying, because just yesterday I was in a conversation with one of the startups we work with, and they're a blockchain startup that's built some really, really impressive technology. They're just here in New York City. And what they've built is truly game-changing for blockchain, and I don't have to go into the technical details.
My head would explode.
But what they're worried about and what they've been checking in on is if they release their tech and for various reasons they need to do an ICO for the technology to work, they're looking at about $2 million in legal costs to ensure that they're not a security. And that's 2 million with an M for a startup that wants to do something extremely innovative in this country. Now they're talking about moving their entire team to Switzerland. Now that's a massive net loss for the US, for the industry, for the technology, and it's why we're not seeing real innovation, in my words, specifically in the blockchain space, coming out of the US, because the fear is either I have to spend $2 million or I might go to jail. And to make that trade, an entrepreneur is going to say, well, that's just not worth it. Let me rather focus on something else. So the regulation in the country, I think, or the approach that's being taken is, one, very slow, and two, I think, is behind in other countries. And the SEC commissioner came out yesterday saying he wants to create a 3-year safe harbor where these kind of networks can launch and have 3 years to become decentralized enough to not be considered a security. And I'm a big fan of that. But what I think is that it's too slow, and maybe we won't even be able to catch up where other places are already starting to build out their competitive advantage in these types of innovations.
But I am going to say one thing. You have to make that impediment known, because trust me, no governor, no mayor wants to hear that regulations are driving someone, that jobs are going to be created elsewhere when you really wanted to create them here. So part of the community, while you're afraid to raise your hand because you don't want to become a target, you're not going to change things unless you make the specific problems known.
Have you seen examples of that where someone started making it known? And now in the US we have that, as someone mentioned earlier, that patchwork where every state, for example, say one, have a money transmitter license requirement and things of that nature. Have you seen examples where by making it known, people have reacted and said, I want to make it easier for businesses to start up here that have been effective?
And we've seen Mark Zuckerberg make it known, and I don't think it went so well.
Yeah, what do you mean, Libra? Yeah. Well, there's a reputational issue there too. So, anybody else? Because you bring up companies moving to other places. Are there other places that are more friendly to startups that you would think of in the fintech space?
To respond to that in another way, just this week, Congress looked at the Digital Equity Act because they see the fact that the digital divide is an impediment to everyone being involved in the digital economy, and thus that also impedes innovation. So, I mean, this is starting to bubble up to where people are thinking about it, but it still hasn't, I think, crystallized in terms of how important it is to some of the key public officials who could make some of these things happen.
Tell me what the Digital Equity Act is. Or tell us.
The Digital Equity Act is designed to accelerate access to the internet, especially broadband internet connectivity for historically underserved communities. So it's looking at how you can address this. I think there's also a large $500 million rural broadband fund that's being initiated. So they're increasingly seeing that not having access to the internet not simply means that you can't access, commonplace services, but that there's talent that's not being tied into the innovation economy.
So that brings up the question I brought up earlier. Well, are there other areas that would be more amenable? And the codicil to that, or the side question to that is then why start up where you started up? Why did you start your company there if there are other places that are better? So are there other places that would be more amenable, and what are the attractions of where you did your startup?
Well, in areas like blockchain, I think blockchain is a unique thing. It's very disruptive as technology. The currency aspect of it spooks a lot of regulators, obviously. So that is unique, and countries like Switzerland, for example, have become staging area, if you will, forward-thinking. Singapore is another one. But the fact remains that most of the investment for entrepreneurs, capital, comes from America. Europe doesn't have it. Asia Pacific is slowly starting to get it. But this is the place. That's the reason why I moved to this country, to innovate here, because it was access to capital is the one thing that is freely available, especially if you're in New York or California. And that's something that it's one of the basic things that every startup needs. It needs capital to grow. And obviously, if your startup's working in a regulated industry like financial services or healthcare, well, it is what it is today, and you've got to kind of work through the patchwork that we have in this country. And I think that might change over time. I don't see it change that quickly, but there's this trade-off. Do I go to Switzerland and start a company and then struggle to get financing for it? If it's a blockchain company, I'll probably be able to get money there faster, who knows. But for some other business that has nothing to do with blockchain, is America the best place, or Europe, or where else? Right?
I think we saw for the first time in 2017 that the notion of the US as the stronghold of capital was quickly disrupted, that hit a brick wall. But it showed that there is a massive appetite to fund these types of innovations globally, and if there's a mechanism to be able to get access to those innovations, there is an audience who wants to invest in them. So while the US is 100% the leader in terms of funding startups, if we're betting on the future and we're looking at, well, what does the world look like 10 to 20 years' time, that legacy is going to be just that, a legacy. And you're going to see nodes that are building that are much, much stronger, much more innovative, and where the talent is ready to be working on it in a way that the US used to be 20 to 30 years ago. I don't know if Steve Jobs and Bill Gates today would have been able to build the Microsoft and the Apple of today with the regulatory environment that exists today in order to be able to be successful in what they do. And this is coming from a person who's coming to the US where I, like you, thought, let me come here to build my next startup and build my next innovation and be investing in these startups. And what I'm seeing on the ground is the challenge to do that is much, much greater than I ever anticipated and expected for an environment that is supposed to be a regulatory-friendly environment to startups.
Just move away from blockchain, you'll be fine.
Yeah. Well, that was going to be one of the observations I made, is that there is a regulatory regimen here. It's known, it may be complicated, but when you move into blockchain, there isn't yet, because nobody has figured out what to do with it.
Everybody has little to do with it and nobody owns it.
Yeah. Whereas here, at least we have, even though there may be 5 or 6 owners, at least there are 5 or 6 owners for the different regulators I'm talking about. So thinking about fintech now, it's been, I don't know when the word was first used, probably 6 or 7 years ago, 10 years ago, 15 years ago. Where do you see it going over the next 2 to 3 years? Is there still lots and lots of run room? And tell me how you guys see it.
I've been in financial services technology now for nearly 20 years in this country. And well before the term existed. Fintech is not a vertical, it's a horizontal.
Right.
So, it's not going to go away. Like payments, for example, you can think of Uber as the, logistics company that transports people, or as a payment company because they've got a gazillion credit cards and a payment stream, right? So I think that aspect of fintech permeating various different industries and driving different industries is the reason why fintech is not going to disappear. It's a crucial piece of the infrastructure across industries.
How about him serving the underserved like you guys are trying to do? Where do you see that? There had been typically a problem seen in making that profitable. How do you guys address that?
We're addressing it through the bundling of the products, not just focusing on one, the one banking product, but actually having a larger relationship with the customer. That's how we're resolving that.
So multiple touch points to get through it. Now, when it comes to the blockchain initiatives around here, what are some of the more fruitful ones? I know we're early stages. You hear the term first inning. I think if it's a 20-inning game, that might be more accurate even. But what are some of the more fruitful ideas that you see or problems to solve? We've got an idea of some of the problems that Sunil has solved. We've got an idea that some of the problem that Samantha and Moneyline has solved. What are some of the more fruitful uses that you see in this very early stage of the blockchain world?
So I can give an example. I think it was to an answer to a question on a guy from IBM on why we need a blockchain solution or a currency when we've got the ability to pay Uber on our phone. It's a startup called Paperchain, and what they do is the founders themselves came from the music industry and were very frustrated that any one of us today can choose a myriad of different music streaming apps and at the touch of a button listen to any song in the world at any time. But the artist who created that probably wait about between 120 and 180 days to be paid for the consumption of that data, even though everyone in the chain knows at that point in time when I push play on my phone that that song is being listened to. So they wanted to disrupt the industry and how to make that payment happen. And they've done their first pilot. They did it on the top of the MakerDAO protocol and stablecoin. They integrated with Spotify and a number of other data sources. And in real time, without them doing anything, from the time they listened to a song, they were able to bring down that transaction to paying the artist in 10 seconds. Truly removing any of the intermediaries in that change and putting that just onto a smart contract that says when the song is listened to on this platform, pay that artist immediately. That's an example. It's only at pilot stage and it's only now starting to get other relationships. But think about the ability to take any transactional data, any type of service that's been sold and immediately make that payment in real time. That's what you're able to do with these types of payment networks that can be digitally programmed, that don't need intermediaries in between the transaction, and how you can now speed up commerce around the world with this type of solution. So that for me is an extremely, extremely exciting startup. They are based here in New York, as much as I have been critical of the US, and they're doing great things.
Anything that you've seen on your end? Kim?
Well, applications that aren't based on payments.
No, it doesn't have to be payments. I mean,
well, that's
you
what
can
I'm
do so many
saying,
things with it.
and that's it. Those are the
You
ones
can tell
that
my
are
skepticism
easier.
from my earlier question about payments.
Well, you're not dealing with all the things that come to play when you're dealing with money, but when you're just dealing with identity, confirming credentials, titles for land, confirming what your provenance. Exactly. These are all things that can be developed, and the challenge there is not dealing with the regulation of 4 different financial services regulators. It's getting a big enough group of participants together to agree to the rules under which they then are sharing all the information. So it's got a different set of challenges, but there are things that you can do that already have a group of people who are used to playing together. Let's say EasyPass, the consortium all along the Northeast corridor that it's toll interoperability. You've already got a group of players that are together, that know that they're in it together and they benefit from it. You can layer blockchain on top of something like that for different services and apply that much more quickly than you can in some other areas.
Do you want another example?
Sure, another example would be great. And then we'll take some questions.
I think there's another company called Arweave. They're based in the UK. They've also got an office here. I think what we see with technology over time is there is the initial spurt of innovation where if we think of PCs first went into everyone's homes, and we were building mainframe computers in our environments to be able to get access to these networks. And then there was this kind of consolidation where we now went to the cloud, and now all these service providers are centralized. And the promise of decentralization was to kind of break that, because with economies of scale, you now get these centralized providers who are in control, and we have the Apples and Googles and Amazons of the world that we have today. And for the first time, what Arweave have managed to do is give the economic benefit of a decentralized network where you're able to provide a solution at a lower economic cost than what you can do by centralizing. And that's a very powerful thing to know when you're trying to build a network that is able to do things at a tenth of the cost of what the incumbents can do today. And it's been the biggest challenge, one of the biggest challenges that blockchain has had on why it can't achieve scale. And they've done that for storage. So now they're able to offer, at a tenth of the cost of the storage solutions that are available today, a permanent storage solution where anything that you write to this network will be stored forever. And how they got that idea was when the fake news, even the term fake news came about, and we didn't know what was a real fact. You could no longer verify that what you are reading is actually the truth. And they wanted to create a mechanism that when you go back in history, you can say, well, where did that come from? What piece of news
That would be
led to
amazing.
that?
Well, that's
and
a
how can you
double-edged
make
sword
it?
to that.
Yeah.
There's a double-edged sword to that. So the blockchain contains child porn.
Yeah,
right now.
exactly right. And
Right,
it's
so,
immutable.
you know, there's two sides to these technologies, and they're not panaceas. You know, I'm by profession a security architect. I can tell you that if you told me that I had to store a bunch of secure information, my first thought wouldn't be to throw that information on a network.
But you would want the government that is sending out any news to store that on a thing that cannot be changed.
Well, there, like I said, there are pros and cons. The technology is still maturing, but it's not a panacea.
We're going to need to wrap this in a moment. Are there any questions? We got time for questions? Yeah, questions. Okay, good. You always save them at the end, please. Bring a microphone up front here. We've got a woman in red there and a woman in a darker jacket over there.
Hi, I'm Catherine Hires. I write for the Global Association of Risk Professionals. I've read that in the fintech arena, the use some startups are employing behavioral economics or psychology economics to enhance their services in some way. So, are any of the startups we've been talking about that you know about employing this tool? And if not, you know, who are leaders in employing behavioral economics to enhance financial services?
So, for example, Lemonade comes to mind. They're insurance company that gives micro-insurance to young people who rent apartments and so on. They basically, you know, part of their business in reducing losses is to use human behavior and psychology and things like guilt, you know, to prevent people from defrauding the system. You know, there's been a lot of hype about how it works. And I can say that there is a bit of hype. It doesn't always work out the way you think.
I think the worldwide leader in this is a firm called Discovery Health. They're a South African medical insurance provider, and they have drastically redefined the ways that people interact with their medical insurance provider by making them healthier, and have one of the most profitable businesses because of it, and used complete behavior economics on how to drive the behavior of their members so that they themselves become healthier and therefore claim less.
That's awesome.
And they're now in, I don't know, about 23 different countries.
Prevention's better than cure, right? So
it is indeed. Woman in the red jacket.
So the woman in red is Liat Shatret. Good morning with Elliptic. Thank you very much for your presentations. So my question is around the concept of banking the unbanked, which we've all spent kind of numerous years discussing, reflecting on how do we bring the entire debanked population into the formal systems. IMF, World Bank, we've seen the conversations. This panel is great for me because you're actually actively looking to unbank the banked in a way, so reverse that, flip that. And I guess as we look towards the associated concepts that come with debanking the banked, financial literacy comes to mind, serving our specific communities, wherever they might be, whether here in Harlem or otherwise in different sectors, you know, the microfinance, the women, the youth. How could we stretch the concept of financial literacy and better give more punch to that concept, which seems to have stagnated to reading a bank statement and then you're financially literate? I mean, how do we grow that? And what kind of experiences maybe you can share with your specific communities to just stretch that further? Thank you.
With the new fintechs, digital wallets and so on, I always felt like If you could put PFM, or personal finance management tools, and use machine learning and so on, for people, for lack of people getting educated about how to spend money wisely and save and so on, I think there's a lot of things you can do by incorporating PFM tools more across the spectrum to help educate people as they spend money. Mint.com did a great job back in the day. I'd like to see more of that incorporated into a lot of these new fintech applications. So
I see you nodding your head.
Yeah, Moneyline's trying to do that by incorporating PFM tools into our app. We're developing what we call the financial heartbeat, which basically takes all of the information that we have around your spending habits, your debt, your credit score, all these various aspects, and basically producing a proprietary score, which is your heartbeat. And then based on that, we can offer you tips and tools on things that you can do to improve your score over time. And it uses machine learning and all the data that we've collected. So I think it's something that we will, and it ties into the behavioral economics question as well, right? If you can really trigger actions off of that information. So that's something that obviously we'll continue to define, refine, and make more robust. But I think it's in the vein of what you were talking about.
Now we've got time for one last question, and we'll have to wrap it. So, please.
Thank you. Thank you to all the panelists also. My name is Cornelia Caldevay. I'm with the United Nations. I have two questions, actually. And one, I think, ties into the financial literacy question that we had. When we talk about financial inclusion and when we talk about serving the underserved and improving their access to different types of financial services, I wonder how you make sure to avoid pitfalls of over-indebtedness and other issues that hurt these people that you earlier said basically live hand to mouth. And I think the basic problem of many people is not having access to financial instruments, but not having enough money to live on. And we've seen that in a number of emerging economies, and also Kenya, famous example of M-Pesa and so forth. We've had issues there with over-indebtedness, and people go and there's a very aggressive marketing of small loans, and people take out small loans from a number of different providers. And so what do you do, possibly beyond financial literacy, to protect your potential customers from these pitfalls? That's question number one.
Ooh, one question.
Question number two is for the whole panel on, and I'm not really expecting an answer, so I'll be quick, energy consumption. Because we've been talking a lot about Bitcoin issues and when we have the proof of work and how energy intensive that is. Obviously, there's other ways, there's proof of stake and so forth. If you all look at innovations, innovators and so forth, do you look at the environmental implications at all? Sorry about my
Let's take the second. Let's go to the first question, because the first question is a good one to answer about inclusion. We're going to have other panels that talk about blockchain and things like that with heavy energy consumption, so we can address that then. Okay?
So, cash is king everywhere in the world. Credit only exists in 14 countries. In Japan, Australia, and Germany, where credit systems exist, people underuse credit because in a lot of countries, credit is synonymous to debt. It's nice that we push credit cards and credit, but if you call it debt, cards, and debt, less people would use it. Young people everywhere are the same. They want to spend more than they earn. So there's demand for credit. And so in emerging markets, for lack of these credit bureau infrastructure, we're starting to see the rise of alternate credit models and microcredit on demand. You go through the shopping cart and Flipkart in India, you buy 500 rupees worth of things, and Flipkart offers you the ability to finance the 500 rupees worth of stuff and pay for it later. Klarna pioneered that in Europe.
So how does one discourage them from becoming indebted?
It has to do with, because on one side you got the businesses that want to write credit and make profit, and on the other side consumers want credit, but then if they run loose with it, they end up in a lot of debt and worse off than they were before. So again, PFM, and I think Moneyline might do a good job there of helping customers understand how to wisely use credit. Credit Karma does a good job here in the US of telling people how to hack credit and how to not overextend yourself and so on. So it's got to be a combination of both. And as an entrepreneur building applications that include microfinance, I think there has to be a side of it that has to tie with ethics, which is you can be unethical and not care about the consequences of credit stacking and lending to people willy-nilly. And at the end of the day, VCs wouldn't have to care because they care about profitability more than anything else. But bringing ethics into it would help, I think.
So we got 20 seconds, so let's go.
All right, in 20 seconds, I think the only way that's going to change is that the notion of the firm and how we make profit changes. And if we have an open system that allows for access, if a person doesn't have choice, they're going to get taken advantage of. And if there's a way for people to be able to provide a service to an individual who has no choice, and now you open that up where multiple people can say, well, I'll be able to help that individual and provide them with an access to credit, where the only motive isn't just profit. And the way we know how to do that right now is a company that has shares that people need to maximize their profitability, where I really believe we're going to see these networks that the foundation of that is not in this type of profit motive. And you can build these types of services where you can have a one-on-one relationship with individuals at scale that completely redefines how that does. What does that look like in 10 years' time? I can't answer in 20 seconds.
So we've got several more panels to get to today. I want to thank all the folks who joined the panel today. Clearly, there's a lot going on in fintech, and there will be for quite a long time in the future. There will be time to mingle and ask these folks questions. I thank you for your time.
Thank you.
Thanks very much, David, and the panel. We're going to break for a short coffee break now. So for those on the live stream, we're going to be breaking, especially you, David, in the UK. Okay, so we'll be back in about 10 minutes for the next session on investors. Thank you. Okay, ladies and gentlemen, we're about to start. And those on the live stream, welcome back. For those who've just arrived, I'm Dr. Leon Perman. I'm the organizer of this event and the head of the Digital Financial Services Observatory at Columbia Business School. Okay, so the next session, in the interest of time and keeping the program on track, we want to start now. I want to introduce Christian Gennaro, who's a member and on the board of directors of NIPE, and she's going to moderate the investors panel. Over to you.
Okay, great.
Just say Monica's on the way.
All righty, thank you for stopping the networking. I know that that's a very important part of these events, and there will be more. So I'm Christiane Gennaro, and happy to be moderating the panel on fintech investors. We will be covering fintech overall, blockchain, cryptocurrency, so recognizing the difference between the two, talking about serving the underserved as well. So I'm going to ask each of my panelists just to, you can read their names, they don't have to state their names, but just to tell us briefly, where are they in the ecosystem? Are they an investor? Are they an entrepreneur? Are they an ecosystem participant or perhaps an ecosystem observer? And to tell us what in the world of fintech investing, whatever their angle is, what's changed over the past 5 years and what do they think is the biggest challenge in the environment? And then we'll get into some more specific questions. We do have a fifth panelist whose flight was delayed, so we may be adding one more and we may not. So Bartek, do you want to go ahead and start and just talk a little bit about what's your role, what are the big changes, and what's the biggest challenge you see right now?
Sure. Hi, my name is Bartek. I'm an investor at Core Innovation Capital. We're an early stage fintech fund. Before that was an operator running a cryptocurrency exchange. So in this space, I think that there's a lot of noise is probably the biggest issue, and it's really hard to figure out what's real and what's just like a fanciful project. And I think a lot of the challenge of investing in that space is figuring out the answer to those two.
Okay, great. Michael?
Hi, Michael Morrow, CEO of Genesis. I run a digital currency trading and lending business here in New York. So I'm coming at this panel and the questions from the entrepreneurial perspective within the confines of a regulated broker-dealer.
Okay, and just tell me very quickly, either anything that's changed or the current biggest challenge, or both.
Oh, gosh.
All right, just one. Pick one.
I think the biggest challenge, for the asset class is still sort of changing mentalities, particularly in the East Coast, as it kind of relates to the cryptocurrency asset class.
Okay, I'm sure we'll talk about that more. Seth?
Hi, I'm Seth Masters, and I'm an angel investor at New York Angels, where I'm also co-chair of the FinTech Committee and a member of the Blockchain Committee, which obviously is very relevant for today. I think the biggest change is that 5 years ago, you were hearing a lot from startups about big ideas. I mean, all you had to say was, crypto, as we heard this morning, or get excited about, big data or all kinds of other catchwords. And by the way, we still have some of that, right? Quantum still out there. Without any really concrete sense of what that actually was going to be if it grew up, and how it would make money. And I think what we're seeing now is across the ecosystem, startups are really focusing on actual use cases and trying to figure out how those use cases will both solve a real problem and ideally make money. That's a big change. However, in terms of the biggest challenge, as an investor in very early stage companies that are, we heard in the last panel about what the incubators and accelerators do. Angels are often at that same stage and are often, as you heard in the last panel, an alternative to or a complement to those very, very early stage assessments of companies. in order to do a good job, you really have to get a funnel that you use to collect as many companies at the top of it as you possibly can survey to understand what's happening. So almost half of my time is spent trying to figure out where to find people who are starting something interesting and getting a look at them. But the challenge is therefore doing a good job of filling the funnel at the top, but also winnowing it down. At New York Angels, we end up investing, and this is true for me too personally, in about 2% of the companies we see. Think about that number. That means that we're also saying no to about 98% of the companies we see. So there's some implications to that, I think. One of the aspects of New York Angels is we try very hard to be a supporter of the ecosystem, to give back, because if you're saying no 98% of the time, you want to do so in a way that's respectful and hopefully actually helpful to the companies, because you have to be conscious of the fact that it's a privilege to be an investor. And so I do want to say to anybody in this room who is an entrepreneur, thank you. It's a really, really tough challenge, and we hope to help you along that way, even if we can't always do it by saying yes to money.
Great. Thank you, Seth. Drew?
Yes, so Drew Propson, I'm with the World Economic Forum. And just to clarify, earlier today, Leon mentioned that this is sold out, of course, and that somebody had emailed him saying that they were the organizer of Davos, and so they should get a ticket coming here. I am not that person, just so you know. So at the fund, we work with, of course, we consider ourselves the platform for public-private cooperation. So I would say we're an ecosystem participant as well as an observer. On the financial services side of things, we have a platform called Future of Financial and Monetary Systems. And we really look at how do you bring multiple stakeholders together to make sure we have an efficient, effective, well-functioning, stable, inclusive financial system, right? And this is not just at the maybe regional level, but more at the global level. So in terms of where this comes into play with investment in fintech, we're always looking at what are the new emerging technologies coming out. How is this going to potentially affect the financial system in the future, and how is it affecting it right now? And what can we do to mitigate any of those risks and really come up with a way that we have a really wonderful, fair, well-functioning financial system that has healthy competition that at the end of the day is good for the end consumer. So in terms of what I've seen that's a little bit different, I think you all sort of stole my thunder a little bit with there's just so much noise out there. Things are really, I don't even want to say it's a mature ecosystem, but there's a lot going on. So I think what's an interesting challenge and what we're kind of seeing now that's maybe a little new is really an attempt to bring some simplicity to all of this noise. We have great ways to capture more data, to utilize this data, but how do we bring this in a way that is really quite simple such that we can use it and it's readily available and it really helps with financial institutions, fintechs, and the like.
Great, thank you. So kind of diving a little bit more on the investor side right now, I'd like to get into a little bit for, what are your kind of rules of thumb for investing and why? You don't have to give any away trade secrets, just kind of what do you look for and why? And Bartek, if you would kind of start that off and then we'll...
Sure, yeah, so I'll narrow that further down to the blockchain space. I mean, my personal view, and I think it's rooted from running an exchange, is I'm looking for pretty much the most boring businesses in crypto. I think the idea of investing in very innovative businesses inside of a very innovative, very nascent industry is just extremely risky. So for me, it ends up just basically being a set of questions like, if you believe that cryptocurrencies will exist in the next 30 years, what must be true for that to happen? And for me, it's things like, well, people will want to be able to exchange them for fiat, so exchanges have to exist, and that's an area of interest. You have to be able to store the cryptocurrency somewhere and not have it get stolen, so there's custody solutions. You need to allow regulators to sleep at night, and so you need to create tools that let them do their jobs. Maybe a couple other smaller themes, but that's basically how I think about this space. So I'm generally looking for businesses that have parallels in the non-crypto space that are obvious implementations, assuming that crypto continues to become larger. And then specifically with this debate of whether it's crypto and not blockchain, blockchain is, I view as a database. It's not like a buzz term. It's literally a database type that has certain applications that run on top of it. the current application of cryptocurrency seems to be the only one that's proven itself to be have product market fit. And the specific reason why people are interested in the short term with cryptocurrencies, or the business models around it, are entirely around speculation. And so like there's this viewpoint of where everybody wants cryptocurrency to go, and I actually totally believe in it over the long term. But I think from an investor standpoint, I'm like hyper practical, and frankly not very innovative in my viewpoint on the types of businesses to invest in. The fortunate thing is those businesses are the ones that are generating revenue, and I think have opportunities to grow quite quickly now.
Okay. Seth, can you tell us from your point of view, kind of what are your rules of thumb and why?
Yeah, so everybody likes to have sort of an acronym or a way to remember things like this. And for me, there are 3 T's that are really the key things I would always want to be focused on early on in assessing a company. The first is the team. By the way, this is not what I expected when I started investing. I thought it was going to be much more of a thematic idea that was going to be important. But having, again, assessed literally thousands and thousands of young companies, the team makes or breaks any company. And the biggest problem, I think, when you're starting out is that you never have a complete team. You're always dealing with having to manage an idea and a set of problems that are greater than what your own human resources can possibly figure out. And so what teams have to have is tremendous amounts of resiliency and energy and focus, and what has to go along with that is some real skills and experience. And how you figure out what you do know and also how to solve for the things you don't know, you need to figure that out. Is it a team that's going to be able to succeed in doing that? The second T, again, one that I would never have guessed before I started doing this, is timing. You know, it's really true in general in the world, but especially in startup land, that being too early or too late is exactly the same as being wrong. My favorite example of how timing can be unbelievably valuable is not a fintech example, but think about Uber. Does anybody know when Uber was founded? No? It was early 2009. Why did that matter? Well, because all of a sudden, there were all these people who had a nice car and no money.
No job.
And they were willing to consider the possibility of driving that car around to get some cash in their pocket. And, there are so many examples of that I can point to. Companies that could have worked if they'd started 5 years later, but they just weren't, their timing wasn't right. And the third T is a bit of a cheat, because it is an acronym itself, is the TAM, or total addressable market, for what the company's trying to do. I think here I totally agree with Bartek. The thing you really want to see is a company that's trying to think about how it can be a real business solving a real problem that's big enough to be worth getting into if you succeed at it, and where there is a reason for potential customers to buy whatever it is you're selling. And so if you're an entrepreneur, I really do think you should focus on those things first and foremost, because without them, in my experience, it's very, very hard to succeed.
Great, thank you. So you have to have good people, you have to have dumb luck. And you have to have a big market.
Timing is not dumb luck.
Okay.
You make your own luck.
Okay, just trying to inject a little humor here. Drew, from your perspective, both I guess as an observer and an ecosystem participant, maybe you can talk about kind of your rules of thumb or the organization's rules of thumb. And it would be great if you could contrast with other markets and maybe kind of developing versus developed. But just kind of give us a sense of.
So maybe to start, I'll just say, let's kind of think of this in 2 buckets. So one, I'll think about investment from an incumbent institution perspective. We do a lot of research here, and we're currently working on a project that is really just looking at AI and it's connecting with other emerging technologies and how this is really affecting financial institutions. And one of the things we're seeing, and we're asking people, where are you placing your bold bets in a technology right now? And we're seeing overwhelmingly that it's AI and cloud. And these things are almost seen as just kind of, those are just givens. The quantum, the IoT, DLT, that is a little bit still, there's some uncertainty there exactly where is the value proposition going to be, or how do we really fully effectively utilize this. So if I were a fintech company and I were really looking at working with banks, I would want to be paying attention to, where they're placing their bets right now in terms of technologies. So I would think of that. The other thing is on we do, for this research as well as our other projects, we do a lot of different global workshops. So I think one of the things that's quite interesting is just to see the different nuances and the differences we see when we go into different regions. And from there, I think if you're looking at more the fintech side of things rather than the incumbent, we're seeing, such emphasis on, it keeps coming up, this consumer-centeredness, right? And there's just such a difference there in terms of what consumers want. So emerging markets, of course, we don't have the legacy systems in place, so it's, perhaps a little bit easier to have adoption in terms of mobile money or, some newer technologies. Of course, M-Pesa is always the example that comes up, and I think something like 2/3 of Kenyans, I could be wrong on that, are using M-Pesa regularly now. So it's pretty astonishing what can happen in a short amount of time. I would say, though, that if you're looking at developed markets, we also know that there are huge inclusion problems in developed markets, and I think there were some statistics brought up earlier. The FDIC study shows that we have around 20% of American households that say that they're underbanked. They don't have the financial services and products that they need to meet their needs. So there's a lot of work that can be done there as well. So really knowing, your end consumer and guiding your business and your products and services through that is really important. In Asia, loyalty programs are huge. You can really do well with a loyalty program. I think in the US that can be the case in certain circumstances, but we can be quite lazy about that sort of thing and not want to switch perhaps. So I think that's that's one of the differences that we really see.
Great, thank you. And Michael, would you talk a little bit specifically, when we were having our prep call, we talked a little bit about investing in cryptocurrencies in particular, both investing, borrowing, lending, et cetera. So maybe you can talk about, because this has been, I think, a big topic throughout, kind of, what are the risks, who do you see investing, how has that changed, et cetera?
So at the time we started Genesis, it was basically a bet on two things. One was that cryptocurrencies as an asset class will exist and that institutions will get involved. That's kind of bet one. Bet two was that the incumbent giant financial services institutions were not going to get involved for some time. And if those two hypotheses played itself out, then there was an opportunity for a relatively small startup to develop products and financial services that exist in other markets, right? Other markets that institutional investors are used to, kind of in the equities and fixed income, commodities, and FX world, and kind of replicate that in the cryptocurrency asset class. So there was a gap in the market for that to ultimately happen. And so when we started trading cryptocurrencies in 2013, that was basically the idea. For us, from the seismic shift on who's involved, what's changed in cryptocurrency, it's almost like shorter to kind of go through what hasn't changed, I guess, about the cryptocurrency asset class. But I think one of the first things that we kind of noticed in 2013 was we were trying to create a buyer and a seller interest in Bitcoin, because that's really all there was at the time. And here we are, a New York-based broker-dealer. And so we have institutional relationships. They're mostly on the East Coast. And so we'd start calling and trying to figure out, hey, can you get interest? And we couldn't get a single phone call returned. We couldn't get a single email returned to us. No one would take meetings with us. And we're like really kind of banging our head against the wall. Our first real sticky guys that gave Bitcoin a shot were the Silicon Valley guys. We're on the West Coast. Simply because I think and this was like Bitcoin being at like $90 or something like that at the time. And the idea that Bitcoin could go to zero still exists today, but it was even more true, right, 7 years ago. But the idea that it could also do 100x, 1000x, that possibility also existed. That risk reward of 100x or zero is the VC portfolio, right? That risk reward mentality is basically what they're investing in kind of in Silicon Valley. And so Bitcoin fit right into their wheelhouse in terms of, so what if it went to zero? They've got other bets. But maybe that's kind of the winner within their portfolio that can actually make their fund a success. And so we found real traction. East Coast guys, they're the S&P 500. They're happy clipping the 7 to 8% a year. Limited volatility, get their dividends, and get that steady stream, right? And so frankly, as it turns out, we were calling the wrong people, right? Like, we just called who we knew, but it wasn't kind of the right investor base as we kind of got our business up and running. And frankly, throughout 13, 14, 15, that narrative didn't change. All of the Bitcoins being accumulated by the VC guys, either in their side pocket fund or individually, or their CEOs of some of the biggest startups that were happening out on the West Coast, not a single East Coast person was getting involved. Over the years, from like half of 16 and certainly in 2017, East Coast guys certainly started getting involved, but personally. So it's the general partners of these hedge funds that were sort of buying stuff for themselves because they had an interest in it, but for whatever reason, and there's a whole myriad of reasons, they were still afraid to kind of put it in their fund. Because when you put that money, fund money into crypto, then obviously you're using third-party funds, right? And so there's obviously due diligence stuff around taxes and legal and accounting and fund, all of the back-end stuff. Regarding, and they still weren't kind of ready to do that, but personally it's their own money, right? So they didn't mind kind of taking a bet on the asset class, kind of starting in middle of 2016. Today, in 2020, obviously we're still not there to the point where a lot of the household largest hedge funds on the East Coast are getting involved. But I would say there's a fair share of kind of the middle market hedge fund guys who are getting an allocation in the asset class, whether that's through kind of the underlying holding Bitcoin themselves and trying to figure out the custody and the storage that Bartek was kind of thinking about, or investing in a fund that has exposure to Bitcoin or whatnot. They're trying to figure out an ultimate strategy. And the fact that now every single bank, every single hedge fund has thought about this. We no longer have that problem of getting our phone calls returned when we try to have meetings with them. But for them, it on the surface, it looks funny because they said no to Bitcoin at $70, and now they're saying yes at 10K. Right. But at the same time, from a risk-reward perspective, I think a lot of the East Coast guys are feeling less and less likely of the zero scenario. And that's good enough for them to start getting involved.
And Michael, we talked a little bit about borrowing and lending. Is that really just as investment strategies, or are you seeing any other kind of application?
So it's funny. So the analog to the borrowing and lending activity is kind of the sec lending model that exists in the equities world, where people borrow stocks effectively to short it and take advantage of price coming down. We started a business kind of around that a couple of years ago now, March of 2018, and that was really kind of the start of the bear market in kind of crypto land, kind of coming off of the late 2017, early 2018. And sure enough, like the first 6 months, a lot of our guys were literally just borrowing every single crypto coin they can to either take advantage of the downward price movement or to hedge a position they had elsewhere. We don't face retail customers. All of our guys are institutional. So you end up with a lot of crypto hedge funds that were getting involved, as well as sort of guys that have other products that were starting to kind of get involved. A lot of the shorting use case doesn't exist today. People typically don't try to short in a bull market, in a momentum area like cryptocurrency. The borrowing and lending that kind of happens right now is primarily kind of twofold. There's still plenty of arbitrage opportunities that exist, not necessarily across exchanges, but now between the spot market and the futures market. So they're arbitraging the derivatives market and the spot market. And if you know how to spot those and kind of trade those, there's plenty of opportunity for money to be made, because I think capital allocation, especially kind of around the derivatives market, is still not very efficient kind of in cryptocurrency today. And secondly, and this is an unexpected kind of development, a lot of the cryptocurrency blockchain-based businesses have their working capital denominated in Bitcoin. It's not in dollars. So they pay a lot of their suppliers in Bitcoin. They try to get off the dollar or the euro. And so they come to Genesis to effectively ask for a commercial loan. Right? It's like, help me grow my business. My working capital is in Bitcoin. I'd love to get Bitcoin to grow my business A, B, or C. And so it's entirely different than folks that are looking to sort of borrow for shorting purposes. But it's an added dimension, I think, to the crypto lending business, is that like people have those kind of commercial building needs, and they obviously can't get a loan in Bitcoin from a bank.
I want to talk a little bit about that kind of tension between, you know, the new in fintech and the established institutions, you know, banks or otherwise. And, you know, I would say it's probably, you know, when this all started, everyone was like, okay, banks, fintechs are going to eat your lunch. And now I think we have the common wisdom, you know, banks have incubators, accelerators, et cetera. We have the common wisdom, well, you know, fintechs can innovate so quickly. So you have to partner because we know banks aren't good at innovation. But kind of going beyond that and digging a little deeper, Seth, I'm going to ask you to address it. And if anyone else wants to jump in, you know, what are the reasons for partnership kind of beyond that, you know, we can innovate faster and you can't?
Right. So first of all, it's really important to remember there are really, exactly as you said, two major models for any startup business. One is to go directly to the consumer and disrupt the incumbents. And by the way, MoneyLion on the last panel is a good example of that in fintech. And then there are the companies that seek to help the incumbents survive that onslaught. And that's the so-called B2B or business-to-business strategy. And I'd say that one of the things we've definitely seen over the last 5 years is, whereas the fintech world used to be about 80% direct-to-consumer, try to disrupt the current incumbent. Now it's pretty much flipped, and it's almost 80% business-to-business type solutions, like Instant, also on the last panel, that are trying to help the incumbent survive. So what you also heard from the last panel, which is very true, is that big institutions, even small existing institutions, don't necessarily know how to work with small companies with new ideas, even if those small companies are trying to help them. So why is there actually a reason to do it nonetheless? Well, there's a huge synergy between a startup with a great idea that can move quickly because it's unencumbered by having any clients today, but it has the problem that it doesn't have any clients today. And it's also unencumbered by not having to worry about having already sold a bunch of existing products or having a pool of capital that's already committed to things that require tending. But it's also got the problem that it doesn't have any capital today. Meanwhile, incumbents are blessed with businesses that generate revenue, but they have to support them. And they've got tons and tons of technology debt, which basically means much of the infrastructure, especially in financial services, is written in a language called COBOL that literally nobody learns how to code in anymore. The average COBOL programmer is now nearing 65 years of age.
So my mom is actually a COBOL programmer. Yeah. She's retired and looking for work.
I'm not going to ask her age, okay? In fact, I'm not. But by the way, she has job security as long as she wants.
Yeah.
But that is, incidentally, if you don't think this is a systemic problem, you are wrong. This is way worse than Y2K in a lot of ways. And so that's one of many use cases where there's a tremendous opportunity if those two sides can meet somehow and work together, because they actually badly need each other. And the reason that now in New York, we've gone from, 5 years ago, literally in New York, there were maybe 2 accelerators that I knew of then. Today, I think there's at least 24. Just think about that. So this is becoming a big thing because all the incumbents understand and are trying to solve the problem on their end. I think the challenge, though, is that for fintech companies, it's not obvious how you plug yourself in. I think you heard that frustration, actually, from Sunil in the last panel. And you need to have a different approach if you're going to try to sell to incumbents who have a long procurement cycle, who have a lot of people in-house that feel threatened by the idea of change, and who also do have to continue serving all of their existing customers even as they make changes. I mean, just think about it. In financial services especially, it's kind of the equivalent of deciding you're going to completely remodel the kitchen in your restaurant while you're serving dinner. And what I think you're finding is the teams that know how to navigate this well increasingly have people as part of the core team who really, really understand the business, who've probably done the business, so they know what the customer needs are, they know what the existing technology can and can't do and how it works. They know how to integrate with it, which is a huge, big problem, especially because you don't want to have to resuscitate a COBOL programmer who's on oxygen to be able to figure out how to plug into the system. And no offense. And look, I think as you think about all those, and on top of that, there's also this minor issue of regulation, which, it was fine once upon a time to talk about moving fast and breaking things, but especially in financial services, that's a non-starter. So culturally, you have to be willing to work within the confines of that kind of world. And I think what you're going to see over the next 5 and 10 years, as there's more and more traction in this interaction between incumbents and startups, is that the successful companies will be the ones that are not only good at whatever technology they're developing and the product they're building, but they're actually good at understanding how to partner well with the incumbents so that they both succeed.
Right. And Drew, how about in markets outside the U.S. and maybe particularly developing markets, is the kind of breakthrough straight to the consumer more of what you see, or is there that need to partner as well with existing institutions?
I would say it depends, which is always the best
Yeah,
answer.
yeah,
Right?
exactly.
But I think both, honestly. I mean, we know that with incumbents that there's still some inefficiencies with the plumbing. So a lot of incumbents do want to be working with fintechs on that if it's not cost effective for them to be doing this in-house. So I think there's definitely a lot of potential there. I would really echo Seth's point on the people component and just your willingness to work together. Leadership is something that we hear from incumbents constantly. It's not that they're skeptical or nervous about the financial or the fintechs, but it's much more of a, we're not exactly sure how we're going to structure our leadership because we know this individual is a fantastic, their background is in banking, but maybe not so strong on the tech piece, but this is a bigger problem than just bringing in your IT specialist. So how do we make sure that we're really working together, and you're not going to have one person that has all the skills that they need. So if you're the fintech, come up with a great feedback loop proposal as you're pitching your product. I think that's a really good way to kind of really reach out to the incumbents and work together. In terms of direct to consumer, that's particularly in areas where we know that there's a lot of unbanked and underbanked, but some resources to put in place to actually get that problem solved, then it's definitely much more direct to consumer, or even working too with G2P or easy bill pay or government to individual payments or vice versa is something that we see frequently as kind of low-hanging fruit.
Right,
Yeah.
right.
I'll just jump in because I think what's really cool about being a fintech investor now is you're basically seeing battles being fought on multiple planes all at the same time. So you have this concept of incumbent versus challenger. Think of Citibank versus Chime, right? And there's one way to frame that sort of fight. And what's happening on that plane is Chime is taking customers who would have otherwise gone to Citibank. Citibank freaks out and then maybe buys a Chime, right? Or they start beefing up their tech team to start becoming more competitive. So if you notice that your Chase or Citibank apps are getting better recently, that's a direct result of the fear of being whoa, where'd these guys come from? And that's really cool to see that responsiveness. And that could be in the form of product innovation as well as in the form of just acquisition later. Then I would call another segment sort of in the similar battlefield is people be like, ooh, how can I make Citibank feel safer and sleep well at night? Maybe I could just sell directly to them to give them the tools to battle against a Chime. And then there's a whole direct B2B component there. And then the cool thing about that for startups is that Citibank has a lot of money to pay for outside help in this battle. But the net outcome for consumers, regardless of who wins, is you're going to get significant innovation in the kind of core banking services that you experience today, regardless of whether you're going to be a Chime customer or stay as a Citibank customer. So there's this kind of battle being waged with people kind of going from one side to the other. While all this is happening, there's a whole nother sort of change in the ecosystem of just the decentralization of banking and finance in the first place. So framing it even as Citibank versus Chime might even be kind of silly in the long-term view, where every app that ever touches your money could be its own bank. And the idea of even thinking of having a bank account with Citibank would just be weird, right? Or Chime would be weird. And so we're seeing a lot of companies now that provide basically the plumbing to allow anything you interact with to hold your money and to move your money. And if you have that, why do you even care about a Chime account? So what's cool, I think, where we are in 2020 as an investor is you have to understand what are the battles being fought and do the outcomes even matter if another battle is actually going to supersede that.
Bartek, maybe I'm going to toss the next one to you to kind of continue, which is, let's kind of shift from helping banks do their business better, maybe not to, can you do good with fintech and still make money? And maybe you could talk a little bit about that, and then we can go down the panel and folks can chime in.
Yeah.
Okay, give us an example or two.
Well, you know, I think there's a backlog of innovation that hasn't happened in financial services. A lot of financial fees are paid by people who don't have access to capital. One of my favorite musicians is a guy named Ben Folds, and he wrote a song about when he was poor, he had to buy stuff, and now that he's rich, he gets like free coffee. And in reality, that's a lot of how financial services works today, where the higher wealth you are, the less that your services cost. And so that's kind of, I think, where the idea of like being poor is very expensive. And that's primarily manifested itself in financial services. So there's a lot of opportunity to reduce the costs of financial services using technology targeting the lower middle income segments. And then more broadly speaking, you know, when we think about investing in companies, we think of lifetime value. It's a pretty common, like you acquire a customer for a certain amount, how much does that customer generate for you in fees over the life? The downside of charging high fees is in a world where there are an increasing number of alternatives is that that person doesn't stay with you very long. And so I think it's sort of a necessity to take a more pro-consumer approach to financial services today than in a time when you really only had Citibank or someone else or whoever gave you a t-shirt. Look at that, I got my Citibank account because I got a t-shirt at Columbia in 2004. I canceled that account 2 years ago. So yeah, I think you can definitely make money, but you have to change the way you think about your customers, and you have to really provide them a lot of value and not just extract fees from them because it's too difficult to switch.
And I've just been given the sign that there are only 10 minutes left, which actually I'm surprised at, so I hope that your timekeeping is good. Let's open it up to the room, and I have a few more questions if the room doesn't, so go ahead. Do you mind just introducing yourself and then? Oh, sorry, maybe I was faster than the, thank you, Michael.
Testing. My name is Jabron. I'm a student at Queens College. My question has to do primarily with investing in a crypto asset. So investing being, through analysis, there is a certain promise of safety. How is that being concluded when it comes to buying and selling specifically crypto assets? And if it's not there yet, are we getting there, or is it pure speculation at this point?
I think you can do all of the analysis in the world. I don't today know how much that will really help you. This is more of a personal view than anything, but I think like 99% of all the cryptocurrencies will be worthless. And yeah, Bitcoin is currently the winner, but I don't think there's kind of the promise that Bitcoin will always be the winner. So there is certainly the possibility that a better Bitcoin emerges. Although kind of the network effect and the flywheel effect and the head start Bitcoin has compared to everyone else would certainly make it a challenge, but I wouldn't kind of consider that, I wouldn't throw that out as a possibility. I do think the primary use case of Bitcoin is still certainly speculation. Although the lens at which we look at these assets may change over time. And that'll give you like different valuation frameworks, but that's probably something that someone far smarter than me would be the one to come up with that.
Okay. Yep, go ahead.
Seth, I was surprised to hear that you only invest in 2% of the companies that you look at. I was wondering if you ever go back and look at the other 98 and see, did you miss a good one?
Yeah, that's a great question. The answer is yes. It's hard to do. The stats are stark. So of the companies that are in our universe, somewhere between 50 and 60 die. Some of them sort of end up being zombies, and they don't technically declare bankruptcy, but they no longer exist in any meaningful form. Then there's about another roughly 25 or 30% that effectively just become absorbed in something else. It's usually not in a way that means as an investor you get much, if any, return. You might get something, not zero, but you don't even get your money back. And what that leaves is something like 20% of the things that you see where there is actually a return. Now, if we're looking at a universe of 100 and choosing 2, that means we are missing more things than we succeed at all the time. So the way I think of it is, when I'm making decisions, I'm just trying to de-risk as much as possible. I'm taking lots and lots of risk. That's the job as an angel. But I want to make sure that I understand what risks I'm taking before I take them, and that I'm paid for those risks, and that I learn from the mistakes I make in both directions, because I'm going to have some investments that don't work out. I'm lucky so far I haven't had that problem a lot, but I'll have plenty of things that I'll look at, say no to, because I don't really understand them, and then they'll succeed, and I'll feel very stupid. And actually, that's very humbling, but it's the nature of the beast, and I think it's what all of the early stage investors really need to do a good job of. That's how you actually become a better investor.
All right, we have time for one more question, so make it a good one.
Well, I can repeat the question.
Blockchain, a lot of the agreements that are now kind of being litigated were SAFs, and those are modeled after safes. Could you just talk a little bit about why many investors don't like safes, and therefore why they probably wouldn't have liked the newer kind of spin on it as well?
Great. Let me just explain what Donna is talking about. So a safe is a form of a money-raising instrument. SAFE is an acronym. It stands for Simple Agreement for Future Equity, and it is effectively a kind of option or warrant that allows you to get whatever the company becomes when and if it actually does issue equity later on, with very, very little in the way of protection for any of the early investors or for the founder, for that matter. And what happened when the blockchain was very young and token companies of all kinds, not only cyber currency tokens, but other kinds of tokens too, is that many people jumped on that same idea and said, we can issue simple agreements for future tokens that would basically be the same concept in the ICO world, the initial coin offering world especially, and basically have the ownership of the company be a function of whatever the token actually was going to be worth later. The reason that this is a problem is the same reason that over literally the past 100 years, we've learned that when you buy shares or any kind of ownership stake in a very, very early stage company, it's really, really important to have dull paperwork. You were talking, Bartek, about the boring things are sometimes the most important. That you have to have very clear terms that explain what will happen if something goes wrong. Because there are so many failure points. That's the reason that many companies are failing. And if you don't anticipate some of them, the likelihood of failure goes up, not down. And the likelihood of success really being as full as it could be also goes down. So as an entrepreneur, this is a much longer conversation than we can have at this panel right now. But I really strongly advise anybody who is an entrepreneur and is thinking about how to raise money for their company to reach out and talk to people like New York Angels. And by the way, go to the New York Angels website. There's a whole bunch of resources there, including the kinds of documents that New York Angels has drafted over many years that try to strike the right balance and fairness between some complexity and some protection for the founder and the early investor.
All right, well, I'm being given the high sign, so thank you very much. I really appreciate it. Take advantage of the networking times coming up over lunch and this evening to talk with our panelists more about your questions. And thank you all.
Yeah, sure.
Sorry, we need to. Sorry, we need to.
Yeah, there are.
Okay, thank you very much, Christian. We're going to move on to the next panel. And I'd like to invite the moderator and an old friend of the DFS Observatory, Ulrika Guigi, she's Managing Director of Deloitte, to come up with her panelists. Sorry,
Okay.
I'll try to stay, I can't stay all day. Leon, a pleasure.
Yeah, sure.
Thank you, Leon, and I'd like to invite my panelists to come up.
Nice to meet you.
I'm sorry. Nice to meet you in person. Okay, so we've got Ravi and Sunena.
I'm just going to come up behind you while you're talking to close this because it's too bright for the camera.
It's too bright, okay.
They're
And
gonna,
you
I
can just
can't
pull
do
it
it.
down.
I'm going to ask them to do
Okay,
it.
all right.
Don't be disturbed.
Okay. Okay, everybody, if you want to have any hope of having lunch before the sun goes down, I would recommend everybody into your seats, please, and we'll try to make up some of the time that we're running behind. And once you're in your seats, yes, please, that would be good. So hi, everybody. I'm really excited to be here. I think Leon puts on the most interesting conferences. Obviously, we go to Money 2020 and to all those payments conferences. And the content and the level of discussion just isn't the same as it is here, with really the high caliber of folks and the very intimate setup. So I appreciate that I have an opportunity to be a part of this once again. My name is Ulrika Guigi. I'm a managing director at Deloitte Consulting in our payments practice. And we will talk today about both payments and finance and really look at how innovation versus legacy is helping increase access to financial services. The panel represents both the payment and banking side, as well as with the World Bank having somebody who really is taking a step above just the corporate view. So I'm very excited about the diverse panel that Leon has assembled here. And starting with Ravi Aurora, SVP for Global Community Affairs at MasterCard. Next to him, Leslie Goh, Senior Technology Advisor from the World Bank. Then we have Yelena from Reznikova, I'm going to try all the last names, from Plaid, which was recently acquired by Visa. So we have the two payment networks represented here. Then Aisha from Bank of America, where she heads cross-product solutions. And then Sunena from TD Ameritrade, really bringing in the investor and retail investor perspective as well, which is interesting because often when we talk about access and improving access, it is very much focused on basic financial transactions. But the very fact that you need to, if you want to build wealth, it starts with savings and with having access to those types of solutions as well, really made it a great idea to include that product line. So I'm going to. So the way we're going to do this is we'll have a good conversation here, and then we will have 5 to 10 minutes for questions from the audience. Since you're going straight to lunch, I encourage you to also interact there with the panelists. We do have a bit of a time to make up here, and we don't want to rush through the dialogue that we have here, so we'll probably take it out of the audience Q&A. And I'm going to start with Ravi, and was very impressed to learn in our prep session that MasterCard has over 750 programs in 80 countries, helping to provide access to the underbanked and unbanked. And I would just like you to talk briefly about how is digitization and innovation helping and changing how that looks today versus how it looked 5 or 10 years ago.
Okay, great. Thank you again for the opportunity to be here. Thanks, Ulrika. And so MasterCard, just by quick background, we are a technology company in the payments industry. And our global payments processing, network spans, across connecting merchants, consumers, government, financial institutions. And we operate in over 210 countries, and you can say in about over 150 currencies, right? So there's all the authorization, clearing, settlement, that takes place, every second. So as we, in this whole payments ecosystem, for us, when it comes to financial inclusion and innovation, at the very core, I would say, is this whole doing well by doing good philosophy, which is not really, CSR, but it is about creating sustainable impact, right, from a long-term perspective. And kind of you drive growth for helping economies to be sustained over the long run. So let me give you some concrete example about that, what we mean, right? Because we have to provide pathways for people to be more financially secure. So one of the programs that comes to mind, and that has it kind of was born out in Africa, in Kenya. And what we've done is a program that started with partnerships. For partnerships, we believe very strongly in both public-private and private-private partnerships. And this program called Jaza Duka means fill my store. So it's in Kenya. So when you look at these small, very, very small, store owners, like, kirana shops, as we call them, you have these small store owners that are mired in cash and in the cash economy. Now, cash does not allow you to build credit. They are only able to get, purchase what, they have on hand. So in partnership with, Unilever, what we did is we said, okay, here's your distribution route. And you look at all these very, very small store owners and what their purchase pattern and what is their distribution pattern there. We brought in analytics into that. We brought in analytics to be able to look at the store owner and see what they're buying, and purchasing and selling, history is. Based on that, we created like a microcredit eligibility. Now, taking that microcredit eligibility, we brought in another partner, like Kenya Central Bank, KCB. Now, KCB, we are able to provide them with, that microcredit score for that Kirana store, for that small store owner, to now have access to credit, so whereby, at much favorable terms, because a lot of times these folks go to unregulated lenders, and they're never able to get out of that cycle of debt as such. So again, this is an example of bringing different parties together, looking at the ecosystem and the value that you can add in this to help uplift these micro and small businesses. So that's an example for you.
And I think that's a great story, and I had not heard that specific story before. I'm wondering if the fact that, or the perception that we have that some of those emerging markets maybe have a less strict regulatory environment, is that helping this type of innovation to take hold more quickly, and maybe Leslie has a perspective there.
Thank you very much. What an honor to be here. In fact, most of the time I work in developing countries. It happened that one of my mission got postponed because of the outbreak, so I had the opportunity to be here today. And so commenting on this whole regulatory landscape in emerging countries, not necessarily that they are less strict, it's just that the incumbents are not there, therefore giving them the fintech and the techfin and all these alternate financial services to really leapfrog in these markets. I mean, take Myanmar, for example, right? They don't have that kind of infrastructure in place for a formal financial system, but the access to financial capability through the mobile devices is very strong because of the non-existence of some of the banking infrastructure. However, the ability for them to leapfrog and taking advantage of all the capabilities from mobile payment system is now transforming them and giving them access to finance, and now with data in the platform, giving them access to credit because of the ability to tap upon the whole ecosystem, and then empowering women and gender equality and opportunity for them to partake in the digital platform. So I think that is one of the things that is very exciting, because in emerging world, due to the lack of some of the traditional incumbents,
they have access to capabilities because technology is now the equalizer, giving them access to services that they traditionally were not able to access in the remote villages for these people, because it was too costly for banks to serve the unbanked and underbanked. And therefore, the mobile technology now with cloud computing and artificial intelligence democratizing the capabilities of financial services for these people who are underserved. That's why it's such a game changer. And you see that blurring the lines from one industry to another. You see ride-sharing company like Grab and Gojek in Asia going into the payment space for cash in, cash out, but now also going into insurance and other products to help people who are underserved to have access to financial services and lifting them out of poverty. And to me, that is the real true innovation and revolution in this financial services space.
And that's interesting when you say the incumbents weren't there, so others came in to fill the gap. And when you look at the likes of Alipay versus the efforts now of Visa, MasterCard, and Amex to get into the Chinese market, even once they have their licenses and they can do all their processing onshore in China, are they ever going to be able to really play that same role in the ecosystem that Alipay has built there, right? So but we do have some legacy providers on the stage as well. So maybe Serena can talk a bit about what you're doing and how you're using digital assets to enable access to investing products, to capital markets for your customer base. Maybe talk a bit about how you see your customer base.
Sure. Delighted to be here. And I don't think incumbent is a dirty word. Incumbents can be, sexy and innovative, and I think we'll prove it. Thank you. So as the head of emerging technologies and digital assets, I guess I'm the designated insouciance within TD Ameritrade. But I think the ethos of what we do is really guided less by the technology and more by this inherent mission of how do we break down barriers that still exist in capital markets that keep consumers on the sidelines, right? Not gonna get into politics here, but there's a lot of rhetoric these days about, oh yeah, the stock market is at its all-time high, Americans are benefiting. But it's actually a very small subset of Americans that are benefiting, because majority of the consumers are sitting on the sidelines either because they've never been educated or informed or given a pathway to kind of take charge of their financial futures, right? So our core mission, I would say since our genesis 40 years ago, has been how do you break down those barriers, whether it's a price barrier. It wasn't that long ago when if you wanted to buy a stock of XYZ company, I hope that's actually not a listed company because that's not a recommendation. My legal team would want me to tell you that. You actually had to shell out $500 in commission and call a broker on Wall Street, right? Well, then with the online brokerage industry, that intermediary kind of got taken away and it was direct access to the market. And I'm sure you've all been following recently, it's zero commission. So if price was a barrier, that kind of got taken away. But, I've grown up at the intersection of finance, tech, and law, and I love this industry, but I'm also the first to call the baby ugly, saying, there's still a lot of complexity and unnecessary opacity that keeps people out. So the way we've leaned into this ecosystem, and just for clarification, the consumers we serve are about 12 million retail investors in the United States and a growing footprint in Asia, and about 10,000 advisors. So, the RIA community. So with a very specific lens on who are the core consumers that we serve, we look at these technologies and these emerging asset classes and say, how can we solve problems that are still inherent, right? You touched on Asia, so I'll kind of double click on that. As we were building our footprint in Asia, specifically Hong Kong and mainland China, one of the things we really thought about was, okay, everybody talks about personalization, right information at the right time, but we forget about the right medium, right? In China and Hong Kong, if you want to serve your consumers through education and financial literacy and access to capital markets, you have to go meet them where they are. And that's WeChat, right? So when we built our business in Asia, we actually did focus a lot on building our domiciled website or mobile apps, which can sound very strange. We partnered with Tencent and we say, we're going to go where the consumers are. And you can check me on this. An average WeChat consumer, first of all, WeChat has, I think, over 1 billion people who use that app on a monthly basis, which is, I'm sure Zuck is very jealous of that. But secondly, an average WeChat user spends about 4.5 hours in that platform. So if I'm going to break down barriers and serve that consumer and give them education and access to the markets, why not start by going where they are? So that's really the approach we've taken in Asia, and we've done a lot of that on the state side in partnership with Apple, but also some of the startup ecosystem. And I think, a similar approach with digital assets. The reason I'm very proud to work at an organization that hearts blockchain, but also Bitcoin. And I know that's unique on Wall Street. But again, us leaning into it is very much predicated by the voice of the client and what we're hearing from our consumers, and making sure if they're going to engage in this nascent asset class, they're doing it with, credible education and prudent guardrails, which, we believe that we ourselves are uniquely qualified to bring, or do it in partnership with, one of the startups in the ecosystem.
This is very impressive. Are you guys ahead of the pack there in terms of what you're doing?
In terms of embracing Bitcoin?
Yeah.
I was talking to Sandra earlier. I'm still surprised that, on Wall Street, we're still kind of an anomaly. I give a lot of credit to our friends at Fidelity, and, with Abby kind of taking the leadership role, they've really leaned into it. But I think other than that, it's us, them. And, what I will say is, my counterparts in other incumbent organizations are definitely leaning into it, right? There just are there's no playbook. So it's one of those things where you're having to write the playbook as you're executing the playbook. That's one. And I think the second is the asset class is nascent. The regulatory environment is still work in progress, right? And the third thing I'll say, just personally and professionally, because many of you are decision makers in the room or startups who want to work with incumbents, is when you want to launch some of these nascent things, there has got to be somebody crazy like me in an incumbent organization that says, I will take the career risk and I will kind of stick my name to it, and with my team, we will start to materialize it. So I think it's a combination of those, but we definitely see an inflection point. We recently hosted our annual advisor event where 5,000 RIAs come for an annual conference. It was in Orlando, and alongside one of our RIA partners, Rick Edelman, we hosted a one-day education session, because it has to start with education, for RIAs on digital assets. There were about 2,000 advisors for an all-day session in the room, and I asked the question, how many of you today believe Bitcoin is a fad? And not a single hand went up. And these people aren't shy. I then asked the question, how many of you would have said Bitcoin was a fad a year ago or 2 years ago? Pretty much the entire room went up, right? So there's an inflection point, and the reason they want to now learn is because their clients are coming to the advisors and say, either I want to invest in it or I've already invested in it. So again, what's really exciting about this, we've always said we're proud to bring Wall Street to Main Street. With digital assets, it's kind of a twist. We're taking a Main Street product and almost bringing it to Wall Street, which I think is pretty exciting.
And it's always great when people are so passionate about the work they do, and I think you're right, it takes somebody who has that entrepreneurial mindset within a large corporation who's not afraid to take the risk in order to build something. And so with that, I'm going to go straight to Aisha, who's also bringing digital assets to product innovation at Bank of America. Can you tell us a bit about how you do that and how that is driving access?
Yeah, sure, no problem. So thank you for having me as well. Just to give you some background, I run a group called Cross Product Solutions at Bank of America, which is essentially innovation, and we focus on our corporate clients. So that is anybody that makes $5 million in revenue and above, and it's our global transaction services business. So what we do is in our team we create new solutions based on client pain points. So we look out there at the entire spectrum of our client base and say, these are the products you're using today, these are the products you're not using, these are the difficulties you're having with your business and your customers. And then rolling that back, how can we help solve those pain points, right? And we can do that in a number of ways. It's about building it in-house, or it can be partnering with a fintech or another technology provider, or it's about making an investment in another startup that can help us strategically deliver that solution. So those are kind of the three directions that we take, because we recognize that at Bank of America we're really good at payments and really good at transactions, but we may not be the best provider of artificial intelligence or optical character recognition or whatever it is that might be needed in that particular solution. So we want to partner with the best and brightest out there, right? So that's kind of the mechanism in which we approach our solution delivery. And then beyond that, I would say, I joke, leading an innovation team, I joke that innovation as we knew it before is dead, right? Because, and I say that because before it used to be a lot about let's test and learn, right? It was all about testing, learning, being agile, and it still is. But I would argue that it's also about delivering products, right? And we forget about that sometimes because you test and learn so much and then you kind of hit a wall and all of the problems that you had before the innovation kind of became sexy are still there, right? When it comes to regulations, when it comes to speedy delivery, when it comes to compliance and operations at large banks, that's all still there. So how do we deliver that in a way that's faster and more relevant and actually solve some of these pain points, right? So what we're doing now is kind of turning the model a little bit and saying we're still doing the testing and learning, and we have, you know, our ideate and test and all of the fun words, all of, yeah, exactly, all of that in terms of our solution delivery framework. But how do we actually then at the end deliver a product to our clients faster? How do we get it in their hands? How do they pilot it? And most importantly, which I actually think is the best part, is how do they opine on the solutions before they're delivered, right? So yesterday I was in a meeting with a client, and it was very interesting because their clients are small mom and pop businesses, right? So for us, it's also about not looking at our corporate clients, but beyond that, how do we help their customers, whoever they might be? So it's about solutioning for that entire spectrum, right? And when we do that in a way that is creative, in a way that addresses some of these pain points, these companies and their customers get a view and an opinion into our solutions before they're actually delivered, right? And so that's the best part, because you're actually creating something relevant and something that will actually help people.
So thank you. And that, I think that leads us really to Yelena, because I've heard from both of you now that working with the fintechs and bringing in some of those capabilities just allows you to get to market faster. And that seems, that discussion, whether to embrace the fintechs and are their competitors or not, that's over. I mean, this is just the way of doing business now, right? Yelena, can you maybe talk a bit about what Plaid actually does to enable all these incumbents to embrace digital innovation and what your role is in that ecosystem?
Sure, thank you, Ulrike. So for folks who aren't familiar, Plaid is an API platform. We integrate with all the financial institutions in the country and pretty soon across the world to allow innovators to have access to their customers' data at those financial institutions. So essentially, our platform allows consumers to link their Bank of America account to an application that's built by an external developer. So platforms like Venmo, Betterment, Acorns, all of these disruptive innovations are predicated on reliable access to consumer data. And Plaid does all of the heavy lifting so that the applications, the innovators themselves, can focus on delivering services to customers, and then we handle the infrastructure layer. In terms of how we're facilitating innovation, it's pretty interesting. So it's a two-sided marketplace, essentially. On the one hand, we integrate with maybe 15,000 financial institutions that effectively act as data providers. And then on the other hand, we have more than 3,000 applications that are built on top of Plaid's data that are consuming data from those financial institutions. And recently it's been, incumbents on one side and fintechs on the other side. But recently, we've seen cross-pollination from both sides, where now the financial institutions that have traditionally been data providers are becoming customers of Plaid and using that same infrastructure to link their customers' accounts at other financial institutions and build some of those similar disruptive products that the fintechs were developing. And financial institutions are starting to compete in much the same way that fintechs did traditionally. And then at the same time, fintechs like Chime and Vero and these neobanks and Betterment, who are typically, consuming the data, are electing to actually build into Plaid to allow their customers to link those accounts to external applications because they recognize the need for, transparency and, a 360, a comprehensive view of a consumer's finances. So they want to make sure that their customers are able to link their accounts as well.
So obviously interesting business model, and Visa put quite a high value on this, on the company when they purchased them 2 weeks ago. It's all built around data though, and a lot of the innovation is enabled by data, because that's how you make the better offers, and you bring together, like you were saying before, have new data elements that enable you to then make lending decisions, right? I'm going back to Leslie though. What have you seen around the world? What can regulators do to make sure that they don't get in the way of innovation? Because when I hear data, I'm thinking GDRP, I'm thinking about everything that's coming down the pike now in the US in terms of regulation, everything that's gone on in Europe already. What kind of environments can regulators set up to really allow innovation to thrive without getting in the way?
That's an important point, because I work primarily with regulators, policymakers, and this is one area that many regulators, especially on the fintech side, and some of the nascent or rather emerging technology, they're still grappling with that. And to come up with the right policy or proportional regulation is important so that you don't shut out innovation. So several regulators already set up sandboxes where they do the testing and experimentation in a sandbox environment. In Asia, this has been the case. In Singapore, Monetary Authority of Singapore has been quite a big proponent of that. And many other emerging countries are also trying out sandbox in order for them to understand before they regulate it. And I think that's the kind of things that we really like to see happen. And also capacity building among the regulators who are in the working group to try to learn from each other, to have cross-pollinations from other regulators in different parts of the world that are already pioneering some of these capabilities in their market. So I think that kind of capacity building, where there's knowledge sharing from one jurisdiction, one region to another, really helps strengthen the understanding of where tech innovations can really help, and then for them to proportionally regulate rather than shutting down shutting down the opportunity for innovators to come into the picture and offering new products. So that's been the way that has been going in the trends of fully understanding and then regulating alongside. And that's very encouraging for me as someone who is trying to connect the dots between regulators and all the innovations out there, be it in incumbents or the new entrants into the market.
And given that so much of this innovation has been happening in Asia and Africa and outside the US, Ravi, would you say that the regulatory climate in the US makes it more difficult for you to innovate here, or is that
No, I would
overstatement?
not say that, Ulrike. I think there's a lot of innovation going on. We have when we look at products and in designing and innovation of our products, there are some key underlying principles that we follow, right? And I think that one of the things is trying to build both privacy by design and security by design into everything we do. And I think that you find that in the regulatory perspective. I mean, these are the core principles that even regulators are concerned about. Because what we believe at a very fundamental level is that, let us say, every individual have a right to their data, right? And keeping those individual rights at the center of product design, innovation is key to what we do. So therefore, because having that fundamental underlying principle that personal data is exactly that, it's personal, right? It's very, very important as you begin and as you go and look at product design perspective. Everybody has a right to control how their personal info should be shared. Individuals should benefit from the use of their data, and that personal data should be kept secure. right, or at all times, and privacy should be honored. So when we look at, in the regulation space, when you apply good privacy by design, good security by design, where there's anonymization, tokenization, how do you, try to make it in such a way, that the information, can be de-identified, and then being used so that it gives the right level of comfort, to the user, as well, from a safety trust perspective, is very, very important. So all of that, I would say, is how we work with regulators in ensuring that we are delivering the best value.
Okay, and I see there's another session about identity and privacy coming up later, and I encourage you all to go, because figuring that out is going to be crucial for the success of any of those innovations we've been talking about. Also, when it comes to innovation, the regulators, in case you're not aware, every one of the banking regulators has now set up an office an innovation office. Most of them did that in 2018. So the OCC, the Fed, the CFPB, and all the other regulators, everybody set up their own innovation office, because they do realize it's important to be working with the banks and trying to create the right infrastructure here in the US. I'll open it up to questions from the audience. If not, there is so much rich and interesting content here. We can keep going. Okay, and we have roving mics, and there's somebody in the front here. Maybe it's another roving mic. Yeah, there's that.
Hi, this is Mehi. I work in Women's World Banking. I have a question for Aisha. What you are doing in Bank of America is very similar to what I do in Women's World Banking. We work with financial service providers that they provide financial services for low-income people. So I was wondering about the structure of your team. You said we work with clients that we try to figure out what's the problem in the payments. So I believe that probably you do some segmentation there. And I think you can do it through qualitative work or AI and machine learning. So I'd like to know how you structure your team. What are the components? Do you have AI team? Do you have a qual team? And then after you figure out what's the problem, usually how long it takes the collaboration with your client? Is it 1 year, 6 months? How about the time span? And how much those solutions that you find are replicable? I mean, from client to client, do you have a kind of can you make it standard, or is each client you have to customize the solution? How much you can standardize those solutions for replication?
So all great questions. Forgive me if I, just remind me if I...
Sorry that I asked so many.
So essentially the way we do it is we have our core team, our cross-product solutions team, but we have teams all across the bank that kind of dotted line into our team, into me. So we have a technology team, we have compliance, we have legal, we have all of these different components that are aligned specifically to innovation in order to help execute these solutions, right? So from that, and then part of that is also data. So we have a data team that works very closely with us all the time, because one of the changes over the past few years that we've noticed, at least, is data is not something that you have to think about at the end anymore. It's something you need to think about from the beginning, right? Every new solution that we are implementing, almost everyone at least, has some sort of artificial intelligence or machine learning capability in them, right? So you need to be able to access that data. You need to be able to learn off of that data very quickly and efficiently in order for these solutions to work, right? And so to the point before too, and then identity and security and privacy and all of those things come into play. So in doing so, we work with all of those teams to execute that. In terms of the custom builds, what we try to do is when we get the voice of the client, we do as much as we can in what we're focusing on now is like microservices, right? So how can we via API not give you one massive solution that everybody has to adopt the whole package of, but instead provide more microservices via API and say, okay, if you only want these components, that is completely fine. Or we will give you one solution with 3 different implementation options, and that way, depending on how large or small your company is, you can then adopt whichever one works best for you, right? And based on the type of implementation, there's different types of functionality. So that's how we do more of the custom type of work, which is providing the optionality that way. And then in terms of time frame, I think that's the last one, it really depends. Like there's no one size fits all, just because it really depends on how complex the data environment is that we're looking at and the privacy, and how involved the legal situation gets. For example, information security and what we call it the bank model governance are, it's a big hurdle to get over, which is almost every machine learning solution out there, right? So we need to, but it's for the protection of our consumers and our clients, right? Because we need to ensure that everything is according to the regulations that we adhere to, that everything, the partners that we are also partnering with, it's a lift for them too. It's not easy for a fintech to partner with a bank. Not easy. Because there is a lot of security related due diligence that they need to do in order to be able to come into our systems. So that requires a lot of time too, and I'm sure MasterCard and TD and you guys know that very well. Yeah.
Definitely.
So there's a lot of lift. So the time frame just, honestly, it just depends.
Good.
Thank you.
Do we have other questions from the audience? Yeah, over there, gentlemen.
Thank you. I'm Haitham Trabik. I'm actually Egyptian, just arrived after leading a program for World Bank for cash subsidy, foundation cash subsidy. So my question is actually to Leslie. I see a lot of programs that created the digital payment programs are created to target unprivileged population, and it stops at access to cash or access to money. It was never created in a way that it will extend to access to finance. For example, this program I was running, it was like for 2.5 million Egyptian family. The very unprivileged is conditional cash subsidy, but it stopped at just they get the cash and buy whatever they have, food, whatever, and stopped here. How we can build this connection between having access to cash and access to finance at the beginning of the program, because after you reach some point, you cannot re-architect the program again of digital payment to be a financial inclusion program.
Right. That's a very good point. Thank you for bringing it up, because I think I personally believe that it's not just a matter of access to money alone, but it's also the ability to have the knowledge, right? Financial literacy, data literacy. In many of these countries, education level is low, and remote villages, they don't understand. Once they get access to all these credits, they would end up spending on the wrong things instead on the family. That's the reason why Chris earlier mentioned about this whole woman empowerment for financial inclusion, because when you invest in a woman, they tend to spend it on the family rather than some of the vices out there, right? As we heard some other folks mention about Kenya example. So I fully agree with you that this has been the case in traditionally. We talk about access to cash and all that stuff, but now I think we need to go further to talk about data literacy, financial literacy, and build the capacity at all levels in order for them to fully understand how do they lift themselves out of poverty in the emerging countries. So I fully agree with you, but those are the things that are lessons learned from the past. Thank you for bringing it up.
I think Rafi might have a point.
Totally agree with you on that point, and I'll just cite an example. For I've been very closely, like even in the U.S., if you take it, right, because being in that cash, 31% of our transactions here is cash. Yeah. So you think that it's not just it's not just a developing economy issue. It is as much
it's
in
human,
developed,
right?
Yeah. So therefore, I think your aspect of financial literacy awareness, like we have a program called like Master Your Card, our Center for Inclusive Growth. So it's not when we are enabling certain systems, ecosystem, uplift, giving access to small businesses or women empowerment, and we also bring in other partners that do just that. How do you keep things on your shelf properly? How do you manage your books, things like that? what is the advantages of how do you find the right processor? And all of those aspects are covered because education, awareness go hand in hand and very important.
Okay, and one last question before we wrap up.
My name is Vipin Bharathan. I run a consulting firm called DLT.NYC, mostly in blockchain. My question is about payment, the cost of payment infrastructure. Basically, you're charging something between 2 and 3% of every transaction for moving money around, Visa, MasterCard, anybody like that. So the argument that you can have an alternate payment system which will cost less is becoming more and more important. So what does MasterCard do to drive down or Visa for that matter, or any of the banks do to drive down the cost of transactions so that, people accept it more?
Sure. Yeah. Thank you for your question. Good question, right? So let me give you a perspective, from a couple of dimensions, right? So there are markets in the world where, so you've got to separate, so one point, let me step back is, when we're looking at payments and talking about payments, it's form factor agnostic, right? It's digital, it could be physical card, whatever the form factor may be. Now, a lot of innovations come about, right? So MasterCard have, we have companies like VocalLink out of the UK, where through mediums such as the real-time payments, faster payments, we are integrating with ACH providers and providing both application services. Our MasterCard Send platform, is like a real-time, near real-time payment, at a very, very, very low cost. Now, when you look at debit versus credit, right? There are markets where rates are regulated. There are other markets where, let's say debit is, dictated by a central bank. And usually, sometimes it is, what you have to see is there is a cost to cash. Cash is not free. Every time you go, whether to withdraw cash, to safeguard cash, to, being able to, cash doesn't give you data. Digital electronic payments now give you data. They give you access to credit. Now, when there is, usually the cost in debit is far less than even, less than 0.5% or so forth. When you're coming to credit, how is that ecosystem broken up? You have an issuer that issues the card. You have acquirers that work with the merchants, and you have MasterCard, Visa that are helping the connectivity around that. Yeah. So when in the case of who gives you zero liability, who gives you data as a merchant for your purchases, your sales, right? Immediate access to funds, safety and security of funds. All of these have a cost in the system as such. So the costs are continuously come down. It has, I think it's a myth that it is, higher. It's much lower at the, as markets and as new payments are coming about, new form factors through, through digital means. Those costs we are continuing to look to. We are working with partners to drive that down.
So I think very fitting that we're ending on a question about cost of card acceptance, because even with all the innovation that's happening, cards will continue to constitute a major payments factor in the US for all the reasons that you described, which is it's a very solid value proposition, but we see the payment networks investing in real-time payments, which is going to come with lower fees and equally interesting value propositions. And we've seen a lot of markets outside the US where the payments networks, frankly, they're not as relevant as they are here, and they're having trouble getting to the debit spend, for example, because other alternatives have come up. But that would be an entirely different panel. Yeah. So with that, I'm sure
very happy to.
Next time, and it's also a sensitive topic, so I appreciate that you answered the question, because there's still ongoing litigation on that very question that's been going on for years. All right, with that, thank you very much to the panelists. I hope you all found something of value in this.
And if the panelists could come up, please, especially Elizabeth. You're on. Okay. Yes. Come on. I don't know which one. Ladies and gentlemen, if you could settle down, please. We'd like to start on time. Okay. So I see some new faces in the room, and welcome. Just a reminder, I'm Dr. Leon Perlman, the organizer of the event and head of the Digital Financial Services Observatory at Columbia Business School, and welcome to the afternoon portion of the event. And for those on the live stream, welcome too. I want to introduce an old friend of the observatory and expert in the field, Deb Baxley, who's going to chair the Identity, AI, and Privacy session. And Deb is the chair of Mobile and Contactless Payments, US Payment Forum, and on board of NIPay. Thank you.
Don't take my notes. Hello, everybody. Thank you, Leon. I think this is the third or fourth summit that I've been to, and it's just always, he has the best network of anyone I've ever met. Yeah, we're missing a couple of our panelists, but we'll go ahead and get started. I can't wait to see the session this afternoon where we get to hear from the FBI. So anyway, one of my roles is on the U.S. Payments Forum, and I'm just excited to have this panel because we're actually working on a white paper on authentication techniques, which fits right into this. So the topic is identity, artificial intelligence, and privacy, the role of identity in securing access and ensuring privacy in the financial ecosystems. And I'd like to introduce our panelists. Oh, all of a sudden they're all here, great. Elizabeth Renares, who's a fellow at the Berkman Klein Center at Harvard. And then David Medine, who's a senior financial sector specialist at CGAP. And please remind me, what does CGAP stand for?
The Consultative Group to Assist the Poor.
Poor, okay. And then we have Kinga Partika, who's with Data Robot. She's a strategic account lead and client-facing data scientist. And then we have Professor Jeanette Wing, the Avenetian's director, Data Science Institute at Columbia, right here at Columbia. And then finally, Matthew Davey, who's the Chief Strategy Officer at Kiva, and excited about that because Kiva is one of my favorite charities. I've been donating to Kiva for about 10 years. So we have three threads really in this conversation: regulation and guidelines, analytics and artificial intelligence, and then financial inclusion. So I think I'll start with Elizabeth and ask you please to lay the groundwork for laws related to identity, data protection, privacy, and access in the US, but you could also touch on what's going on in the rest of the world as well.
Yeah, sure. How much time do we have? It's great to be here. So this is a quickly evolving space. And we could take all day to outline the sort of relevant laws and regulations that apply to identity and privacy broadly. But the first thing I'll say is that having a data protection or privacy law in whatever jurisdiction you are, it does not solve the problem, right? That is very much a starting point for a conversation around identity, in particular digital identity. So the best sort of framework that I have seen to outline the relevant laws and regulations in the space is sort of a three-layered approach, where the base layer is this idea of general law. So everything from contract and tort law to consumer protection to data protection and privacy laws, of course, to sector-specific laws and regulations such as HIPAA and GLBA, obviously in financial services, to the full array of laws that apply to pretty much everything under the sun, need to be sort of assessed and factored in. The next layer above that is what I call sort of general identity law, which are laws that apply to identity systems generally. So there aren't actually that many of these, but they are emerging rapidly around the world. So an example is something like the EIDAS framework in Europe, which is a regulation in Europe that basically governs things like digital certificates and timestamps and e-signatures. And so that's sort of generally applicable to identity services and offerings within that framework. Another example in Virginia is the Virginia Electronic Identity Management Statute, which is sort of underutilized at the moment. And there are more and more of these. UNCITRAL is also working on sort of a global identity management framework. And then you have the third layer, which are ID system-specific laws and regulations. So again, there aren't that many examples at the moment. They're more in the private sector, which are actually not necessarily embedded in law and statute, but things that are trust frameworks or governance frameworks around a specific identity system. Things like the Trusted Digital Identity Framework in Australia, or some of the systems that are emerging in the UK and Canada and other places. So that's kind of the broad universe, if you could simplify it, although it's very complex. And as I said, I think the important thing to keep in mind is that you really have to take a sort of holistic, composite approach to looking at the relevant legal frameworks when thinking about identity, privacy, and AI.
Thank you. You mentioned something about commodification. What does that mean?
Already. So there's another emerging trend we're seeing around the world, actually competing trends, I would say, where we have some countries who are banning the sale of data and digital assets so for example, the recent data protection law in Uganda bans the sale of data outright in any form. We have other countries that are sort of putting limits on the sale or commodification of data or digital assets. And that's sort of one trend we see emerging in the world in response to some of the, the data governance crises that we're facing. But there's another competing trend, really epitomized in laws such as those recently passed in Wyoming, that are really looking to commodify as much as possible and to create digital assets and frameworks for digital assets and basically anything digitized. And there's this interesting tension around the world, and we can dive into it more deeply. But I think it's something to keep in mind in the context, particularly of financial services, where in several of the panels this morning, we heard about this sort of increasing convergence of money and data, or money and things that were not money. So obviously things like social credit and alternative credit scoring play into that. But there is obviously this trend as we digitize of this convergence. And I think we really need to be mindful about how we may be commodifying or propertizing things that are not suited for that type of legal framework.
Yeah, social credit scoring. Interesting but scary at the same time. So how many of you are sick to death of consenting to cookies every day for the rest of our life? So David, your organization, CGAP, published a paper about the need to transition from consent to something called legitimate purposes, which sounds really interesting. Can you explain that to us?
Sure. So I'm at the consultative group to assist the poor, and we focus on financial inclusion efforts in developing countries, many of which don't have laws on data protection. So it's a wonderful opportunity to take a fresh look at data protection in the 21st century and try to think what kinds of laws make sense in the way things actually work. So in terms of consent, I imagine a fair number of you have smartphones in your pockets or purses. And many of those smartphones have apps, probably 10 to 100 or more apps. I could ask for a show of hands as to anyone who's ever read the privacy policy of an app on their phone.
Yeah.
Okay. Anyone who's not a lawyer, anyone who didn't get paid to write that policy, please put your hand. Only you should keep your hands up. I've read a few only in the pay capacity as well. But clearly we're living on apps right now, and we have no idea what they're doing with our data. And that's because the whole notion of notice and informed consent simply doesn't work. We have apps, we have IoT devices, our refrigerators, our stoves, our phone, our garage doors. We have websites where we're constantly clicking through cookie notices and everything else. And the reality is, it's a model that's really may have worked in the past, but it certainly doesn't work today, and it's only getting worse. Where Carnegie Mellon studied how many weeks you would have to spend a year reading privacy notices if you chose to do so. There have been studies in India where they tested college students and law students on their comprehension of large websites in India, and they had about a 50% success rate, and it was an open book exam. So these are policies that are written by lawyers and not intended to be intelligible and to give a broad range of uses. So what we've done is we've proposed a different model of data protection which doesn't rely on consent and instead focuses on legitimate purposes. And what it means is shifting the burden from the user to the provider to say you can only use my data for legitimate purposes. And those are things that are reasonably expected given the nature of the service or product that's being offered. If you're going to ship me a product, you don't need to know my whole financial history. You need to know my billing information and my address. On the other hand, if you're a financial services advisor, you do need to know my whole financial history, and so it's appropriate for them to collect that a range of information. And so essentially that would be the test, which is the burden would be on the consumer who can't see what's going on behind the scenes at a provider with their data, how it's being used, how it's being shared. So instead, the law would give the protections to the consumer to make sure that their data was used appropriately based on the nature of the transaction. I mean, one analogy is you go into a restaurant, you don't have to study what's going on in the kitchen. The law gives you a baseline set of protections. Likewise, the law should give you a baseline set of protections on how your data is used, because in neither of those cases are you really in an adequate position to monitor data usage. We've also looked at an alternative but similar approach called fiduciary duty, which is very familiar to people in the financial services realm, but in India and other places have proposed it as a model for how data is handled, which is that companies should use data in the consumer's interest, not just in the company's interest. I think at the end of the day, you still get into a reasonable expectations approach and likelihood, so I don't think this tests are all that different. One question that comes up is, and it's particularly for us where we want to promote innovation and new products and services being developed and created, is, wait a minute, if you can't use data for secondary purposes, aren't you thwarting just the kind of thing you're trying to encourage? And our response to that is de-identification, anonymization. That is, if you can de-identify the data, then you can use it to develop new products and services, just so long as it's not an identifiable form. We know it's hard to it's not that hard to re-identify information, but in this particular context, you can have legal prohibitions against re-identification. India is considering legislation now where the only criminal portion of the legislation is re-identification. And I'm not sure I would go that far, putting people in jail, but I think it's a controllable mechanism. And again, we would also give consumers rights that you see in a lot of data protection, access, correction, portability, things of that sort. But again, I think the key thing is to be realistic about how data flows and put the burden where it belongs.
So, Elizabeth, you had a concept of contextual identity that I thought was interesting. Can you explain what that is?
Yeah, it actually builds nicely, I think, on David's comments, which is we've definitely seen the shortcomings of consent. We've seen consent relied upon and invalidated in a number of recent actions around the world. So in Sweden, a school district, basically, a court found that a school district didn't have had consent. They had obtained consent to basically use facial recognition technology to monitor student attendance, but that the consent was invalid because of the power imbalance between the students and the administration. Obviously, we're seeing more and more actions under the Biometric Information Protection Act in Illinois, BIPA. And in those instances as well, often what's happened is there's been sort of a blanket consent obtained through consenting to terms and conditions of a website or platform, but not the specific informed consent required to obtain the actual biometric. So this is a really important trend around the sort of invalidation of consent. So the idea that I've been thinking a lot about is inspired by a very nerdy concept from Helen Niesenbaum around the theory of contextual integrity, which is an alternative theory of privacy. It's an alternative to this idea of notice and choice, and really it's focused around norms in specific contexts. And so I've basically imported this into the notion of digital identity, and I'm thinking about how what happens a lot in the digital realm is we treat the digital as one singular context. We talk about digital identity, we talk about online and offline, but that's completely inaccurate. So in the digital realm, we have relationships that might be in the context of healthcare, so a medical chatbot, we have financial services, we have social contexts, and each of those contexts should have different norms that would apply just as they do offline. And so the notion of contextual identity is really to think about what the relevant legal framework should be through that lens of what the appropriate norms for specific contexts are, and not to treat the digital as sort of one blanket context.
So it's very much like what David was discussing.
Exactly.
Yeah.
Yeah, it's a reasonable expectation based on the context in which you're sharing information.
It makes so much sense. So switching gears a little bit, talking about analytics and artificial intelligence. So Kinga, can you explain what automated machine learning is and why do we need it?
Sure. So before I get there, let's just talk about machine learning and AI and define them so you guys don't think I'm talking about a Terminator. So when I say machine learning, I really mean learning from the past to predict the future. And when I say AI, I really mean a computer system that is powered by machine learning. And this system is able to perform tasks that ordinarily require human intelligence. Now, automated machine learning is essentially a technology that automates a lot of the tasks that any data scientist would do if he or she were to build an AI system. Why do we need it is because what we're seeing in the market is a huge discrepancy between the supply of data scientists and people who can actually build AI systems and demand of machine learning and AI. And the only way to really bridge that huge gap that, by the way, is growing exponentially is to put automated machine learning into the hands of not just data scientists to make them more efficient, but also into the hands of people who understand the business very well.
Okay. And so you're working with clients on this. Can you give us some interesting examples?
Sure. So first of all, there are literally hundreds of different AI use cases in any organization, and you're really limited by your data and your imagination. So let me maybe give you two quick examples. First one is AML, anti-money laundering space. And let's try to simplify it a little bit. So let's say that what you're actually trying to do is predict which transactions are fraudulent. Now, if I go to any big bank today and then ask them to explain how they're doing it, they would probably tell me that they have a rule-based system. And what we've seen in the market is that, unfortunately, this rule-based system is very inefficient. And what I mean by that is that it will literally tag thousands of transactions that are completely normal as fraudulent. So that's step number one. Step number two is that they get passed over to a team that now has to manually review all of them. And as you can imagine, it's a very labor-intensive process. How you can change it with AI, a simple example would be to essentially build a machine learning algorithm that would take those transactions that were tagged by rule-based system and ask your AI, tell me which transaction is actually fraudulent. What we've seen by doing something like that, what it allows you to do is eliminate your false positives. False positives essentially means false alarms. So of course the goal is to catch all the fraudulent transactions, but you want to eliminate as many false positives as you can. And by doing this, you're saving your team hours of time and essentially millions of dollars if you're a bank. Let me give you another example which comes directly from trading space. So let's say what you're trying to accomplish is price a municipal bond. And if you know anything about municipal bonds, they're largely buy and hold product. And that means that they're not very liquid. You don't have great data on them. And how traders are doing it essentially is, again, very inefficient. It's quite subjective, and it takes them a lot of time. What we've done is, again, built an AI system by using automated machine learning, working directly with traders who understand the business very well. And this AI system is able to now price those bonds very efficiently and quickly. There are a couple of things that you accomplish by doing that. Number one is you free time of your traders. They're now able to focus on much more complicated products. That's number one. Number two is you're making your entire team much more efficient. And third really important point, if you're familiar with that space, is that now you're able to respond to many more RFQs or requests for quotations. And actually, it's a use case that saves any institution, if implemented in the right way, tens of millions of dollars, so it's quite popular.
Thank you. So building on that, Jeanette, you've been conducting research on what you call trustworthy computing and trustworthy AI. Can you explain what that is?
Yes, I'd be happy to. So trustworthy computing has been a term that the academic community and the industry community has been using for a couple of decades now. And the whole point about what trustworthy means is really a set of properties that we would like our computing systems to hold. So the first is reliability, which means it does the right thing. The second is security, which means it's not vulnerable to attack. The third is privacy, which we've heard a lot about. And there's so many other properties. And so both industry and academia have been working very hard over the years to make sure all the digital products that you know and love are reliable, privacy preserving, and secure. We still have a long way to go, but we also understand that the adversary will always make our job hard. Now, AI systems add more properties for us to have to worry about. So trustworthy AI adds minimally a couple of properties that I think are quite relevant to this meeting. First is robustness. So we want our machine learning models to be robust to small perturbations to the input. And I'm sure you measure the goodness of the predictions and the accuracies of your models with respect to small perturbations to your training set, for instance. That's an ongoing, probably the best concrete example of why we want robust AI is, and you probably know this, is in image recognition systems, it turns out to be very easy to modify an image and make the classifier classify something incorrectly. The canonical example now is to take a stop sign and add a piece of duct tape to it, and that will cause the vision system to not classify the stop sign as a stop sign, but as a yield sign. Therefore, the car goes through the intersection and you die. So that's not good. That's clearly not robust AI. The second property that AI has really forced the academic community to think about is fairness. So in fact, in today's paper in the New York Times, there's an article about how AI systems, these machine learning models, are basically giving risk assessment scores to people who are potentially should be given bail or not. And this is based on historical data, but if historical data is biased, well, so will your machine learning model be. Is that fair? Are we just not reinforcing historical bias by building these super duper machine learning models? Yes, we are. But then what do we do about it? So now, not only do our systems have to do the right thing, be reliable, be secure, so hackers can't change the results of elections, be privacy preserving so that our identity isn't released to the entire world, but they have to be robust, they have to be fair, they have to be all sorts of new properties. So we have basically upped the ante in terms of how to ensure that the nice systems that you are building satisfy these properties.
That's really, really interesting. I love the example of the stop sign. So shifting to financial inclusion, as we've often heard, according to World Bank, 18% of the adults in the world are financially excluded, primarily because they lack access to documents to prove their identity. They're excluded from financial services. And that's nearly 1 billion people globally who lack an official identity. So Matthew, from your work at Kiva, What issues and solutions have you uncovered relating to that?
Yeah, so for those of you who don't know, Kiva is a nonprofit that for the past 15 years has been facilitating microlending around the world in over 90 countries. And so just really quickly contextually, when you talk about the unbanked, you're not talking about no financial activity. Typically what you're talking about is cash-only activity or very limited non-cash activity. And so Kiva's traditional operations would be working with a microfinance partner in a country, or usually many in a country. And literally, someone who grew up in that village will hop on a scooter in the capital or in an urban center and drive with a scooter of cash and a notebook and go out to lend capital and to receive repayments. And they went to school with these people, so there's a level of trust there. And when you talk about including those people, today you're talking about digital financial services. The reason it's becoming possible and cheap, effective, secure to be able to actually take these excluded populations and include them is not by laying copper wire and building a brick and mortar bank. It's digital financial services. And so that brings in a whole host of issues and opportunities, and a lot of them were already hit on, but when you talk about digitizing populations that have never been digitized before, and then doing that with their identity and their financial information, the importance of privacy and security and all these challenges that are getting stacked on top for us, there's no technical capacity, there is no regulatory or policy capacity, there is no consumer education that exists. And we think about all the challenges we have here in understanding how AI is going to impact our credit score. At least for the past 60 years, we've had systems built around centralized credit bureaus. So some of the risks, like thinking about how you're putting technology and policy, and David was talking about how great it is to go to a country where there is no bias, there's no anchor in terms of what does policy around digital financial services look like. There's also no tech. So the big opportunity, you can actually go from scratch, and there's no anchoring. There's no need to have a tool like GDPR. You can actually build the overall framework, the technology and the policy, to be user-centric and to use legitimate purpose, not click through a terms of service consent. You can build those all in from the ground up. The risk is that if you don't do it right at the beginning, and I think the next 5 years in the developing world will set the norm for the next 50 years in terms of what does digital privacy mean and digital security and digital financial services regulation and policy. If we don't do it right, we're going to be dropping an anchor in the wrong spot. And it's really hard because we're talking about doing things that oftentimes we would sit here in Manhattan and say, man, I wish that Google or Facebook or whoever wouldn't sell my data like that. And we're talking about going to a spot where there's no asphalt on the roads and saying you could set up that system here. The challenge is they're just getting their first Android phone. And so I'm really inspired, and also I nod along with everything all these panelists have said about all of those risks. Those are doubly scary when you're a population where political instability exists and you might become a refugee tomorrow. But man, the opportunity of being able to rewind the clock 8 years in Syria and giving them systems that were resilient beyond a policy or a regime change, they'd show up in UNHCR camps and refugee camps, able to prove they're a doctor because of their identity documentation they'd have, able to bring their savings or their credit history. Like the opportunity to actually future-proof some of these systems is huge.
Great, thank you. Reminds me a little bit of some of the cool things starting up in India with Aadhaar and UPI and some of the payment banks and things like that. I had a chance to do some really cool things. So David, coming back to you, I was surprised, I guess a little bit surprised to hear how the unbanked are just as, or maybe even more concerned about their privacy and access to data as all of us in this room. You did a study that says people are less likely to take out a product if they are worried about the data. What was that about?
Sure. I think starting with financial inclusion, trust and confidence is critical to financial inclusion. People are not going to put their money into new financial instruments if they're not going to trust that the money is going to be there and confident that the systems are working properly. When I started at CGAP, I was told that the poor don't care about privacy. It's only about shelter and food, which I had thought that privacy might be a factor in trust and confidence. And so we've set about to test that proposition in a couple of different ways. We did a qualitative study in India, interviewing 50 people around the country, and there was a very strong view that privacy was important in financial services. And there was sort of a quid pro quo, which is I don't mind giving my money to a financial institution as long as I am the one who benefits from it primarily. But one other aspect of it, which sort of relates to what Nati was saying, is that the people love their Aadhaar number in India. They laminate it. They keep it in a safe place. They cherish it. And I think very understandably, because it's a sense of identity. And when you live in a country of over 1 billion people, the government has said, we know who you are. This is you. Some countries you might think that's not a good thing, but in India, it's actually quite valued. And that was one of the striking things we got from our preliminary study. But we also, there's the privacy paradox that you may have heard discussed, which is people say they care about privacy but don't act that way. The classic example was a study at Stanford University where they offered students free pizza if they gave up their best friends' email addresses to a marketing company. I think you can tell what the result was. And the result was the same regardless of their stated privacy preferences or gender or any other factor. Anyway, we said about testing in India and Kenya, how people behave with regard to financial services and privacy. So for example, in India, we went out on the street and we showed people a loan product and an advertisement where the amount of the loan was the same, but the two different competing products from different companies had two important different features. One loan had a higher interest rate than the other, and the loan with a higher interest rate offered privacy protection for the person's data. And so the question is, and these are very poor people in India that we intercepted on the street. I walked along the streets of Bangalore, joined the team doing it, and we found, surprisingly, 60% of the people were willing to pay more for a loan that protected their privacy. So we said, okay, let's not make it just financial. What about investing your time? So we set up 2 desks, a 10-minute desk, getting a loan quickly, no privacy, a 30-minute desk where you have to wait longer, but you get more privacy protections. Like 80% of people got on the longer line. Now I will say that I noticed in India there's a sort of a crowd sense that the minute you start talking to someone, there's a crowd around. And then so if a lot of people saw a crowd at the longer desk, that might have accounted for at least part of it, but not entirely. We did some similar testing in Kenya where we found some similar results in terms of people's willingness to pay more. We also tried a test where we downloaded an app on people's phone and gave them a chance to essentially sell some of their privacy protections back. Anonymization, third-party sharing, how long the data was kept. And what we found is the one that they particularly did not want to sell back, that is the privacy right they wanted to keep most, was third-party sharing. They did not want to see that happen. And we saw, as over time people got more privacy protected, but even at the very beginning of the test, third-party sharing was the thing they least wanted to do. So I think, and we did the study really for 2 reasons. One is to see if there's a self-regulatory interest in promoting privacy, and we think it's in financial interest of lenders to do so, although again, as a sidelight, I'd say this is when comparison shopping was offered. If you offer different groups a loan, one with privacy, one without, the adoption rate is about the same. It's when they compare loan products and see that they get privacy that they're willing to pay a premium to get it. And the second is in terms of creating a regulatory environment, I think it lets policymakers know their constituents care about privacy and maybe just should have it as a baseline protection instead of having to compete for it in the marketplace.
That's an amazing story. We're going to open it up for questions, so start thinking of your questions. Sure.
Yeah, sorry, I just want to jump in on that. So from my perspective, there's nothing inherently more inclusive about digital. So in a lot of contexts, the reason that people don't have identity is 1 billion people around the world. There are a variety of reasons. So for example, birth registration is often the start of your sort of legal identity in places. Many times the reason people don't have sort of legal identity from that perspective is because they're not giving birth in hospitals, or because they fear persecution, or for a variety of reasons that have literally nothing to do with whether it's analog or digital. So I just want to be clear that there might be more that can be done with digital after it's established, but from a sort of entry point perspective, we shouldn't take for granted that there are some significant concerns there. I also think that in some of the contexts that David pointed out, especially in India and especially in Kenya, the recent judgment around the Huduma Namba, I think is really important. That I don't find it surprising that vulnerable populations are more concerned about privacy. There's certainly a lot more harm that can be done and inflicted, and a lot of these tools are actually used for exclusion. So before, where you might be locked out of a single service from a particular government agency, increasingly digital systems are consolidating the information and the power and becoming a single point of control especially for vulnerable populations, and creating a set of sort of in or out. So you're now either in a system or you don't exist. And that is incredibly inclusive in a lot of contexts, and there are increasingly courts are applying sort of fundamental principles of human rights, civil rights, political rights to really try and mitigate some of the harm that's been inflicted. So yes, there's some positive to inclusion, digital inclusion, but I think we should also be very, very clear about the risks and the potential for exclusion as well.
This is very exciting. There's a person watching us from London. His name is David Birch. Maybe some of you have heard of him. He's a famous blogger, payments expert. He's very funny. He's written a lot of books on identity, digital identity, and he has a question for the panel. Should we basically forget about KYC and go for AI-powered transaction monitoring instead? A good question for Kinga or any of you.
I can jump in.
Should
and
we
do the
give up
question.
on KYC and go for AI-powered transaction monitoring instead? Oh, KYC, know your customer, so I'm getting background on who the customer is.
So maybe I can jump in. So to marry on to Elizabeth's point about a lot of people don't get a birth certificate, also KYC verification country by country varies in terms of what the process is. So often unbanked populations will have the documentation. They just can't produce it. It's a 7-mile walk to the center where they have to bring it, and on the way there it rains and it soaks their proof of employment or their proof of where their address is. That actually just meeting the hurdle, even if you have the documentation, it's not reasonable to say somebody can meet that hurdle. Any of you who have opened a bank account in the United States, which is probably all of you, it was probably inconvenient how many forms of identification you had to bring. That's basically impossible for most unbanked populations. And so when you talk about, do you abandon KYC, I think there's two, not competing, I think they'll end up meeting in the middle trains of thought. One is, we can use AI and machine learning to infer who you are without ever needing that central trust authority to anchor and say, this is David Medine, open an account for David. Like this is his, wherever you are, your DC driver's license. I think on the KYC side, what you're starting to see is tiered know your customer checks, saying for this type of product or service, here's the identification requirements, and having stepping stones down to make those requirements easier for entry-level products. And I think both should be considered. I'm really excited about the movement on the actual regulatory side, saying we're going to have tiered know your customer verification. And interestingly, at least I'm seeing it very quickly in developing countries because they're grappling with digital for the first time. So they're able to, with a fresh set of eyes, work with folks like CGAP to say, how should we write these laws and these policies? And then do that, and you're seeing tiered KYC.
Anybody else have a comment?
Maybe I would just add to this that whenever you're implementing AI, it's not like you're closing your eyes and hoping that everything is going to just magically work. I think you really have to think about having guardrails in place and monitoring your system, right? Because we all know that over time, the models will degrade. So you have to think about replacing them or retraining them. And it's really important to have a framework in place where you know that things are actually working. The goal is to make us more efficient, not more miserable.
That's a good motto. Okay, any other questions from the audience, please? Here. Is it on?
Hi, my name is Vipin Bharathan. I run a small consulting company called DLT.NYC, focused mostly on blockchain. Anyway, my question is, I'm not lucky enough to be born in a country where my information has not been already stolen. So, given that a lot of our stuff is, a lot of our privacy is already lost, many people tell me, you know, when I talk about privacy, why do you even bother? We've already lost it, like our virginity. It'll never come back. You're done. So I want to see if there are any pathways to getting back our innocence, going back to the Garden of Eden.
That's a colorful question. Thank you. It sounds like something Dave Birch would say, by the way. Go ahead.
Why not? I'll jump in on that. I think it depends how you define privacy. So if you're talking about, you know, my data is out there, my data is for sale, my data is on the dark web, I think, sure, that's probably true. That is true. But I think there are many dimensions of privacy, in many ways to think about privacy, including data protection, which is related but different, right? And so I think the Clearview AI, developments are a prime example of this, where, the fact that your photos are publicly available on the web, obviously a lot of people feel like that doesn't entitle anyone and everyone to utilize them for whatever purposes they deem fit. And so I think that's a really important distinction between privacy and then this notion of data protection, which governs the uses and the recourse that you have around the uses of your data. And so in my mind, there's still a lot of gain and a lot of wins to be made around thinking in those terms. And I think we can borrow from what other jurisdictions are doing and have done. And we haven't really been thought leaders globally around privacy in some time. And so I'm sort of looking at what other jurisdictions are doing and how they're thinking about this. But from my perspective, that's one area where there is a lot to be gained.
Can I add to that? First of all, I wanted to add a subtlety. It has to do with AI and machine learning, and that is the more data you have, the better the model you can build. And all these wonderful AI technologies are based on having lots and lots of data. So face recognition systems, image recognition, speech recognition, all the things that we know and love, even search, are based on having lots and lots of data. Data about us. It's our behavior that these IT companies are using. And so that there's that sort of cost benefit, if you will. But there's something even more with the promise of AI that is pushing this need for privacy, and that is different organizations know that if, for instance, hospitals know that if they can share data, say about patients, they can build a better machine learning model that will will reduce false positives and false negatives in determining whether that X-ray is showing a cancerous tumor or not. So the benefit is actually sharing data, and of course HIPAA forbids the sharing, but there are privacy-preserving technologies that there are many, but some of them can be used in a way that you can share this data but still preserve the privacy of the individual pieces of data. And some of these techniques are cryptographic based, but they're not scary. And big companies are already using these kinds of techniques for point solutions to point problems. So I think that there's actually a lot of progress in the privacy-preserving technology space that will light up new scenarios that will benefit society.
Another aspect is all of that data on the dark web is used mostly for knowledge-based authentication. So like your mother's maiden name and name of your first pet. And that's a really lousy way to authenticate somebody. We should be moving more towards biometrics so that value of that data. Does this tie in with the, what is it, ID for D, digital ID initiative? Is
yeah, if I could just quickly also respond in two ways. One is the fact that countries around the world are clamoring to develop data protection legislation shows that at least policymakers don't think all is lost on privacy. And then I can tell you from a personal experience that people say kids don't care about their privacy anymore, but my kids have figured out how to block me on Instagram and Facebook. So they just draw the line in different places. The ID for D is a program at the World Bank that promotes digital ID, and it incorporates privacy by design as part of its proposed approaches. But I actually have a question, if I could, for the machine learning AI folks, which is sort of accountability and fairness. In the financial services space, we have policy considerations that may, in some cases, override predictiveness, like fair lending. And the problem with AI and machine learning is it can incorporate not such fair lending from the past. And I did a stint at the Consumer Financial Protection Bureau where we had a company come in to show its predictive risk prediction tool. And we said, and they said, oh, it's far better than Fair Isaac and everything out there. And we said, how does it work? They said, we don't know. It just works, and it works really well. But you can't say the 4 reasons why you turn someone down because transparency. How do you reconcile the cool aspects of AI, that it works so well and is so predictive, with the need for overriding policy concerns?
Yeah, so I think a really important point here is that you should never be implementing your models if you don't understand them. So you never want to have a black box model. If that is the case, you're going to be in big trouble. There are many techniques to actually show you how your model thinks, and I wish I could show you a demo of our platform to showcase some of those capabilities, but I'll just mention one. So whenever you get results from our platform, it's not just, say, a probability of a transaction being fraudulent, but it's always connected with the reasons why the model thinks that this is the case. And what you should be doing is looking at those reasons and asking yourself as a SME or business expert, does it make sense, right? So there's a lot of work up front that you have to do to get comfortable with your AI system before you actually deploy and put it in production.
Okay,
I just wanted to add to that. I think what Kinga just said is tremendously important if you're an agency and organization that is using AI or machine learning to make decisions about people. The academic community is at the point where there are many of these AI systems, particularly using techniques like deep learning, where we actually don't know why the system makes a particular prediction or makes a particular classification. Yes, it spits out a probability, but we can't trace it back to give you the explainability and the interpretability that you would like. And these models can be huge. They can be billions of parameters trained for weeks on clusters of GPUs. So these are non-trivial pieces of code, if you will. It's not surprising that they're not explainable. But when they're making predictions about people, a risk score, a lending score, and so on, you as a customer should insist on an explanation, and you as the agency using these should figure out how to give that explanation to the customer.
Well, I'm being told our time is up, so I'd like to thank all the panelists. It's a really great discussion.
Do you work? Oh, okay.
Really good. Hey, good to see you again. I will see you. Keep on publishing everything like you still publish. The last couple months have been very good. Thanks. Yeah, you also. It's nice to have someone who knows a lot about machine learning. I'm trying to find associate groups.
That's a little hard to imagine.
I have no idea. We used to commiserate with each other. The big firms.
Yeah, I left that behind too. You were in Dallas, DC?
Yeah, life companies compared to other.
Yeah, I don't miss it, I'll have to say.
Technology, it's music.
If you know, we have this center that with IBM on blockchain data transparency, so I know who the faculty are in Columbia who are very interested in blockchain.
Okay, folks, deep breath. Thank you very much for that panel. Sorry, a few minutes late getting up here to thank everybody. Just some issues going on. I now want to call up Carol Van Cleef, again, another old friend of the observatory, and she's going to moderate the legal and regulatory panel. I'm really looking forward to that. So over to you, Carol.
Well, good afternoon. I assume this is the panel that everyone has been waiting for. We're very fortunate to have a panel that is very rich in the in regulatory representation. I think we're waiting for a couple of them to still get up here. Hey guys, come on up.
I will say I commend Leon for his organizational capabilities and putting together such a strong and fine panel. The one mistake he made is he didn't invite Hester Pierce to be a speaker today. And we'll get, if you haven't read the papers, we'll get to that later. But in any case, it looks like we're just about all together here. We're maybe missing one, but I think we're going to go ahead. Oh, here we go. What I'd like to do is have each one of the panelists introduce themselves and tell us a little bit about what their role is in the particular organization that they're in. Matt, do you want to lead off?
Sure. Hello, everyone. Yes, it's working. Okay. Matt Homer. I work for the New York Department of Financial Services. You heard this morning from Superintendent Linda Lacewell, who is my boss, and I am the head of our Division for Research and Innovation.
I'm Melissa Nettram. I'm with the Commodities Futures Trading Commission. I'm the head of our Lab CFTC unit, which is essentially our innovation arm of the CFTC.
My name is Daphne Waxman, and I'm an attorney with the Securities and Exchange Commission within the Division of Enforcement, and I specialize on matters related to distributed ledger technology, digital assets, initial coin offerings, and all that kind of good stuff.
Hi, I'm Josh Clayman. I work for the law firm LIVESTREAM, and I'm the Global Tech Sector Co-Head, U.S. Head of Fintech and Head of Blockchain and Digital Assets. And I also chair the legal working group of the Wall Street Blockchain Alliance. So I love this space.
Hi, everyone. My name's Aaron Wright. I'm a professor at Cardozo Law School. I also run Cardozo's blockchain project. Thanks so much for having me.
Well, we're going to do a lightning round quickly because we want to flesh out as many of the issues as we possibly can, because for those of you who have focused on this area at all, you know that not only do we have a lot of issues, but they're very complex and they're often out into different areas. So we're going to go down. I'm going to ask each one of the speakers to give me your number one regulatory issue from the perspective of where you sit. And then, and you can do it all in the same breath if you want to, is what's the number one legal or regulatory development in the space from your perspective? So there's a little bit different there. One's the issue and one's what the development that's happening. Matt?
Yeah, sure. Yeah, I mean, I think that, I think from a very, so I'll provide sort of two answers. I think from a broad innovation perspective across fintech, not just blockchain, but more broadly, I think the question that I spent a lot of time thinking about from a regulator's perspective is how can we enable new entrants into the market in order to sort of promote competition, improve financial services for consumers, while at the same time ensuring consumers can have public confidence in those new solutions that emerge. So I think that's something I spent a lot of time thinking about. With regard to sort of crypto issues specifically, I think the issues are, I mean, the big issues are AML, CFT, and cybersecurity, I think, from our perspective and in the companies that we look at as we're licensing. Yeah, so and I think to answer the second question about kind of the development, I don't know that, I think for me it's kind of the blurring of the lines. I mean, as sort of, particularly within the crypto space, how, as it sort of evolves, my observation being on the job here for about 5 months is that everything that's been invented in traditional finance is now being reinvented on top of blockchain. And from a regulatory perspective, I think it's not always clear where the lines are drawn, which I'm sure many people in this room also feel. And so I think that's just sort of a broad, I don't know if I'd call that a development, but something that I think we're all trying to grapple with.
Just real quickly on that lines being drawn, do you mean the lines of what applies in this space, traditional finance, to what applies in blockchain-driven world of finance? Is that kind of line?
I think so, yeah.
Thank you.
Sure. So for those of you that aren't familiar with the CFTC jurisdiction, we're a little more limited, right, than the superintendent mentioned and Matt mentioned. We are focused, our jurisdiction really is focused in the derivatives markets and the trading of futures and swaps. and looking in the commodities space. So when I'm looking at, I'm 3 months into the job, a little newer than than Matt, but 3 months into the job, what I'm looking at in terms of what are the big issues, it's the whole idea of innovation overall, whether it be blockchain or AI or cloud or anything underlying the futures industry and the derivatives markets, and how does that fit into our current regulatory structure? In terms of the second question of what are the things that we're seeing most, obviously I think the hot topic of the day, as well as the hot topic the past few months, many of us have been talking about it, digital assets, and how do digital assets play in our regulatory space.
In terms of what's the hot regulatory issue for us at the SEC, I think custody of digital assets continues to be something that people are focusing on. And the question is, how will regulated entities meet the possession and control standards under the customer protection rule? In terms of regulatory what's important in the space right now, I think digital assets will continue to be used in financial transactions, and that we'll need to find a way to find an appropriate balance between fostering capital formation and also, on the other hand, ensuring that there is adequate investor protection and market integrity.
So I think for me, what I see more and more is a lot of companies, whether they issue digital assets in the past or plan to in the future, who are highly compliance-minded. And for example, they may have avoided in the past the US market, but now they see that to get to the next step, they really need to enter the US market, and they're trying to figure out how to do so in a compliant manner. Similarly, folks who are thinking about issuing digital assets, contemplating ways, if they're a very large company, for example, whether they might be able to do some sort of issuance in the US. So I think that that's something folks are grappling with that I see in my practice. What I think is great in terms of the regulatory developments is that we see that the regulators have been inviting discussions, have been continually listening to views from the market participants and from lawyers and from others, and inviting discussion. And so we've seen an evolution of additional guidance that has been very helpful. And I think, frankly, the announcement just within the past day or so of a potential token safe harbor is a regulatory development, or at least a proposal that's of particular interest.
Yeah, and I would echo what Josh just said. The proposed safe harbor is obviously top of mind, but part of a broader conversation about this division between whether or not a token can be classified as a commodity or security if it's supporting an open blockchain-based network. Beyond the safe harbor, we obviously have litigation that's pending that's going to come to a head at the end of the month, or at least we'll have some resolution, hopefully at the end of the month. Telegram, and obviously central bank digital currencies are incredibly important, along with other forms of stable coins, whether they come from a bank or from a large corporation.
Well, I think we've just teased out most of the issues. I was going to say Telegram, definitely in light of the judge's order that came out the other day, and we'll talk a little bit about that in further detail. But we've got innovation, we've got the AML CST regime, we've got consumer protection related issues, we've got the tokenization, when is it a security, when is it not? We've got a little bit of everything here. So I'd like to turn to Melissa. Could you tell us a little bit more about what you're doing in your role at your innovation lab, and how does that play into the overall mission of the CFTC?
Sure. First, I forgot my disclaimer to start off, which is my views today are those of mine and not those of the CFTC. I'm still learning and coming into a government role. I have to say that first and foremost. So Lab CFTC was created 2.5–3 years ago. As I mentioned, it is our innovation arm, so to speak, of the commission. With me coming on board in October, we rose from an initiative within the commission up to an office, reporting directly to the chairman. the chairman is completely committed to having innovation be core to everything we do. And in elevating us to an office, he was hoping that's a signal not only to those internal to the commission, but across the industry that, listen, when we say we're committed to innovation, we really mean it. At Lab CFTC, our goals are really to help in terms of promoting and fostering responsible innovation. And we're going to be doing that in a couple different ways. The first is with the elevation to the office, right? One of the things we're focusing on is being that the tip of the spear across the commission to identify ways that regulations should be changed or adapted given new technologies or innovations, or to identify how new innovations maybe are struggling given that some of the regulations were written 20, 30 years ago and didn't account for the technology of today. The other piece that we're going to be focusing on is education, not only external education through the efforts of, we do an annual Fintech Forward conference. We put out a number of primers for the industry on some basic things. We have one that came out in October on what is AI. But we're also going to be doing a number of education efforts internally. You can't expect regulators to know how to get that innovation to fit into the regulatory box if they're not even familiar with what that innovation is either. And so we're going to be doing what we can to help our colleagues across the commission in those efforts. The last, but certainly not least, I think probably the most important piece of our role is to be the front door to help people come in and talk to the commission on new technologies or innovations or even existing technologies and innovations or challenges they're seeing, and using Lab CFTC to be that way and the gateway into the commission. One of the things we've started doing across the commission over the past couple months is enable the once you come in, we connect with others across the commission to say, so-and-so will be coming through our doors and they're asking these questions. Can you make sure somebody from your offices are there? My prior life, I was at a tech company, and I know what it's like to, one, explain to those colleagues of yours, hey, it's important to go talk to regulators and convince them to actually spend the time to do that. But two, to go have a meeting with regulators and then walk away and sometimes think, well, the regulators got more out of that than we did. And so we want to make sure that, when you're coming to talk to us, that some of your initial questions are answered so that when you come back through the process, right, there's not really any surprises.
I think a lot of people may be confused between when they go to talk to, when should they be talking to the SEC versus the CFTC. Can you help us on when would we want to come in and talk to the CFTC as opposed to the SEC?
So if you are dealing with something relating to the derivatives markets or a commodity, definitely come talk to the CFTC. I think what Carol's referring to is there's often a question about, is this a security or is this a commodity? I will say, we work closely with my colleagues at the SEC and in terms of how to coordinate on things like that. But I don't know if you have any other guidance on that.
Okay, so well, thank you. That's helpful because I know that's something that comes up quite frequently. Daphne, can you tell us more about what your unit is doing and how that again interacts with the rest of the SEC and what you see otherwise, knowing that these are your own views of what the SEC is looking at generally.
Sure, and I have no excuse. I forgot to give the standard disclaimer today. These views are my own, and they don't express the views of the commission or any of the commissioners. So, first and foremost. So I currently sit in enforcement, and as an enforcement attorney, we investigate potential violations of the federal securities laws, and I focus on digital assets, distributed ledger technology, unregistered digital asset platforms. However, there's lots of other divisions and offices within the agency that are really actively engaged in this space. First and foremost, like Lab CFTC, the SEC has what it calls FinHub, which was established in the fall of 2018, which also serves as our central point of contact for the industry who want to engage with us on certain issues and receive and receive guidance. Within the FinHub, we have dedicated staff from all the offices and divisions, senior staff, who regularly meet with people about projects to discuss what the implications are from the viewpoint of the regulator and how the federal securities laws will apply to their particular project. The FinHub also issues lots of guidance, joint statements, such as the statement we issued with the CFTC and FinCEN in October of 2019 about various rules and applications in the space. The Division of Corporation Finance is also involved in a lot of activities involving reviewing registration statements of digital asset offerings and circulars under Regulation A, and also issuing no action letters when appropriate. The Division of Trading and Markets is involved in the application of the custody rule to digital assets, and also ensuring that digital asset platforms that are acting as exchanges are registered either as broker-dealers or they're operating pursuant to an exemption. The Division of Investment Management is also involved in the application of the custody rule and other requirements under the 40 Act to different products involving digital assets. In addition, we have OC, which is very focused on going into regulated entities and identifying areas of risk when it comes to digital assets. And also the Office of Investor Education is very focused on disseminating information to investors about initial coin offerings, the risks that they pose, and ways to avoid potential scams in that area. Also, like the CFTC, we regularly coordinate with other federal agencies, other state agencies, and other international agencies in the space to make sure that we have information about everyone and what they're doing to inform our decisions going forward.
And Matt, I know that, as you mentioned, the superintendent was here this morning, who gave us some, enlightened us in terms of what the overall department is doing. Can you talk a little bit about your division and then how your division, again, interacts with the department?
Yep, absolutely. Thank you. So the Department of Financial Services has, just very broad purview over many different sectors, which has been, I think, eye-opening and interesting for me to experience in my time here. We have very large, complex foreign banks all the way down to, in some instances, like a single individual who may have some type of non-bank license from us. So the kind of the breadth of different types of institutions is just very vast. So the superintendent, when she came on board, she created two new divisions. She created a cybersecurity division and a division for research and innovation. And I think that's a real, I think, indication of where her priorities are in terms of both risks in the market, but also opportunities for New York. I think one thing that is unique about New York and our mandate vis-a-vis, I think, federal regulators, is that our mandate also includes an economic development mandate, a jobs creation mandate, a regulatory modernization mandate as well. And I think that from an innovation perspective, that's very exciting because it enables us to really lean in to the innovation side of things in a very significant way, which we're starting to do. So my division is we have a few different, I'd say sort of two primary mandates within the division. One is to foster innovation in the marketplace across everything, fintech, insurtech, crypto, sort of everything we have responsibility for. And then also to foster innovation internally, which I think is equally as important, probably more important, frankly, but also more difficult. I'm a big believer that we cannot supervise technology in the market unless we know about that technology ourselves, unless we ourselves are somehow using that technology. And so I think you'll see us moving forward in both of those areas, putting in place programs to support innovators like the Project Whitehall InsurTech pilot program that the superintendent mentioned this morning, as well as other programmatic initiatives. And then internally, I think you'll also see us engaging with the RegTech community to improve our own capabilities. The division I'm responsible for also includes our virtual currency licensing regime, and there are a couple folks from the team in the room here today. We've licensed. There's two ways to do virtual currency business activities in New York. One is through a BIT license, or what's known as a BIT license, and then the other is by becoming a trust company in the state of New York. And we've licensed 24 entities altogether through our rules in that area.
And Matt, as you were talking, I realized that one item we had not put on the agenda, so I'm not going to hold you to having to answer this, is that there's one state that's been very creative recently, putting together a new special purpose trust company, or trust bank, with the idea that they're going to be able to take the powers of that trust bank and export it into other states, thereby sort of maybe skirting, or not having to deal with, I should say skirting, but having to deal with money transmitter licensing or BIT license issues as they may be. I don't know, and as I said, I won't put you on the spot as to whether your office has been looking at that kind of possibility, what it may mean if you start to see these types of entities coming to the table.
Never heard of it. No, I think look, I think there are a lot of things that states are experimenting with, and I think that's a positive thing. I think what I would say is that if you want to engage a virtual currency business activity in the state of New York, you do need to come to DFS.
And I think just on that particular note, I think one of the things that's worth looking at is, and this particular state has been very vocal in how this charter may be used going forward, is to take a look at the litigation that the DFS has been involved in for a number of years with the controller of the currency on the special Fintech bank charter. So it's just a footnote. I guess one last question to close out this round with the regulators. And Daphne, you mentioned a little bit about what you're doing beyond the agency. I guess I'd like to hear from the others, and if you'd like to expand upon what the kinds of efforts that are happening both in the U.S. and on a global basis.
Yeah, sure, and then I'll turn to my colleagues here. But I think the superintendent mentioned earlier, right, the Global Financial Innovation Network. That's something that the CFTC is also a part of, as I know my colleagues on this panel are as well. That if you're not familiar with it, there's 50+ organizations that are members of the GFIN in a way to promote financial innovation globally. I've heard a couple comments throughout the morning about how we given we're a borderless, this is a borderless issue, how our global regulators coordinating, that's one piece of it. At the same time, at least I could speak to the commission itself, right? As I mentioned, we work closely with the SEC on a number of issues, as well as a number of states that, if we are looking at an issue, what have they learned as they're looking at a similar issue? What are the processes that they've put into place? We're constantly looking for ways to coordinate and work what we can to improve our own processes as we're looking at that.
Yeah, we coordinate with many other regulators. In the banking space, we work quite closely with the FDIC and the Federal Reserve Bank of New York, where we often have joint responsibilities, as well as with regulators from other countries for foreign banks, and in the insurance space with other states. And then the crypto space, I mean, we talk with CFTC, SEC, and others all the time. So I think that's important for people to be aware of, that we do talk. We're aware of sort of the conversations that we're having with the companies in this space.
And I think there are a couple of others. I think the banking industry has been hard at work or the banking regulators for many years in putting together international groups, the Bank of International Settlement and others that they clearly have stepped out and taken a significant role. And then we also have FATF, the Financial Action Task Force, which has been working on common anti-money laundering standards.
There's also FSOC, the Financial Stability Oversight Council, which is comprised of all of the federal regulators. There's a digital asset task force underneath that a number of us coordinate on. And then informally, I'd be remiss if I didn't say informally, my colleagues at the other agencies who are also in innovation arms, we tend to meet on a regular basis just to share best practices as well.
So I think the key takeaway for me, at least, in hearing this conversation is the fact that we've got a lot of different players who are now at the table and engaged in this issue. And so it's no longer just watching what the SEC is doing, the CFTC or the DFS, but at looking at a much broader picture on these issues. So let's turn to our private sector people. In some ways have greater latitude in what they can say, in other ways maybe not. But so for Josh and Aaron, I'd like to get your views on what you think the sort of the top issues that we're dealing with today. I mean, obviously tokenizations is it continues to be a huge issue and has been in the news twice in the last 2 days.
Sure. So I think the challenge, particularly for lawyers and entrepreneurs that are trying to innovate in the space, is the number of overlapping and competing regulations that apply particularly for blockchain technology. I mean, blockchains are intended to be global in nature, right? It's native to the internet. It's not intended to have geographic boundaries related to it, and value can move incredibly fast. So if you want to transfer a digital asset of any sort, whether that's a digital currency, virtual currency, or tokenized share, or really any other form of asset, you can do that and have that pretty much transferred in about 10 to 12 seconds on platforms like Ethereum, or 10 to 12 minutes on platforms like Bitcoin. So that makes it very difficult for entrepreneurs to innovate. The rules here are complex. And in many ways, a lot of the rules presuppose some sort of centralized intermediary that would sit in the middle of these transactions in different ways. And that's the challenge that we're grappling with now. The second thing that's incredibly challenging is really that any of the digital assets that can be created can be used for different purposes, or they can be combined. So we've heard a lot about tokens in the first token boom of 2016, 2017, part of 2018. But even today, there's just new generations of synthetic assets that are coming out. So stable coins that automatically pay you interest. What are we going to do about that? That's going to be pretty concerning or pretty interesting, right? If you don't want to have people setting up bank accounts, they can pretty much just get paid interest on effectively something akin to a dollar bill in their pocket. So it's moving incredibly fast. And I think that the global nature of blockchain technology in particular creates those challenges. There's also a lot of folks that raised a tremendous amount of capital that are in a bit of a bind because they don't know whether or not what they did was going to be considered a security or a commodity. I think we've had pretty strong indication that most of those transactions, if not the overwhelming majority of them, involve the sale of securities. But at the same time, these entrepreneurs have built things that they think are useful and that consumers may enjoy, and they want to get into the hands of those users. So that's a particular challenge. And then I guess the last major area is just stable coins and or central bank digital currencies, right? The blockchain developers have kind of cracked that nut. They have stable assets, so not assets that fluctuate wildly like Bitcoin or Ether, but actually maintain a stable price. That's led to a lot of innovation. Just to give you an example, yesterday, about $1 billion have been locked up on Ethereum in various different decentralized finance or DeFi platforms. That's up from about like $30 million at the beginning of the year. So it's showing that hyperbolic growth that caused VCs to salivate and cause entrepreneurs to get really excited. And
what does it do to the regulators?
Right. Well, then the regulators get excited. Yeah. So the key thing here, though, is because we've been able to, or entrepreneurs have been able to crack the ability to have a stable digital asset, at least temporarily, maybe not long term. It's opening up new planes of innovation, and then also attracting traditional businesses to start exploring that, whether or not that's a bank that wants to issue a central, a bank coin of some sort, or organizations like Libra that are trying to build kind of a global currency, kind of acting as a central bank in and of itself, even though they're fashioning it as a payment system.
Yeah, I think Aaron put that in an excellent way, very thorough and good. So maybe I'll jump in a slightly different way, which is that yes, innovation is proceeding, And so maybe stepping back from my view, and before I go any further, nothing that we say on this panel, any of us, is legal advice or investment advice. And also nothing I'm saying is on behalf of my firm or the Wall Street Blockchain Alliance. But I think one of the things that we often do, and I'm guilty of this as well, is that we say, okay, we need the answers. We need the answers for this, how to make, we know what the end result might be. We might want something, say, at the end of the day, a token not to be a security. But how do we get from here to there? And so, fairly or unfairly, unfortunately, we end up taking the global we, asking regulators to provide us with guidance where we don't even know exactly the guidance that we would be looking for, right? We ask for some sort of answer when we don't even have a recommendation for the answer and how to get there. So I think just building off of what Aaron said, I think it's incredibly important to have this interaction and for the private sector, the public sector, market participants to discuss these things because I think we need to find collaborative answers and we need to go incrementally. I don't know if you want to touch upon is it okay to touch upon the token safe harbor for a second?
Yes, please.
So I won't go into details about it, but a couple of things that I think are really interesting as a proposal, right, is the idea that, okay, so say at the end of the day you want to have a token that is not a security. We already have guidance up to this point about many initial issuances from the SEC, for example. Although, not looking at you for the SEC, you're not speaking on behalf of the SEC, right? But knitting together the process and actually getting granular on what some of the steps might be and what some of the requirements may be so that people can begin to discuss whether these actually get at the aims of protecting investors while encouraging innovation, I think is really important. Because it's been wonderful to have lots of discussion and speeches and things like that, but to actually be able to say, here are what some of the requirements might be. And here's how we're going to hold developers and others' feet to the fire to make sure they're actually doing things in a way that is responsible to these people who are investing their money, right? We want to support their innovation, but we also want to make sure that people are acting responsibly. And things like, I remember when Aaron and I happened to be, I guess, up on the same, on a panel, talking about digital assets and talking about how even if you want to purchase a token for use, you still probably want to know certain things. You still probably want to know whether, say, 90% of tokens were sold at a 90% discount with no lockup, right? That might be material to you, or whether, the developer team is selling tokens. And I think tokens that they hold or how many they hold, that kind of stuff, or what the use of proceeds may be if if things are being built out. So I do think that that the proposed token safe harbor provides a good starting point for discussions. And I also think just the fact that in the speech, which was published just a few hours ago in writing, the fact that actually, Commissioner Peirce's email address is in that speech, I think that's pretty amazing. The fact that it's just inviting direct input, and I think, again, not to sound too pro-regulator right now, because again, as I said at the beginning, we have questions that we're all trying to figure out. But I definitely think that if you look at the guidance that's been given, it shows an evolution of thinking, and it shows that listening has been occurring to the industry.
Yeah, I think the challenge is just the speed, right? Entrepreneurs have 2 to 3 year time horizons if they've raised some degree of capital, and the wheels of federal and state agencies turn pretty fast, but not as fast as the cycle for a startup. And I think at the same time, lots of venture capitalists just are concerned that they're going to lose their capital. I mean, frankly, the ICO market's gone, right? It's dead. There's nothing else really going on there. There was a momentary blip where people tried to do exchange offerings, but there's not much going on in terms of tokenized fundraising at this point. So the token safe harbor is great. Maybe it reopens that up. But it also, I think, is animated in large part by folks that just want to get their capital back, or at least know that there may be a possibility for them to get some capital back. I think also with the safe harbor, it's interesting, but there's lots of additional details that need to be taken into consideration, which are not in the at least proposed bill. But it's always great to have this conversation. My sense, though, is it could also, we may just see the industry shift to just other forms of capital formation. For example, there's lots of innovation thinking about how to basically virtualize a venture capital fund in and of itself, kind of inverting the model a bit, which may prove to be just another path forward. So it's definitely interesting times. I think we'll continue to see this, and largely we're going to get some answers, which is really interesting, particularly for us lawyers. We're going to geek out about this. In the Telegram case, which has a hearing set, I think, for a couple weeks from now, which hopefully will have a rendered decision that addresses some of these knotty problems as well, which will shape the way that regulations related to tokenized assets will continue to develop.
Well, and what's always difficult in the space is that, as I said earlier, we have lots of different issues going on, and how do you sort them out? And so what you've just heard from especially that end of the table, really starting in the middle to the far right, or left, right, whatever, is the issue of digital assets as securities. Well, I think on this end, we have those who are looking at it from a commodity and currency being a commodity perspective. There's really very different sets of legal issues that come in. So it's important to keep those separate, though the Telegram case you mentioned is an opportunity for those things to come together, because 2 days ago, I guess, or late Thursday night was yesterday, the judge in that case sent or entered an order to ask the CFTC to weigh in on whether the Tron is a commodity. And that is potentially, this is, I think, an unprecedented step being taken in a case that could yield some very interesting results. Okay, we've covered a lot. Another issue, EFTs. This is, everybody keeps saying, when's it going to happen? When's it going to happen? Or ETFs, I'm sorry.
Yeah,
you can see I do the payment stuff.
Well, so that's, for more established assets like Bitcoin, and I imagine at some point Ether, there's been increasing call from investors to just gain exposure to them. So since there's, fairly clear statements or other indications that both of those assets are commodities, folks want to be able to trade in them, but not necessarily hold them. Holding a digital asset is still difficult. I think we talked about the challenging issues related to custody. And frankly, on the technical side, the infrastructure just hasn't been built up yet to keep these assets safe. So we know how to keep physical assets safe. We kind of don't know yet how to build really, really secure, mission impossible, like virtual safes for these assets. So there's folks that want exposure to these assets because they've performed well, but don't necessarily have the means to do that, and ETFs are a potentially attractive way to gain that exposure. Up until this point, we haven't seen any approved ETFs. It seems, at least in my opinion, that it's going to take a long time for that to happen, in part because these assets are held by a fairly few number of people. It's pretty concentrated. So I think there's just some concerns that need to be worked out related to those issues, and making sure that it's actually fair and the funds can actually not be manipulated in some sort of way.
Well, and another issue, and Matt raised that in his opening comments of top issues in the space, is AML, anti-money laundering. You said I'm going to get CFT, countering the financing of terrorism, and we add sanctions into that mix as well. I don't know how many of you followed this, but back last May, FinCEN, the Financial Crimes Enforcement Network, put out guidance to the world of crypto assets to say who's in and who's not in, covered by the FinCEN rules. And then at the same time, interestingly enough, they put out an advisory to the whole world, especially of institutions that are subject to the record-keeping reporting requirements of the Bank Secrecy Act, meaning the banks, the securities firms, and so on, of what they should be looking for in terms of criminal abuse of crypto assets. And then following up on that, back in December, the FinCEN director, Ken Blanco, made the comment very publicly before the banks saying, if you haven't seen any activity in your bank, go back and look again. What that means is the next round of examinations that the banks will be going through over this next year or so, the regulators, the examiners are going to be coming in and looking to see what the banks are doing from a proactive standpoint with respect to looking at customer activity, which could be in a variety of different kinds of forms. I think we've got an interesting issue as to whether that could potentially also, when we have examiners come in like this, there's usually a very predictable wave of what happens next, and that we will likely see another round of account closures. It could be like people like us that have, are involved in the crypto space. It could be others, and please, don't mark me down on that one. But that's an issue that's out there. It's going to be a meaningful issue because I think just at a time we're getting much more comfortable with getting into the markets generally, we're going to probably suffer some backlash. On the sanctions front, OFAC has been definitely taking a very proactive stance. They've put their first wallet addresses on the OFAC list back in November 2018, and subsequently have made it quite clear what their expectations are in terms of what the industry is doing, and I say industry, what is happening in the crypto world in terms of complying with the OFAC sanctions. Basically, they do apply as the message. And that leads us to a interesting case involving a gentleman who, I guess, allegedly asked the U.S. for whether he could go to North Korea to participate in a crypto conference, and he was apparently told no. He went anyway, and then on the back side, there's been allegations that he then continued to cooperate with and work with the North Korean government in trying to come up with I don't know if it was a central bank digital currency, but helping in that regard. And he was arrested the day before Thanksgiving, getting off an airplane in LA. Again, it's a message to what the expectations are in terms of compliance in multiple different types of ways. And then the last piece on that front, and I was the designated person to speak on this, is FATF standards. Back in June, FATF made it clear that they expect their member countries, which is 37, to enact laws that would effectively do the same thing for, it would take our funds transfer rule and travel rule and incorporate those concepts into their statutes. And that's a law that says that, hey, you're supposed to collect name, address, and other information about the sender of a transaction and also the receiver on the other end of that transaction. And by the way, you're also supposed to send that information along after you collect it to the institution where the transaction is going, and if it goes to any transaction in between or any place in between, you're supposed to send it there as well. I will say that's probably the most significant issue that is plaguing or I shouldn't say plaguing, but it's consuming a great deal of time and attention in the crypto space right now. And it may ultimately be a game changer on a number of fronts in terms of the pure crypto asset itself. So I went through that very quickly. So I guess we mentioned stablecoins earlier. Oh, I guess, Matt, do you have any other comments about what your department is doing? Because I think you have the most direct interface with regulatees on these issues.
Yeah, happy to talk briefly about it. And I think there's a lot to be excited about in this space, but we do have to remember that cryptocurrency is for the currency of choice for criminals, and can also be not only national security threat, but also can result in consumer fraud as well. I think with regard to the we look very closely when we're at sort of the AML BSA policies when we're looking at applicants. My colleague who reviews those is very detail oriented and looks at every aspect of those. With regard to the travel rule, I don't have anything specific to say there other than we expect our licensed entities to ensure that they're complying with all FinCEN requirements.
Okay, I have been given the warning that, or the suggestion that it's time to open it up to questions. Oh boy, we got one real fast here. Please go ahead.
I think you've asked too many questions today. So.
Okay. Okay.
They happen to be on point.
We'll get your microphone now.
Yeah, okay, I'll hi.
Can you use this?
So while we're getting that in place, we haven't had a chance.
I'll ask the question. Anyway, this is for.
It's on. Okay. Something like a little time.
So this question is for Melissa, because I'm going to ask about the digital dollar project. Your the ex-director of CFTC and the commissioner and Accenture have formed the Digital Dollar Trust. First of all, I mean, I know that the U.S. Probably is not going to go and make a digital dollar very fast, but we are definitely going to get central bank digital currency from other sources, like China. What will be the way in which those types of assets will affect, your control? Do you have any comments on the digital dollar trust in the first place?
I know of former John Carlos and Daniel Gorfine, who is my predecessor at Lab CFTC's initiative. I think it's called Digital Dollar Project. I wish them a lot of luck with it. I really don't want to comment on the specifics of it from a commission point of view. The only thing I would say is, as more and more people are looking across the industry, trying to identify again, well, there seems to be enough innovation that maybe we should be changing the regulatory structure or be thinking outside of the typical box. The more we should have this dialogue to continue to foster that. And other than that, I can't really say much more, but thanks.
And we weren't able to take the deeper dive into stable coins, but I think it's important to remember that not all stable coin, when you use the term stable coin, it really encompasses a broad range of product, and some of them may in fact be securities, as Aaron discussed, and others may be currencies. So this is going to be an issue that's going to be sorted out for quite a while to come.
Yeah, and some currencies are different. I was just going to say, some of them doesn't even touch our purview, right? More in the payment space. And
that's an interesting point, because there are some central banks that are working on stable coins, and then there are others that are just working on a pure digital currency.
Yeah, and this is, the BIS started looking at e-currency way back in the 90s. Academic researchers have looked into it since the 70s. So, this is an ongoing conversation, and I think a healthy one, right? Maybe there is a huge advantage to having digital assets that can zip across the globe. But there's lots of challenges, both in terms of privacy and just basic laws around money. There's a lot of complex laws that may need to shift in order to accommodate those types of things. Yeah.
Do we have another? Where's the microphone in someone's hand? Okay.
Thank you very much. Thank you. You can hear me, right?
Yes.
All right. Thank you very much. In regards to the ETF question, it's been a challenge, as Professor Wright mentioned. It's probably going to take a while. However, the rejection documents by the SEC have been pretty specific in what are the things that need to be resolved, mentioning repeatedly custody and shared surveillance. I'm curious particularly on the shared surveillance element, and I'd love to hear anyone's thoughts on that. It has to do with the underlying market and the potential for cross-market concerns, etc. What do you think potentially could make regulators feel comfortable enough that there's enough shared surveillance in terms of the total volume surveilled from within the volume of Bitcoin, for example? Do you have any thoughts on what are some specific kind of KPIs that the industry could be aspiring for in order to solve those challenges?
Melissa, Daphne, are you in a position to address that?
Any thoughts? I purposefully didn't ask anyone specific. Just any thoughts on that?
I mean, what's interesting is it's pretty easy to surveil Bitcoin transactions, right? There's plenty of analytics companies that can identify the flows of funds and, presumably de-anonymize a number of those, the large holders of those transactions. So if there is some abusive activity, it should be able to be readily identified. I think the custody issues are very complex. They just root down into very complex property law questions, which we haven't looked at in a very long time. Those are some of our oldest laws. But those are being sorted out both at the state levels with like Wyoming that's trying to address some of those questions, and other committees like as part of the Uniform Commercial Code amendments, et cetera.
And I do think this isn't a specific example that you're looking for, but I do think while the discussion has been centered largely around the rule changes and them not being approved, right, and that leads back to the market surveillance points that you're talking about, I do think that what Aaron mentioned earlier about the expansiveness once you have an ETF, and basically I always think this is the center of the universe, digital assets, but actually we're still a small number of people who are using them and holding them. So I do think that a larger issue is just if you have a flood of people that you don't right now, frankly. I think that's the real concern, or a real concern.
Well, and I think if you look at where we've been, 3 or 4 years ago and where we are today, the surveillance tools, as you said, are many more in place, and some of them are incredibly powerful. And I know that the regulators have been looking at those tools to get more familiar with it. Next question.
Hi, my name is Era from Galaxy Digital. We're an investor in fund space with market structure RegTech. So by the end of last year, we started a new wave coming up, majorly in the DeFi space, decentralized finance with Compound, Uniswap. So we're very interested in regulation around that space. I think Aaron, you touched a bit earlier. Now you have staking provider offer like a robot advisor for you without RIA license. And since those DeFi, they're like non-custodial, not necessarily, subject to the custody and BD license requirement, which proposed last year. How regulators think about that kind of jurisdiction over the DeFi space is something investor and startup we're very interested in.
Well, I think we have brought, the SEC has brought actions against certain entities that are non-custodial in nature. So if you have an entity that is engaged in offering or selling digital assets, even though they're not custodying the digital asset on the part of the investor, they could come under the purview of our rules and regulations. And one example is so-called decentralized digital asset platforms, which in my opinion are really just non-custodial digital asset platforms where the user retains control over their assets they only relinquish control by using their private key before they're entering into a transaction on the platform itself. So I don't think the custody issue gets you out of the larger issues here, whether or not you're acting as an unregistered exchange, whether or not you're acting as an unregistered broker-dealer. I think from the SEC's perspective, we really want to make sure that there are adequate protections for people who are selling, trading assets on a platform, that platform has rules that govern who can trade, whether token issuers can trade, if they're monitoring the space for potential market manipulation and things like that.
Matt, you sit in a unique position because this has been an area in terms of the lending, the finance aspects that has always been the purview of state regulators.
Yeah, I mean, we don't have a specific regulatory regime for DeFi, but I would say that a lot of DeFi type activities do fall within our requirements. And many of the type of proposals we see from applicants or existing licensees do touch on areas within the DeFi space.
And I think it's important to keep in mind that anything that involves lending. There are lots of laws that are around that, and I think this is going to be one of the big issues over the next probably 3 to 5 years in the space. Okay, another question.
May I ask a quick question? I just think it would be really helpful I know it will be helpful for some people who are watching or in the audience. So for the regulators, if a company wants to come in and see you, and they're not used to dressing up, what should they be wearing? Serious question.
Yeah, so we meet, I mean, I think we often do pre-licensing meetings with all sorts of companies, and they come in dressed in all sorts of different ways, and I think we view them all equally, so.
I know the SEC has been hosting P2Ps in regional offices across the U.S. and as long as as long as you wear your shirt and shoes, I think we're good.
Yeah, I would echo that, but then I'd also just add as a piece of advice, as you're coming in to talk to us, be prepared to also educate on some of the underlying technology as well. Don't always assume that the people at the table know what you're talking about, right? And a lot of what we can get as you come in is to learn about the new technologies and innovations, as well as then help you in answering your questions. But what we gain from those open office hours, as I mentioned, is a two-way street, right? You're the ones experiencing this real time, learning how the rules of the road are impacting your innovation or technology or not, and getting that feedback and those lessons is very valuable to us.
Do you have any suggestions on them consulting with lawyers before they go in to have those meetings?
Yes, very much so. We cannot, and I'm sure I speak for my colleagues, but we cannot give legal advice during our open office hours. And so we have had folks come in without lawyers, where we have said you should make sure you go talk to a lawyer or hire a lawyer and ask them about these 5 questions, because we cannot be providing you legal advice. So I highly recommend, I'm speaking to an audience where most of you probably either have lawyers or are the lawyers for these companies, but that is often what we recommend in those meetings.
I think a lot of times when we meet with industry participants, they're looking for answers from us, and I think we like to turn the tape and we say, listen, you guys are the technologists. You are really in the best position to find a solution to this issue. You know the technology better than we do. What we can offer is to help you identify areas of risk or concerns that we may have if you go down a particular direction. So, it's important to know what your role is and what our role is here.
One concern I have, and then we've got to cut this off, is if a party comes in to talk to you, they haven't talked to a lawyer necessarily, and they make comments that might be incriminating. Do you take notes during those meetings? Okay, thank you. And on that note, thank you very much to our panelists. It's been a great session.
Ladies and gentlemen, thank you very much to Carol. So we're going to have a coffee break now, and we'll call you back in about 15 minutes. Thank you.
No, I have to take a train back. Oh, okay. So I'm on my way back.
Life carries on. Hey, Josh.
Hi.
Well done. Yeah, great. Superstar. We're still gonna grab a coffee sometime. Okay, ladies and gentlemen, it's me again. If you could take your seats, we're going to start the next session. The end is in sight. So if you could please take your seats, I'd appreciate it, so we can get going on time and end on time. Okay, I want to call up another good friend of the Observatory and Columbia Business School, David Symington, a policy advisor, inclusive finance for development at the UN Secretary General Special Advocate for Inclusive Finance for Development. We had to print another page for that. Okay. I just need to get everybody back. Ladies and gents on my right, could you settle down, please, so we can start on time? Okay. Michael? Okay. So we're in the final stretch towards the end, and that, of course, means we're going to have a networking reception at 6 o'clock. So I invite you to stay for that. It's from 6 to 7 in this room, and they'll clear out the area on my left for the reception. So I invite you to stay if you'd like to. Thank you very much. Over to you, David.
Yeah, so thanks, Leon. We got the graveyard shift. So hopefully we will keep a little bit of an audience, and also that you will all stay awake. So we're changing gears a little. So from talking about digital currencies and crypto assets in the US, we're actually going to switch and think more about digital financial inclusion and the fact that we have like over 1.7 billion people that are still unbanked. And I'm really delighted that we have an absolutely fantastic panel, and I'm glad you've all stayed to hear from them. So I'm just going to introduce people by name and organization, but if you want to know more about their background, it's in the booklets in front of everyone. So we have Karen Miller from Women's World Banking. We have Amr Ahmed from the Central Bank of Jordan. We have Evelyn Stark from MetLife Foundation. And we have Stella Kemper from Flourish. Sorry, Stella. Always get your name wrong. And of course, Dara Duguay from Credit Builders Alliance as well. So let's kick this off. And we're going to first of all look at mainly two topics in this discussion. The first one is just big picture. We're going to think about what are some of the key opportunities and risks for digital financial inclusion given the emerging technologies we're seeing. And the second issue that we're going to address a little bit later is we're going to think about financial health, what we mean by that, and how that looks around the world. So let's start. So Karen, as you know, a really good thought leader, from Women's World Banking's perspective, like what are you seeing as kind of the key risks and opportunities from digital financial services for the underserved and in particularly women?
Thanks, David, and thanks everyone for staying this afternoon. It's been a great day. I think let's talk first about opportunities. And I want to focus first on the private sector and what they really need to do to embrace the opportunities in serving un- and underbanked women. And first and foremost, understanding that tremendous market opportunity in serving the women's market. If you can first understand that, then the next steps really make a lot of sense. And that is then actually understanding what women's specific needs are when it comes to digital financial services and kind of getting out from under any biases you might have about serving the women's market. It's not about pink products. And so what we really see at Women's World Banking is that if you do go in and have these conversations with the private sector and start to show them, for instance, that here is a specific example. In Pakistan, we worked with JazzCash. And JazzCash said, well, we don't think women are very good clients of ours because we don't have that many women clients. Well, we went in and looked at their data, saw that women's behavior was virtually identical to men's. And so we said, well, there's 5% women clients. So what are the barriers that we're seeing to address the fact that there are only 5% women clients? And we found two very distinct barriers. The first, women very much want to know who else in their friends and family are using the same product. They like the client referral. So how do you address that? And then secondly, you're a Pakistani woman, you actually own a mobile phone, you're excited to have that engagement and ownership over a financial product and service in your hand, but the first step you have to take is to go to a local agent in your town, your village, your city, and to open the account. You go up to that agent, the first thing that gets asked is, what's your phone number? A strange man you don't know is asking you, a Pakistani woman, what your phone number is. Right there, you've got a barrier to opening the account. And so we worked with JazzCash to address these two issues. One, very simple SMS referral, so that women would know their mother, their sister, their friends are also using the JazzCash product. Secondly, working with JazzCash and Unilever, who had a group of women called Goody Bajis that were selling Unilever products in the local villages and training them to be bank agents. And so as a result of those two interventions, you saw an increase from that initial 5% to 17% of the JazzCash clients in about a year and a half. And so, you're still saying 17%, that's not where it should be, but finding those incremental solutions to address the barriers that women face, you can make the type of progress that you want. The second thing, though, I want to address is on the fact that digital financial services, let's not think about it just as digital. And so, to use the portmanteau phrase of phygital, you've got to leverage the digital, the convenience, the security that digital allows, but make sure that there's a human face with those elements so that a woman can engage with someone, ask questions. If you can address that, women have lots of questions. They want to know that there's a face behind this abstract digital product that they're using. So we need to be able to address that. And quickly on the risks. So first and foremost, women do tend to have lower digital and financial capability. So how do we address that? You think about the adult classroom training is not the approach to take in addressing that. It's how do you engage women in the moment when they're engaging with a financial product or service. And so once again, the agents may play a role in that, in providing that basic touch point right as they're trying to engage with a digital product. And then the other risk I want to address, and I'm sure Amr can talk more about this too, is from a regulatory perspective, thinking about know your customer requirements first and foremost. We have more than 500 million women around the world with no legal identification. That means they can't open a bank account. They can't get a SIM card in many countries. And so if you have very restrictive know your customer requirements, right then you've got a barrier for women addressing being able to access the formal financial system. So David, I think I'll stop there. And
Thank you very much.
Yeah.
Well, I think it actually naturally feeds on. So Amr, you're sitting at the Central Bank of Jordan. You sit in the financial inclusion team, and you've been, very much part of the heart and soul of developing the National Financial Inclusion Strategy, the kind of innovations on the payment system, as well as, trying to roll out the RegTech sandbox. So From your side, what do you see as kind of like some of the key risks from new technologies that are trying to serve the underserved? And what are some of the biggest opportunities in Jordan?
Thank you, David. And if I can start with opportunities as well before risks.
Yeah.
Well, I mean, first of all, it's making or banking available for all. It's not about banks or financial institutions itself. It's about outreaching and making financial services for people. So one of the main opportunities is, for instance, leveraging in Jordan, we're leveraging on the national mobile payment switch, which was particularly designed for the underserved, based on an agent network where they can approach and open a digital wallet and then try to start to transact and have access to credit and different other services. And we've been working along with the Ministry of Trade as well in order to provide licenses for home-based businesses, especially for women, in order to be connected to digital platforms as well, in order to offer their products and services and get payments online and digital payments as well. And that's one of. On the other hand, we have a different population as well, which we target, which is youth and refugees as well, given the circumstances in Jordan. So we've worked on regulatory reforms to allow refugees to open digital wallets because of the barriers they face opening bank accounts, and that goes along actually on Jordanians as well, not only refugees, higher costs of maintaining a bank account. So you provide broadly, let's say, digital financial services for most, actually more of 67% of population who are underserved or actually financially excluded. So that's one of the opportunities. On the other hand, you create opportunities from, let's say, supply side, from a government side, by digitizing government payments, and that goes both ways, either people to government and government to people. So once the whole cycle is digitized and promoting with private sector as well to develop more lower cost products for population, that's where you see this public-private partnership working best. Now, if I want to go over opportunities, I cannot stop because that's part of my job to look for these opportunities. But for risks, mainly we can go over, again, particularly in Jordan, given the circumstances around, money laundering is one of our biggest concerns, and counter-terrorism financing as well. So that's one part. And the other part is social. As you said, Karen, women go to a mobile payment service provider agent, and they're asked to give their phone number. And that's, again, one of the other risks that we face. Now, on the other hand, is lack of financial literacy or capabilities as well is one of the challenges that we try to tackle much. And it's not a problem or like an issue that we can, as you said, that we only can provide in our curriculum. It has to be a mutual, social kind of thing, and in partnership with private sector. So that's in a nutshell, and I'm sure we're gonna dive more in other issues.
Yeah, so just as a very quick recap, so I'm reminding everyone to ask hard questions at the end to both of these guys. So we heard from Karen that for serving women, we really need to understand their needs better and the cultural context. That is not just the technology solutions, but also the touch issues. And there's a real need for both tiered KYC to make sure that we're not excluding women that don't need to be excluded. And also, how do we think about tailoring programs and trainings to build digital capabilities? And from Amr, we heard about enabling regulation so that refugees can also be serviced with goods, with products and services, as well as enabling a better enabling environment for mobile money, and G2P and P2G payments being real opportunities to drive financial inclusion, as well as risk obviously being on ML CFT, and there's still being remaining social barriers, as well as challenges towards literacy, and we need both the private and the public sector to step in. So I'm going to change gears, and we're going to move on to financial health, but please think up your hard questions for these two for later on. So I'm going to shift to Evelyn. So Evelyn, can you tell us what financial health is? Can you also tell us kind of like how it links to financial inclusion? And could you tell us maybe a little bit about how that looks different around the world if it's low income or high income countries?
Sure. So thanks. I'm going to pretend I'm a lawyer or a regulator and just tell you that I'm speaking for myself and not my institution. And in part because it's 4 o'clock on a Friday and we should be a little bit provocative, right? So,
Good.
Financial health, I would say it's the evolution of how poor people have managed their money for time immemorial, right? So way back when, all of our grandparents were in savings, grandmothers, our grandmoms were in savings groups, and they pooled their money, and then they shared it out. Later, those things also became called credit unions, but somewhere in the 70s, we decided that we would create micro finance groups, and all the women would my favorite joke, Graham Wright's joke really, is that if every woman in Bangladesh bought a cow with the proceeds of her microfinance loan, Bangladesh would have sunk under the weight of cows. So, but we created this system where we told women that they had to create a productive enterprise. It really wasn't that useful for an awful lot of people. You had to find 39 people to join you to borrow money at the same time that you needed money. So then it evolved some more, and it became more flexible and more useful, and we stopped making our customers lie to us, and we let them say, actually, what I really want this money for is to invest in my husband's rickshaw business. I will be the banker. He will be the rickshaw driver. And by the way, then he reports to me because he has to pay me so that I can pay you. So there were a lot of changes in this story. And then, the credit only, we realized people were actually borrowing because they wanted to save. And so this is where microfinance morphed into financial inclusion. And I will say that from the beginning it was a good idea, and if you look at any definitions of financial inclusion, it has all this lovely stuff about quality products, great service, respectfully and responsibly delivered. But when I ask you what the measurement of financial inclusion is, you're going to tell me 1.7 billion people around the world don't have an account. And so this is the provocative part. I'm going to tell you I don't care if people have an account. Truly couldn't care less. Because if they're not using it and it's not useful, then why do I care, right? So if I have an account with zero money, I haven't transacted in it for a couple of years, if I have bad debt, a loan, I'm included, right? And then I look at the United States, you cannot get access to a really terrible, horrible payday loan at 400% unless you're financially included because they need your check, right? So inclusion started to seem like a binary, either you're in or you're out. And that was never the intent of the financial inclusion community. In theory, it was an overhyped story at some point. Oh, we're going to give people loans, they're going to become productive, and then, everything's going to work. But, we've shifted and morphed. So I think we came back to financial health. Health is much more intuitive. If you tell me someone's healthy or not healthy, then you're going to assume a bunch of different things. I don't think we have the metrics right yet at all. I don't think we have enough metrics for what financial health actually is, but it's a lot more intuitive than binary inclusion-exclusion. So then where I came to this, the United States, just to give you some quick statistics, 96% of Americans have a bank account, 33% of Americans are financially healthy. That means that they could cover an emergency, that they have some money in long-term savings, that their debt is not overwhelming. Americans are really great people. 54% of them think they're in financial control. So 33% healthy, 54% optimistic. That also actually worries me about digital. But Kenya, which many of you might know of as the success story of digital financial services, 85% of the population is now connected through a mobile phone, right? I would tell you that that's a prepaid card, right? If you think that that's great financial health in America to give people prepaid cards, I think you probably wouldn't say that was the best thing going. But we're saying it for Kenya, which also kind of I find difficult. But of 85% inclusion, we have 10% of the population financially healthy. So I think that that's where we really want to be as people in development. So not people selling things. People in development who want people's lives to improve, we want to close that gap. So we're not trying to spell sports betting, which has really loved mobile money. We're not trying to sell payday loans, which have also really enjoyed mobile money, as do the bars. So that's my spiel on taking the risky side of where we are and how we got here.
That was incredibly good for such a short amount of time.
Okay.
Thank you very much. Do you want to come in here,
Yeah,
Stella?
I'll just build on what Evelyn was saying a little bit. Financial inclusion is about access, getting people in the system, and financial health, I think of it as outcomes. So are people resilient? Are they able to manage day-to-day cash flows? Are they able to plan for the future? And I completely agree. I think a lot of this is just expanding the dialogue and the way we think about inclusion and financial health. And one thing I wanted to mention actually is that the World Bank runs a global Findex every 3 years in partnership with the Gallup World Poll, and they survey, I think it's 130 countries. They tend to be known for this one metric, what % of the population is banked. But there are a huge number of metrics, and actually this year we're expanding that, and Flourish, the organization I work with, is funding some additional new financial health metrics, and there'll be a separate financial health module. So hopefully we're starting to shift and think of it that way as well.
Stella, can I come back to you with a question then? So obviously you're coming from an impact investor, one of the most well-known impact investors in the digital and financial inclusion space. And I was wondering, so what is Flourish's investment strategy in relation to financial health? And also, just to add on top of that, to make it a little easier for you, what would you like to see more of from investors around the world?
Absolutely. So we are primarily, we think of ourselves as a venture fund. So we make early stage investments in financial technology companies, both in the US and internationally. We also make select ecosystem grants and do some internal research as well. When I think about where there's real opportunities and where the sector is headed, I think it's about shifting from a product lens, so thinking in product silos, to really taking more of a consumer-centric perspective about what consumers need and how they think about their financial lives and their lives more broadly. And this has come up throughout the day, this idea of taking this consumer lens. I think you can talk about behavioral design, human-centered design, behavioral economics, but it's also, there's three things that I think about in this front. It's about using financial solutions terms that people understand, just everyday person can understand. It's about making sure it's really relevant to their everyday lives. And it's also, to the extent that it's possible, embedding financial solutions in non-financial behaviors. And I can give a couple examples of each of those. So we invested in a company called Juntos that works globally and is essentially an AI chatbot, but works with bank customers, often newly banked customers. And one example that they've shared with me is they had a customer in Mexico who was a migrant worker and used to go home every weekend to deposit his paycheck and didn't understand, he didn't realize that he could just deposit his paycheck locally. The chatbot, they were able to realize this. They said, hey, did you know you could deposit locally? And it helped the newly banked customer understand how to better use tools. On the front of how to address real needs, one example of this is thinking about
day-to-day cash flow management. And we've invested in a company called Propel, which is actually based here in New York, that provides an app for managing food stamp balances. And so traditionally, food stamp recipients need to call an 800 number. It takes time. It's kind of difficult to manage. But this is essentially kind of like a personal financial management tool where food stamp recipients can do a better job of managing and thereby extend their balance over more of the month. And I'll give a third example, which is around embedding financial products in non-financial behaviors. We've invested in a company called Hula in Africa that provides agricultural insurance. And it's difficult to get people to sign up and use insurance, but what they've done is embed this into products that smallholder farmers are buying, like seed, for example. And when the farmers buy that product, it's bundled with the insurance, and therefore they're able to get that insurance really easily.
Great, thank you. So Dara, I've not been so nice. You're kind of the last person up, so always people can say what you might have been planning to say, so my apologies on that. But at Credit Builders Alliance, can you tell us a little bit about, from your perspective, and you guys mainly work in the US, like on the financial health challenges, like what are you seeing as the challenges in the US, and what are some of the opportunities from your organization are you seeing here as well?
Great, sure. Well, I wanted to share with you some of the statistics in the US that sort of underscore one of the main challenges. And these statistics are all around the credit realities among US consumers. So according to the CFPB, approximately 45 million Americans, about 20% of the population, are what are considered credit invisible, which means that they don't have a credit score. There's just no information about them. And Experian actually did their own analysis, and they came up with 54 million, so slightly more. I asked them why. They said they looked at their entire file, whereas the CFPB only bought a slice, so somewhere between 45 to 54 million. Additionally, some of the credit realities are that consumers in low-income neighborhoods are more likely to be credit invisible or to be unscored. Black and Hispanic consumers almost twice as likely to have very limited credit records. And low-income consumers are more likely to establish a credit history through things such as collections and public records. So through my network, we have 550 nonprofits that are part of Credit Builders Alliance. About half of them are nonprofit lenders. The other half are engaged in some kind of financial counseling or coaching. And it's amazing that when many of them do counseling and they pull someone's credit report, in some cases the credit report might be really, really, really thick, but this person is unable to generate a credit score. So how could that be? It's because everything that's on their report are things that are negative. There's no positive credit. There are things like collection agencies. There's things like, public records. There's things like judgments and so forth. You actually have to have positive credit, paying on time in order to generate a credit score. So it's a very strange thing that someone can be credit invisible but have a very thick credit report. Some additional credit realities among U.S. consumers. This is according to the New York Fed. About 51% of Americans have what's considered a prime credit score. About 31% are subprime. There's also a category in between called near prime. That's about 16%. And again, about 20% are invisible. So what does that mean if you're credit invisible? We had a grant last year by Experian, and we went into 5 different major cities. And we partnered with one of the members of our alliance and asked them to recruit their clients. And the other commonality among all of the members of the alliance, other than their desire to help people build a positive credit history, is that they tend to serve minorities and low to modest income people, a lot of immigrants. And so we did listening sessions in 5 different cities. They were very geographically diverse: LA, Detroit, Chicago, Dallas area, DC. but the stories were amazingly the same. And one of the questions that the moderators asked in every single city was this question that relates back to the Federal Reserve study. I'm sure we've heard this all the time, that what would you do if you don't have access to credit and you have a $400 emergency? Well, we found that the number one answer in all of those cities were that people would sell something, which means that they would have a garage sale, go to a pawn shop. The second most common answer would be that they would go to their friends and family. But in most cases, their friends and family were equally as broke as they were, so it's not really a good source of income. But it was really, really telling when people started talking about one of the other questions that we asked them, which was, what are some of the challenges in your life, actual challenges that come about by being credit invisible? And credit invisibility does not just relate to your ability to get financial products. It relates to so many other things. The credit report is used by 50% of employers in their job screening process. 50% of employers. Some states have outlawed it, but still nationally 50% of employers. It is used by most landlords in the tenant screening process. In one of our listening sessions in Chicago, a woman talked about how her credit is so bad. She said it was because of her ex-husband. But she said her credit was so bad that her and her children just rent from friends and family because she's not able to pass the tenant screening. We hear that all the time. Another story in Los Angeles was from a woman, a Mexican-American immigrant. She was really excited that she was able to get a degree. She worked really hard during the day cleaning hotel rooms and went to school at night. Her degree allowed her to get a better job, but she had no access to credit. She had no credit card. So she said this new job required her to travel. And so when she would arrive, she arrived one night very late, about midnight, at a hotel, and the company credit card was not working. And they said, well, no problem, just give us your credit card, you can figure this out in the morning. And she didn't have a credit card. And so it took her the longest time, until about 2 o'clock in the morning, until they finally let her into the room and allowed her to figure it out in the morning. She said it was totally humiliating. And so we're finding that the big problem of credit invisibility can be solved if people can actually create a positive credit history. And so that was actually the reason that Credit Builders Alliance was created 12 years ago, was to help the microfinance industry in this country. And many times when I say that I work in microfinance, the follow-up question is, what, in India? And I say, no, in the United States. And people say, there is a microfinance industry in the United States? And I say, yes, there is. Most of the nonprofit lender entities are certified by the Treasury Department. They were created in the Bill Clinton administration. And they're called CDFIs, which is short for Community Development Financial Institutions. There's about 1,400 of them all over. But additionally, a lot of nonprofits are now lending. These are nonprofits that you're probably shocked are lending. These are household names: Goodwill, Catholic Charities, tons of domestic violence groups, groups that aid people that have disabilities. Why are they lending? They're lending because their consumers and the people that they serve can't get loans anywhere else. And so we were created to be the intermediary that trains them how to do credit reporting. As part of being part of our alliance, the credit bureaus allow them to send their data. Absent us, they actually have a size requirement. So if you're a microlender underneath a certain number of loans, you actually are not allowed to report to the main credit bureaus. And so this is something that now is a reality and has been for the past 12 years. So I wanted to finish just by taking sort of this issue and looking at it on a global level. So a couple of years ago, it was the last year of the Obama administration, the Treasury Department had a financial inclusion event, and Bill Gates was the opening speaker. And he made a comment that microfinance had not really achieved its potential that they thought it would, and that the main problem is that the businesses stayed on the micro level. They were never able to grow.
And so I thought about that, and I actually asked Experian, and they're on my board, and I asked them because they are the credit bureau that's the largest in the US, they're actually UK-based, but they're also the largest in terms of where they have subsidiaries around the world. So they have 40 countries where they do business under a variety of different names, it's like Serasa in Brazil, but 40 countries that have subsidiaries. So what I did is I compiled a whole list through a bunch of different sources of MFIs in those respective countries. I gave it to my board member. She ferreted it out to all of the countries, and they did a comparison of those lists of those MFIs and who are their data furnishers. And with very few exceptions, like countries that required credit reporting, if you sort of exclude the ones that had a requirement, very, very, very few of them were actually reporting to the credit bureaus. And so what I take away from that is that if these micro entrepreneurs are never able to build a credit history, how in the world can they possibly get a bigger loan to grow their business from a mainstream institution if they don't have any history? And so just as it wasn't happening in the US organically, it took an organization like ours to recruit, convince, train, connect to the credit bureaus. That's missing around the world. We're very interested in looking at that. So if anyone is also interested in that, I'd love to talk to you afterwards. But we think that that could be really game-changing if we can help them and make the connection to the extent that credit bureaus exist in the developed or developing countries.
Okay, great. I actually would like to go back to Evelyn, if that's okay. I would like to kind of, because obviously MetLife has been very involved in collecting statistics on financial health, and we've just heard about the States and how financially unhealthy a lot of America is. Can you tell us a little bit more about what the global picture looks like and what that sort of tells you in terms of where you would like to see more work being done?
Sure, and I would second what Stella was saying, that one of the problems with that single statistic on Findex is that there's actually a lot more. Just nobody's looking at them because the one data point becomes the too large a data point. So I think that's an excellent source. We did a project with Gallup in which we looked at both objective and subjective measures, so sense of agency and ability to control your funds alongside more traditional questions about your ability to manage. So they're really interesting. They show a lot about, like I said, 54% of Americans are optimistic just about their funds aside from the fact that they're not financially healthy. Japan, actually 50% of the population is very financially healthy, the highest in our sample, but only 33% of Japanese feel like they are in financial control. So there's a lot you'll see on national attitude inside the data there, but I think that the big issue for us is it has to be local, it has to be contextual, and you have to go deeper. So we are working in Mexico right now. The central bank in Mexico is adding financial health questions to their national data. And working with our partner, BFA, loosely, not directly, and they're working together to create another measurement that's useful for financial institutions. So I don't think that the same measure that the central bank wants is actually the same measure that an institution wants in order to serve their customer. So necessarily, it can happen, but if I really want actionable data, that's one problem with the Findex data. 72% of the population has an account. It tells the institution nothing really about what do my clients want or need. So we're looking at data and measurement at an institutional level as well as at a policy level. And then also we're looking at a lot of behavioral science, which is not a measure per se, but really to better interact with and understand clients. So just a quick aside on the financial literacy and the literacy, I really think we can do better in just making products understandable. And you know, as you said, so is it easier to train 300 million people to understand your product Or would it be easier to change the 20, 40 products that we need people to understand? And I think that's an obvious answer, but that's where we are on measurement.
Okay, so I would love to ask the same question to everyone in the panel, from the different perspectives, but I'm going to hand it over to the audience to see what questions people have, because we've only got about 12 minutes left or so. But just before I do that, I'll do a really super quick summary of our discussion of financial health to remind you and get your question juices going. So we heard that in terms of the link between financial health and financial inclusion, we started off with more of a discussion about credit for small entrepreneurs, but clearly that is not the only financial need. And then we moved to thinking about financial inclusion, about access and usage, but we kind of forgot about quality and actually making sure it met people's needs, and that's kind of where the discussion is moving to. We also heard that America, we are very financially unhealthy, so there's a lot of work that needs to be done on that. We also spoke a little bit about metrics and how the new Findex from the World Bank that's going to come out in 2 years' time will have more data on financial health, and we should use that, not just quote the 1.7 billion financially excluded that I used earlier. And in terms of thinking about some solutions, we should, it's used all the time, but customer-centric solutions are really important. We need to think about how we can embed healthy financial solutions into products that people use, maybe not necessarily for which they think of as financial services. And we also heard more about needing to be nimble about using technology to use financial literacy. So like the lovely example in Mexico. And finally, I think the last couple of things we heard in terms of microfinance being something that's really important to help people build positive credit histories. We need to think about how we can tie behavior in microfinance institutions into our credit bureaus so that people have a chance to rebuild their credit histories if they've got a lousy ex-husband. And we also heard a little bit about how we need to think not just about these metrics in a US-centric or European-centric way, but context really matters. We need to be careful in terms of how we apply metrics, because they need to be both relevant to what institutions' usages are, but also to the country social norms. I hope that was a really quick, fast way of doing it. But so we got 10 minutes still, which is great. So do we have any questions from the room? Okay, so a couple of hands. Yeah. We'll try to take 3. And I'll try to divide it out based on how willing I see people at the table being to answer those questions. So, we 2 here to start with, and 1 there. Yeah.
All right, my name is Cornelia Caldeman from the United Nations Department of Economic and Social Affairs.
Welcome.
I have a question. I think it was briefly mentioned the role of G2P transfers in getting people to be financially included, at least to have that famous account access. And now my question is about the G2P transfers. How do you ensure it just doesn't just stay with the account? Because many times people just take the money out and then use it however they use it. So how do you make sure that this G2P actually translates into better financial inclusion, better financial health? What are the enabling factors?
So Amir, I'm going to give you that whenever. We'll take 3. Sure. Yeah. We'll do 2 more questions, and then we'll do a round of answers. So go ahead. There was another person here that wanted to ask a question. Yeah. And then there's also someone over here as well.
Okay, I'm lucky.
So.
Okay, Haitham. My question actually to Amr. Coming from Egypt, I know Jordan, they had very interesting experience about biometric identification and authentication as well, where they actually had a program for covering all the country and which use eyes for identification and authentication. My question is, like, does it have any effect in KYC process when it comes to financial inclusion or not? Did it have any effect? It has been like for 3 years now, I believe. So did it have any effect on KYC when it comes to financial inclusion or not?
Okay, and over here.
Hi. So my name's Henry Bruce. I work at Mix, a data resource for inclusive finance. So we've heard from a lot of stakeholders today. Thank you for your own diverse perspectives. But we haven't heard from many data providers or data specialists. So a question about data. So what are your thoughts in terms of improving decision-making at whatever level is relevant? For the trajectory of the data environment over the last 5 or 10 years and what you kind of see ahead in the next 5 or 10 years. And what needs to happen next, right? So if we're going to improve decision-making using metrics, using data, what's the kind of the key thing for you that needs to happen for that to be the case?
Okay, so you're very popular, Amir. So I'm going to give you one of the questions. I'll give you the question on the use of biometrics for expanding digital financial inclusion. Is there anyone at the table willing to pick up the question on GDP payments? And yeah. And then we, of course, have the question. Do you want to take the last question on what next? And on financial health, do you want to take the question? One of you both maybe want to weigh in on the data aspect? Okay, great. So, Amir, you can start. Yeah.
Thank you. Well, regarding the biometric, IRIS program has been established, particularly actually with partnership with UNHCR in order to identify the identity of refugees for receiving aid. So that's where it was firstly established. Now, after 3 years, it's still doing the same purpose. However, now because of many payment service providers are allowed to offer financial services for refugees, so the process of opening digital wallets for refugees now using biometrics is enabled. So that kind of increased the numbers of financial inclusion for financially displaced persons.
Great.
Yeah, but can I just add one thing on the G2P very quick? Because it's really important question, and I think what we have done is kind of special in this case. So what we have done, just to ensure, we've published or actually announced instructions for all commercial banks to offer basic bank accounts, which is tiered KYC. For population plus for payment service providers over mobile payments to open basic wallets as well, which is again simplified KYC. Now, after digitizing G2P, particularly social benefits payments distributed by National Aid Fund, what we've done is we've worked on different other projects simultaneously, same time, along with a program that we run, which is sponsored by Bill and Melinda Gates Foundation, which is called Mobile Money for Resilience. We've been funding and promoting private sector and different other entities in order to develop financial services, particularly receiving payments at merchants where most of National Aid Fund beneficiaries do their transactions. So what we've done is we've worked on the supply side, where we enabled and installed point of sales and kind of funded actually projects to create such financial services for beneficiaries in order not to just go cash out their money, to go, and we've located where they mostly go transact and develop and installed digital means of accepting payments as well. So that's part of it. And on the other hand, we've developed electronic bill and presentment system, which is connected to mobile wallets as well and bank accounts. So whenever they get payments, we ensure that they can pay all of their payments through wallets, which is utilities, telecommunications, and everything else at no cost. So, yeah, that's it. Thank you.
I'm going to ask everyone to limit their comments to answers to about 1 minute or so, because we're a bit tight. Do you want to come in here on the question on GDPs as well, Karen? sorry.
Sure. I think you hit the nail on the head on the whole issue around, okay, cashing out. And so how do we, help address that? And I think, Amar, you touched on all of this, is that, what are those connection points for when in this case, I'm going to give the example of when a woman receives a GDP and she is cashing out because she's thinking if there's any money left in that account, she will be penalized and not then receive her next full amount. So there are fundamental, issues sometimes with the full understanding and the connection points with GDP programs that we, need to address, and once again understand clearly what that user journey is going to be for a woman from the moment that that GDP is in her account.
So just to add to this, in Jordan, it appears that they actually did the entire ecosystem overview and talked to the customers. I would say that's a rarity. So very often they do this G2P, and depending on who it's coming from and who's administering it, you have major problems. So the social side says that women shouldn't keep anything in their bank account, because if they keep stuff in their bank account, that means they don't actually need my money, right? So, what are they doing saving? In the United States, we do that, right? If you have more than $2,000 in your account, you lose benefits. So we need to be super careful about how we design these things and who the benefit is. So you keep hearing that GDP is just so great. It saved the government X bazillion dollars. Great. Now women have to walk, 12 miles, or they have to open a bank account, and most bank accounts charge fees in order to do that. Or we get a prepaid card that every time you use it, you have to pay a fee. So I think these things, if they're not designed well with the customer and the system in mind, then they're not going to help.
Okay, great. Dara, can you answer the question
1 minute.
on data evolution?
Yes.
Where are we going next 5 years?
I'm going to talk about data in relationship to underwriting and some of the most recent changes. And so some of the big changes with credit scores and credit reports is that credit reports are starting to contain non-credit trade lines. So things like rent now are starting to appear on credit reports. I mean, this doesn't just appear. You have to go through a process, or your landlord. Things like telecom, utility, if the companies decide, can also appear. There's certain applications out there where you can give your own permission, like Experian has something called Experian Boost, where you can give your permission for your utility and telecom to actually show up on your credit report. And so people are getting more credit for things that are non-credit. And one of the biggest trends that FICO just came out, this was just in the news, with their brand new score. It's going to be out at the end of the year, called FICO 10. And one of the big changes in that score, other than the fact that they think that people that have bad scores are now going to have worse scores, but other than that, which has caused quite a reaction in the nonprofit community, they're using trended data, which is something that VantageScore, their competitor, has been doing for many years. And so the main difference is think of a credit report, it's normally just like a point in time, when, whatever that time is when you pull that credit report. But trended data is going to tell you a trend. So let's say, for instance, you have a credit card and you pay the monthly payment every month, so you're paying it on time, but you're consistently charging up to the max, and then they give you a higher limit, and then you're charging up to that limit, and they give you a higher limit, so you're getting yourself more and more and more in debt. So looking at the trends is going to actually give them, the underwriters, the lenders that are underwriting, more information. So those are some of the newest trends in data, at least in connection to underwriting.
Stella, I'm going to give you 30 seconds. It's 30 seconds, but they are the last 30 seconds, so it's also quite nice. Yeah.
Well, I don't know that I have that much more to add. I think data has been really, alternative sources of data can be quite powerful when it comes to credit underwriting and also insurance. There's also risks there, as we've talked about earlier in the day, and how that data is being used. But so for example, we invested in a company in India called Bond that uses the cash flow data for Uber drivers to be able to give short-term loans and understand and really help Uber drivers bridge the gap when they need money to buy fuel versus when they get paid a few days later. So I think there's a lot of, but I was also thinking about data from another perspective, which is as a call to action at a macro level. So thinking about these metrics that we're tracking, sometimes they're not always informing what decisions we should make at maybe a company level, but they can really motivate folks to find areas where they can focus, and they can motivate governments and the full ecosystem.
Okay, well, thank you to all our panelists. I would encourage you to go up and speak to them if you have questions that we didn't manage to get to, or if you want an even deeper answer. They're all really good thought leaders in this area. And finally, you're only one more panel left before you can relax and have like a beverage without ruining your credit score. So thank you.